certain patterns happening which show momentum, which show growth. Turnaround in stories. Those can help you make long-term investments, and that is where the equity markets is meant for, to make investments. On the other side, companies borrow money or take money, not borrow, but take money from investors to grow their businesses. So all of this is meant for that. Unfortunately, it's being used more as a trading platform, more as quick money operations. And then you have these opportunities of these people who can kind of proclaim that they've done X, Y, and Z. So it's part of the system. Unfortunately, people fall to it. Honestly, I'm not one who believes in these God theories, and I honestly don't think that anyone should. But the fact is, people are naive and dumb.
Greed and fear, as they say, are the two universal emotions that play in the equity markets and capital markets as a whole. And Mahima, of course, is with me this morning. Mahima, good morning.
Good morning.
And luckily, and I think it's high time, Securities and Exchange Board of India taking stock of everything that's going on. Of course, this is following through on regulations that they came up with on finfluencers. You have to be a registered research analyst or a registered investment advisor with the Securities and Exchange Board of India in order to give advice in the first place, and they weren't.
Yeah, and that's exactly what viewers need to know, right? Taking advice from anybody and everybody is not recommended. And plus, for viewers, I think it's very important to keep in mind if you're going and buying somebody's courses, or if you're taking somebody's advices, watching video, do your own background check on whatever stock he or she is recommending. You should not just blindly go ahead and buy something if it's recommended by something. I think that's the whole and soul of the story. That's the bottom line of the story.
Or take professional advice if you can. Even the advice that you get on this platform, on NDTV Profit, is always dispensed by SEBI registered advisors or research analysts. But even with that, we encourage you to go and do your own research and to possibly speak to your financial advisors. If it's stock related or even mutual fund related, please ensure that you're doing that. Having said that, Mahima, we've got our first caller of the day, and Kiran is calling us from Hyderabad. Kiran, very good morning to you. How can we help you today?
Good morning, sir. Good morning, Mahima ma'am. Every investor should be thankful for NDTV Profit for conducting such a good show like Ask Profit. It is very helpful for all the investors, sir.
I'm glad to hear this. I'm very, very glad to hear this. How can we help you today, though?
Sir, my query is regarding, I would like to deploy 3 lakh rupees, sir. I find many pockets attractive currently.
Okay.
For next 2 to 3 months.
Okay.
So, 3 lakh rupees in HCL or Shriram Finance, or both equally splitting them into 2 is my query, sir. I would like to head this query to Samir Dalal, sir.
Sure. With the caveat that Samir generally looks further than 3 months. Samir, interesting queries. HCL Tech from the IT pack, the question is, does it finally move out of the lull that it's been through? Earlier in the week, you saw a pretty smart up move for the index as a whole. And on the other end, you have Shriram Finance, which has been on a downturn. And we had Soumit Sarkar, who does a dealer check at 8:45 every morning, and he suggested, I think yesterday or day before yesterday, the senses from the dealing rooms that Shriram Finance may be now seeing a bottom. I'm wondering whether that holds true for the fundamentals as well, and whether you would go out and buy.
So let's talk about the two separate companies separately. HCL Tech in the IT space is actually one of the companies that has been able to, I'll not say post growth, great growth, but slightly above what the industry averages. So from that perspective, HCL is obviously something that is interesting, but valuation channel now. Today, when you're buying companies at the PEs of 20 and your growth rates are 5 and 6%, that means a PEG of 4, which is a tad expensive. So unless growth really accelerates for the IT space, and I don't know where, honestly, it's going to come from, given the fact that AI is coming in and taking away some amount of the opportunity that exists for some of these IT companies, it's going to be difficult to see where the growth comes from. But if it comes through, I think HCL is one of the counters that can do well. Now, 3 months, unfortunately, is too short of a period for me to give an advice on. that might rest better with a technical advisor. But fundamentally, nothing wrong with the company. It's a great company from maybe a 4-year perspective at lower levels. Coming to NBFC like Shriram Finance, so we believe the India opportunity for financing companies remains extremely good. And Shriram Finance is a large player which manages to get money at decent rates. The kind of book that he's building collateralized is quite strong and good. Where again, I won't say it's expensive, but neither is it cheap. It's trading at about 2.2 times book, if I'm not mistaken, on the 1 year forward. And if I project it a little further to 2 year forward, it's about 2 times. So it's not expensive, because expensive would be about 2.5 times price to book, and relatively attractively valued would be closer to 1.2 to 1.5. So it's in between. So if I had to take a call at this point of time, my bet would be more on Shriram Finance. But again, 3 months, very short-term period. I think technical view would be a better view to take in this kind of a situation.
Okay, point well made. You've seen one of the big stories this week, Mahima, has been the online real money gaming regulation that came through, the law that was passed in both the Lok Sabha as well as in the Rajya Sabha. And you had reports that said that some of these companies are contemplating shutting shop because it's practically impossible to conduct activity. And seemingly, the next update is that they're going to take the Union of India to the Supreme Court, or rather to the Karnataka High Court, and they're going to be discussing whether this is something that they can challenge in court. We were anticipating that this would happen.
Exactly, yeah. I mean, this was ought to happen. The lobby will go to the court for sure, because a lot is there on stakes for them. But having said that, I think when we spoke to the Methi chief as well, he also said the same thing, that they've evaluated this very well, and they've been evaluating this for the past 3 years now, and they've calculated everything and have taken a call post considering everything, considering job cuts and everything. So, and he also said that it's just 1/3 of what they are banning. 2/3, that is your esports, is not getting banned. Esports, and there's one more category in that which is not getting banned. So the people who will be losing jobs because of the real money gaming ban can go and find jobs in that
it may not be as
easy. The transition will take time, but I mean, this was ought to happen.
Yeah,
it was
had to happen. I must point out that what you're seeing on the screen is an NDTV Profit exclusive. It is coming from sources, and seemingly Dream 11 Gamescart, as you can see, are likely to file a writ petition with the Karnataka High Court by next week. And this was expected, as Mahima pointed out. Let's see how that pans out. As Mahima also pointed out, we spoke with the MEITY secretary, and what he said to us was that they have a strong case and they will be able to defend it. The pros and cons were weighed, as she pointed out. There will be job losses, there will be loss of business, but set that against the amount of money and livelihoods that are being lost on account of gaming, real money gaming and betting online, and they really didn't have a choice but to do something like this. We've got our next question. Let's take that up with Nilesh. Nilesh has been waiting by. BSE is the name of the counter that we're talking about, and it's had quite a battering in the recent past, also because of updates that came through yesterday from the Securities and Exchange Board of India's chairperson, who said that they're contemplating longer-term derivative contracts. We've got Manoj from Mumbai, who's bought 2,650 is the price. 30 shares is what he has. He's wondering whether to add more the current price and what the target is from here on. Nilesh, what's the view?
Well, Alex, the stock has been in a downtrend. If you see last 2 months after hitting highs near about 3,000, the stock has started forming a lower top and lower down formation and constantly facing resistance at the high level. So overall structure is indicating that there could be further leg on the lower side, which will take this counter towards 2,200. So better wait for some more attractive levels near about 2,200 could be a good entry point if somebody is looking to make an averaging. Current price is not a right time to average, and 2,200 to 2,150 could be a good entry point. It has a very strong support at 2,050. That's the long-term 200-day moving average, which seems unlikely to be taken off on the lower side. So it should find somewhere near about those levels some bit of support, and we can expect a gradual up move towards 2,600 to 2,700 in next 3 to 6 months.
All right, that's the view with regards to where charts are concerned for BSC. We've got our next caller. Manav is calling us from Gurugram. Manav, hi. A very good morning to you. How can we help you today?
Hi, good morning, Mahima, and good morning, Alex, and good morning to the experts as well. So I've been eyeing a counter for last 7 to 10 days. That is named HLE Glass Coat.
Okay.
And I was lucky enough to to get the detailed show in the Know Your Company yesterday.
Right.
And from there I got to know they have acquired a company called Omera in European Union.
Right.
So I wanted to know, like, is it a good point? Is it a good counter to, enter in? And what impact that the acquisition has on this company for the long term? I'm trying to, hold it for like another 2 to 3 years.
Right.
So is it a good point to enter?
Okay, I got your question, Manav, and since this is a long-term, from a long-term perspective, I'll take this up with Samir. Samir, if you've had the chance to study this counter, what's the view like, HLE Glass Coat?
Sorry, I've never studied this counter.
Okay, no worries. Then I'll take this up with Nilesh. Nilesh, your view on the charts, since, we've done a detailed KYC, Manav, you've gotten so much detail as to where fundamentals are concerned. But Nilesh, if he wants to make an entry right now, do you think the charts are attractive enough to enter?
Well, Mahima, we have already seen a spurt of over 21% in last 4-5 sessions in this particular counter. And if you see the volume attraction, which is higher than the average in this week itself. So looking at the overall undertone looks strong on the upside, and from let's say 6 to 8 months, the kind of time frame, it has a potential to move towards 650, 700. But it's not advisable to chase at the higher levels. Better to buy in a staggered manner, buy in multiple tranches. There could be possibility of some bit of profit taking, which might come in this particular stock, and which will open downside towards 450. So ideal strategy should be to buy on declines and keep a stop loss below 400. Position target comes somewhere around 700 to 800.
Yeah, it has been in focus ever since its results, and it ran up quite substantially after that. I remember having identified it in our 3 stocks in the morning as well, and on that very day the stock went up quite substantially. Yeah. The PAT numbers improved quite substantially on a year-on-year basis. It went from 5 crore in the June quarter last year to 18 crore in this quarter, and it's been a sizable uptick. Of course, sequentially they've seen a bit of a decline, but their margin profile has also improved quite dramatically. Manav, I'm glad that you caught the episode, and keep watching and let us know. Give us feedback. We'd love to hear more from you. Arjun from Kolkata is writing in, and he's asking about Hind Copper, which he's contemplating for a period of 7 to 8 months. Now, there are a few fundamental aspects that will come through over the course of the next couple of quarters. So, Samir, I spoke with the management, and what they were saying is that there is capacity that will come on stream in the remainder of the financial year. And so what they were saying is that Q4 and maybe the next financial year is when you will really see the implications of that. Do you think that now is a good time to start adding on to this counter?
So yes, capacity addition is going to happen, and that is going to lead to great operational leverage. Look, these are businesses that are converting mud, you could say, into a certain product, right? So that at the end of the day has huge profitability and margins, because the costs are only basically royalty on what you are able to find from the ground. So as the capacity for mining and refining increases, I think the profitability will increase. Valuations are, I think, if I'm not mistaken, I can't remember exactly at the top of my head, maybe a 40 or something trailing. Going forward, once the capacities come up, I'm sure the operation profitability will improve, which will drive profitability. Now, the stock has probably been in a lull for a period of maybe a year or so. So it might be an attractive entry point to start with, but I would say don't go all out right away. Maybe slowly accumulate it over the next 3 months. Unfortunately, this person only wants to be invested for 8 months, so he may not be able to capture the upside, because like you also said, the capacity is going to come up after some time. So the profitability, by the time they ramp it up, they get the operations running, and all of the profits start coming through, could be a year plus from now. So he may not be able to get the benefit, but for anybody else who has a longer term view, yes, keep adding the stock, and every time it corrects more, please add some.
You are bang on, actually. 47 trailing is where the price to earnings currently stands. We have to slip into a very quick break. We've got more time on the other side to take more of your questions, so do stay tuned.
माय बर्थडे गिफ्ट टू पापा, ये उनके पापा की पहली गाड़ी एक गराज में पड़ी थी दार्जिलिंग में, फिर 3 मैकेनिक, पेंटिंग, पॉलिशिंग। जब इसे फाइनली घर लाया ना, तब लगा लाइफ में ग्रो किया है। बुलाओ।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें। गोल्ड ग्लास, क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Banish.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell. Oh, wow. Yeah.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Us.
Welcome back. You're watching Ask Profit here at NDTV Profit. For viewers who are just tuning in, you can either call us or WhatsApp us. And in terms of where the markets are at right now, at its day's low point, the Nifty 50 trading around 0.8% lower, and counters that are contributing to that downfall includes your Grasim, which is down 2%, Hyundai Motor, which is down around 1.8%, Asian Paints also losing ground. There's HCL Tech, JSW Steel, Nestle, Tech Mahindra. So IT names and consumption names in particular not doing very well. So that's with regards to where the markets stand. But we're also joined by Rajesh Bhosle from Angel One joining us on this side of the show. Rajesh, hi, a very good morning to you. The next question that we have is from Natarajan, who is writing us from Chennai. He's asking about Suzlon. He's got 2,000 odd shares bought at 65 rupees a piece and looking for a longer term frame from a 3 to 5 years perspective, and wants to know if he can continue to hold the counter or not. Samir, I take this up with you. Your view on Suzlon?
Yes, I do, and I'm very positive on it. I think that we've gone through a huge time correction, not price correction, time correction on the stock, I think over a year plus now. Look, the operations are scaling up nicely. They've reached about 40% capacity utilization. They're talking of 70% in the current year. Look at the order book that they have. They're sitting on quite strong, quite healthy. India's demand for renewable energy is constantly increasing. Wind energy is one of the spaces that is going to get a massive benefit. Suzlon has about 30% market share in that space. So as the overall size of renewable energy and wind space grows, Suzlon will keep gaining its business. And once they're able to scale their business and work at 85-90% utilization, we think the company will be spitting out decent amounts of profits. You're getting the stock at about 58 rupees, which works out to, if I do a 2-year or 3-year future projection. So actually, I'm projecting quite far for this one. So if I do a 3-year future projection, I'm getting at about 18 times earnings based on the scale up of operations that we are expecting. I think the stock has the capability of moving up to about 100, 120 rupees. So in 3 years, if the stock can double from here, I look at it as a 25% CAGR return, 26%, which is fantastic. So and this is a company now which is debt free, and we think this is a great investment to make. Disclaimer: I have it, I hold it, and I will plan on adding more if it keeps coming off.
Okay, all right. So that's with regards to where Suzlon stands. And Venkat also has a query on Suzlon. Venkat, you bought at the levels of 74, but I hope that answers your query as well. We've got our next caller. Sanjay is calling us from Gujarat. Sanjay, hi, a very good morning to you. And if you are a Gujarati, kem cho?
Bas majama chhi aapni.
Bahut saras. What is your query about?
My query about Zinka Logistics, that is called Black Buck.
Right.
I recently bought on 17 July.
Okay.
400 shares I bought at the average price of 440 rupees.
Okay.
So what can I do? I stay for a long or get the profit?
Okay. Okay, Sanjay, I got your question, and congratulations, because you're sitting on profits of 77,000 rupees already. I'll take this up with Rajesh quickly. Rajesh, on the charts, do you think you should continue to hold Zinka Logistics or maybe book some partial profits now?
So we have not tracked this stock a lot, and overall the technical setup definitely looks positive, but many times this counter moves in circuits. I mean, it's advisable to at least book 50% of profit, and then if it extends towards 720, 750, that is a key retracement level. So there around those levels he should book full profit. So as of now, book partial profit, because this counter is not well known, and I mean on 720, 730 you should book full profits.
Got it. All right. Hopefully that answers your question, Sanjay. Gaurav Baheti has got the next question. He's writing in from Hyderabad in Telangana, and Godavari Power and Ispat is the name of the counter. He's bought at levels of 60 rupees per share, and he's wondering whether a target of 280 is possible. He's made quite the gains, and he's held despite the decline from the high point. Rajesh, on the technicals, what's the view?
So in last couple of weeks, we have seen strong traction in this counter, and overall volume activity as well as delivery volumes have been picked up. So yes, we continue to have a positive bias. Possibly the stock is headed towards 250 levels, which is its last December swing high. So as of now, hold on to it, expecting 250 as a target. And on the downside, I feel any dip towards 215, 220 is likely to act as a strong support.
Okay, all right. That's the view with regards to where Godavari Power stands. We've got our next question from Shrikant, who's writing us from Bengaluru, and asking if this is the right time to make an investment in a recently listed counter, that is Travel Food Services. He's saying especially because Q1 results were good. Samir, any view on this counter? It's a fairly recently listed company.
So I don't have active coverage, but we did track it for the IPO, right? So we studied it. So I can give you a thought process on the company, but I will not go out and say whether it's a buy or a sell. So the company is growing at a relatively decent pace, and the opportunity for them continues to grow because the number of airports that are increasing, where they can get access, where they can get their footprint in, and then grow their revenue and profitability. Plus, as number of passengers and all of those things keep increasing, I think the company will continue to do well. The biggest risk for them remains is if competition heats up in the space, and rentals move up, it could affect their profitability. That is one of the big worries that we had, and which is why we've chosen not to cover the company. But business-wise, it's a very good growing business at the moment.
All right. So make sure that you study the company before you take a decision, by the way, since Samir has not given you his view on whether to buy or not. Raghavendra is calling us from Bengaluru. Raghavendra, very good morning to you. How can we help you today?
Hi, good morning, Alex.
Good morning.
I hold SJVN stock, 1000 quantity. Buying price is 132.
All right.
Even I am tracking the quarterly result of SJVN. This quarter result is decent, and previous quarter was into loss. Is it good to average now, or hold or exit in loss?
Okay, and you're holding for the long term?
I already hold this stock from last 9 months. I am ready to hold another 6 months.
Understood. So then I will have to get you a technical view, because I'm pretty sure that on the fundamentals it's going to be a longer term view. So therefore, Rajesh, on the technicals, SJVN, what's the view? He's bought at elevated levels. Stock is sub 100. He's bought at over 130.
So overall, this week the prices have shown traction. In fact, after a very long time, prices are sustaining above its 200 DMA. And also, if you see on the indicators front, RSI is crossing above 60 zones. So from here onwards, at least for the short term, we expect a upside possibly towards 112 to 115 levels. So yes, having a positive bias. On the downside, if we see somewhere around 95 levels, a strong basis form. So 95 would be the stop loss, and on the higher side, 112 to 115 is what we are expecting in the coming weeks.
Okay, all right. So that's with regards to where SJVN stands. We've got our next caller. Rajesh is calling us from Hyderabad. Rajesh, hi, a very good morning to you. How can we help you today?
Yeah, good morning, ma'am. Actually, I want to know regarding which one I can invest in Sansera or Precall for long term.
All right, and this is from the capital goods space that you're talking about. Okay, I'll take this.
Triangular.
Yeah, okay, I'll take this up with Samir quickly. Samir, would you prefer investing in a Sansera Engineering right now or Precall?
So that one's a very easy one because I don't track Sansera, so I would have to say Precall. But if there are other sectors and counters that they are looking at, Precall may not be the best purchase at this point of time, given where the stock lies. But there are other companies I'm not in favor of the sector per se at the moment, given I feel the first consumption growth will be the driver. So I would rather position myself there. And if he's not bought anything, look at something from the consumption side where valuations haven't run up too much or they're not too expensive. I know it's difficult to find that, but there are companies with strong SSSG. But if I had to pick between these two, Precall is the one I'd take.
Okay, all right. So that's a view on Precall. We've got a question on Ather Energy, which on account of it being a new listing, I'm going to have to take back with you, Samir. Ashita from Hyderabad is writing in. She's bought 46. I think she's gotten allocation during the IPO. So she's got at levels of 321 and she's in the green right now. Does she add more, accumulate at this stage for a period of 1 year or more?
So definitely it's an accumulate for me, right? I believe the electric vehicles, especially the two-wheeler space where Ather caters to, is something that is going to see an explosion over the next 3 to 5 years, right? You're going to see huge growth, huge opportunity. And Ather is now almost, I think, the second largest player when it comes to sales from the August data, the news that came that they're now the second largest player in the electric space. So we believe the opportunity is great. But I'll just put in one caveat, because of these recent listings, there are certain stocks which are locked, which means the free float also that is there is not fully available for sale. And we feel that once all of these, locks come off the system, there will be some amount of selling that comes in. So post that, I would advise the person to go out and add. Yes, hold on to what you have because that allocation is great. But on any corrections closer to 350, 370, I would advise you to add. And I do believe that those levels will come for the simple reason that right now, all these new IPOs that come with, I'll just give a simple case of example of NSDL. Whoever's gotten allocation, they are the only people that are allowed to sell. So if I want to manipulate the stock, or not manipulate, but play the stock, I don't need too much. I just need to a lot of the people who got the allocation are not going to come to sell. So I just need to buy a little bit and run up the stock. And I think that's something that's happening even in a stock like Ather. I think once the shackles come off where everyone can start selling, you will see the price come off. Long term, it's a buy. Short term, wait a bit.
Okay, let's take the next question on Hyundai Motor. And this is a long-term question, but entry price is being sought. And The question is from Kumar, who's writing in from, I'm not very sure, but somewhere in India. The question is for you, Rajesh. What's the view on the charts for Hyundai? Is this a good opportunity to buy?
So overall, auto pack have done well in last couple of weeks, and even Hyundai has done well, moving from the levels of 2,000 to 2,600 in just couple of weeks. So the overall chart structure continues to look positive, but since it's in a overbought condition, I would suggest to wait for dips somewhere around 2,300. That would be an ideal level to buy.
All right, so that's with regards to where Hyundai Motor stands. And speaking of the auto space and sticking to that space, in fact, Prasad is calling us from Bengaluru. Prasad, hi, a very good morning to you. I believe you have a question on Jyoti CNC.
Yeah, ma'am, good morning.
Good morning.
As you can see, I have around 65 shares bought at a price of 1150.
Okay.
Then the stock has collapsed.
Right.
And yeah, I think it's safe to say that I have to forget the stock for some time. But I'd like to know if is it safe to add some more at current levels so that I can average out?
Okay. Prasad, got your
Or
question?
do I have to...
Sorry?
No. Should I average it out or should I just forget it?
Okay. So, and this is from a longer term perspective, I believe, Prasad, correct?
Yeah, that's right.
Okay. Got your question. I'll take this up with Samir then. Samir, what's your view on Jyoti CNC from a longer term perspective? Can you continue to hold or maybe average at the current levels?
So Jyoti CNC is actually an engineering company more than an auto ancillary company on that side. So, I mean, yeah, it's a good company, great business, growing well. Valuations ridiculously expensive, about 60, 65 times earnings. Even when sales grow and look, they don't have that great of an operating leverage and they do have new capacity coming on. So what will happen is in the initial stage, you'll see the depreciation increasing. You'll see the cost to set, the employee cost that you hire for until they scale that up, which can take another 6 months to a year. I think profitability is going to be under some pressure. Unfortunately, your viewer, the person who's asked the question, has bought at an extremely high level. I think he's going to have to bear some pain. If it comes closer to 700 levels, it could look interesting from a longer term perspective. At this point of time, I am not looking to buy. But given the fact that it's a great company, if the person wants to hold on, can. But I personally believe that we will see lower prices.
You will see lower prices, so bear that in mind. Okay, you can probably keep a stop loss and pay attention to it then. Let me very quickly come back to you, Samir, and let's run through a few more questions quickly in the last 7-8 minutes of the show. BSE is something we spoke about on the technicals, but Sridhar wants to know, is this a good time to buy considering that it's dropped in the recent past?
So no, honestly, I would not be buying BSE. 2 reasons. One, if I'm not saying it's going to happen, if the SEBI puts some sort of restrictions on short-term contracts, I'm not saying it's going to happen. That is detrimental to BSE because a huge chunk of the turnover and profitability comes from the short-term derivatives, right? So that is a negative. Second, valuations are already very high. Now, operating leverage in these companies work positively also and negatively also. So if the volumes drop, the profits will fall off the cliff. So for me, I would not be buying BSE. I think the risk reward is not in my favor. Although I don't believe that the short-term contracts are going to go, maybe they will introduce long-term contracts, leaps, which are called one-year contracts, which is something that happens globally. But given where the valuations stand, I find it difficult to say that upside potential in the short term is available.
Got it. Raj is calling us from New Delhi. Raj, very good morning to you. How can we help you today?
Good morning, Alex. Good to be back on the show again. All right, so I have a very weird question and I don't want you to beat me up because of it. I have about 50 lakh rupees that I want to invest only for 6 months.
Okay.
So is there just 1 or 2 stocks that I can invest in and just spin this out and get out fast?
Well,
I know it defies all rules. Please don't beat me up for it, man.
So if you have the gumption, if you understand the risk, see, ultimately the question is, if you are driving fast on a road that allows you to go 150 kilometers per hour, it is skill and to a certain extent luck. And so therefore, if you understand the risk of going at 150 kilometers per hour, then you do it. I take your question.
Which is why I ask advice from you also.
Okay. So since it is a short-term question and since it's for 6 months, would you be okay with getting a technical view instead of a fundamental view?
Anything at all that would help, my friend.
Okay. So Rajesh, I'll come to you therefore. It's a substantial amount of money and he's asked for 2 stocks. I don't know if you think that that is the right approach. Whatever it is, I think he would take the advice.
So I would like to give 2 counters which we feel that it's likely to perform well in next 6 months. That one is AB Capital. We are seeing breakout on multiple time frame, may it be weekly or monthly or daily. So multiple time frame breakout is witnessed on AB Capital. Possibly the stock is headed towards 330 to 340 levels, and on the downside we are seeing strong support somewhere around 270. So that is one counter. The second counter is from the auto space. Definitely auto space have come out from a long consolidation cycle, and we expect in the next 6 months auto will continue to perform. So one counter that we are liking is M&M. Already it has run in the last couple of weeks, but it has given a breakout from a 2 years consolidation, and possibly from the heavyweight this can be an outperformer, possibly headed towards 3800. So M&M and AB Capital are the 2 counters that we are betting in the next 6 months.
Samir, again, I think I might have caught something from your expression. You shook your head when he said AB Capital. Did I catch that right?
No, I didn't shake it for AB Capital. All I was saying, the head shake was from the fact that they're just this is basically chasing momentum.
Yes.
But in a 6-month time frame, I think that is probably the right strategy, and that is the only strategy, because you got to, you got to play the momentum and hope that the momentum continues for a longer period of time. But I would suggest, instead of him doing something as drastic as 2 stocks, spread it out a little bit further and keep trading in and out for 5, 6% moves, because in a situation like this, it's very difficult to say when Donald Trump makes a statement there and suddenly tomorrow here we are down 10%, that would be a very big negative.
All right. Okay, Samir. And that's a fair and candid view.
You've gotten both.
You've gotten both. Raj,
both.
I hope that helps you. We've got our next caller quickly. Sunil is calling us from Mysuru. Sunil, hi. Very good morning to you. I believe you have a question on HCC.
Hi, good morning. So I bought HCC at the rate of 39. Okay, with 2,000 shares.
Okay.
Now I am lost with around 23K. It's just a long term. I can wait for until 1 year.
Okay.
Next 1 year.
Okay, Sunil. I got your question. I'll take this up with Samir quickly. Samir, quickly, 30 seconds answer on HCC. What's the view like? Should he continue to hold for a year?
Yes, he can continue to hold. Orders are coming through. We think the opportunity is good. Stock is corrected nicely. You can average in some more, and then you will get a chance to probably get out at a better price.
Okay. Can I take one more question? No. Okay. Rapid fire. Okay. It's time for the rapid fire round. Samir and Rajesh. This is where we throw as many questions at you over the period of 2 minutes. Samir, first to you. Rajesh has got ITC at a price of... okay. Sorry?
Rajan.
Rajan has gotten a price at a lower level. He's waiting for the stock to go up, but he's calling it a slow-moving consumer good company. He's wondering whether to keep holding. What's the view?
If he has a 3-year view, hold on.
Okay, the next question is from, do we have the name of this person? Okay, from Mr. Rao, who is saying that he has 10 lakhs to invest for the next 3 years in insurance companies. Which one would you pick, Samir?
I'll go in for an ICICI General.
Okay. Veena from Hyderabad wants to know about Polyplex, border levels of 1328. Polyplex is the name of the counter. Would you hold or sell? Rajesh?
So overall exit, expecting more downside, possibly 950 is what we are seeing.
Okay, Bank of India is the next counter. Anupama is holding 1300 shares bought at 128 a piece. Should she continue to hold for a year? Samir, your view?
You can hold on.
Endurance Technology, Lucky from Ahmedabad wants to know whether it's the right time to buy on the fundamentals. Samir?
No, I would avoid this one.
Okay, Asian Paints is the next counter. Ashok Pai wants to enter into this counter at the current price for the next 2 years. Samir, is that advisable?
Absolutely. Please go ahead, buy. You might see some pain, but long term, this stock will do phenomenal.
Samir, REC PFC, hold, exit or add more at the current price? Gul wants to know.
Disclaimer, I'm buying. Please buy.
Okay, the next one is Kane's Tech. Tarun from Hyderabad has already bought 25 quantities. Wants to know if from 3 to 4 year perspective we can continue to hold. Samir, your view?
I don't have a view on this one.
Sterlite Technologies bought at levels of 297 4 years ago, holding for the long term. Can it be held? Akshay wants to know. Samir?
They're better companies than Sterlite Technologies. I think plus the space is going to get competitive, so I'll say sell out.
Okay, Soham wants to know about Yes Bank. Your view on the charts, Rajesh?
So we are expecting bounce back. Possibly 21 is what we are expecting, so can hold on to it.
Got it. All right. Well, that is the end of the rapid fire round. Thank you so much, gentlemen, as always, for taking the time, and happy Friday to you. Happy weekend as well. Hope we don't get any big headlines before the weekend is over. Well, that brings us to the end of this edition of Ask Profit. It's been an absolute pleasure bringing it to you from Mahima and myself and the team that put the show together. Thanks so much for watching. Up next is Know Your Company, and this is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
जब मुंबई से वापस कोल्हापुर शिफ्ट हुआ तो सबने कहा कि ड्रीम सिटी को छोड़ रहा है। ड्रीम सिटी, तो मैंने कहा ड्रीम में तो यही गलियां आती हैं। तो जब ये रियलाइज हुआ कि कुछ बड़ा करने के लिए बड़े शहर में रहने की जरूरत नहीं है, तब लगा कि लाइफ में ग्रो किया। कशी ताई, ऐसे बॉय मिलते मुंबई में? चांस ही नहीं।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Babish.
So good to have you in the manufacturing suit inside a clean room, not a boardroom.
To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell. Yeah.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Varsha Chandnani, and we're going to be talking about onto a hospital company today. It's obviously inflation-proof to a certain extent from a business standpoint. It's also to a large extent geopolitical and tariff-proof as well. So you've got all of those largely not likely to impact something like this, and hospital companies have come to the forefront in a large fashion. It's a sector which has done extremely well over the last 12 to 18 months. You've seen a huge valuation re-rating, and therefore you'd want to understand whether that growth can actually sustain or not. And therefore what we're going to start with is trying to understand what I want to know with regard to this one. It's a KIMS that we're going to talk to, and we're going to talk about KIMS hospitals. And what I want to know is the first thing is that they have launched a lot of new hospitals, and all of that is impacting the numbers negatively. Mind you, from a business perspective where hospitals is concerned, you launch a hospital and it doesn't give you the best numbers in year one. The launch is more where the first and the second year numbers will reflect some bit of softishness. Thereafter is when the ramp up will start with regard to numbers, both on margins as well as on top line. And therefore what I want to understand is this trend of a taper down with regard to profitability, and we will look at those numbers and you'll see what I'm talking about. Is that going to change going forward? When do we see a ramp up on profitability as well as on average revenue per operating bed? This is a very common metric used for the hospital business in particular. Average revenue per operating bed. It is only the top line number coming into the hospital's kitty for every operating bed. So non-operating bed is not included, right? And this is termed as RPOB. And RPOB for a KIMS is growing substantially because they are growing in the markets where there is better revenue versus the markets where there is lower revenue, which they have traditionally been in. The third lever is occupancy. We spoke about average revenue per operating bed. Occupancy is a measure of how many beds remain unoccupied. So all of those factors is what you consider when you're looking at hospitals. occupancy ramp up. And you will see that ramp up, as I did mention during the first metric. You see that ramp up in occupancy only from year 2, year 3 onwards. In year 1, you will see muted occupancy in most new hospitals, and therefore overall occupancy for the company as a whole has fallen. And are we likely to see a recovery there is my question. The fourth piece is with regard to margins and profitability. How will these two, therefore, given all of these metrics, how will these two metrics also move? And how do we see an increase there? The fifth piece is with regard to capex. They've been doing acquisitions as well. They fund that through debt to a larger extent, and therefore you've seen a ballooning of debt as capex has played out. They have revamped their strategy. They're trying to do asset light. They're trying to lease land rather than buy land, which is asset light. But nonetheless, how far are we with regard to the top of the cycle? And the sixth point, debt. Therefore, has it peaked? When will it peak? And at what amount? And the last piece is with regard to expansion beyond FY27. I'd want to know what the plans are, because till FY27 we have clear visibility on what they're doing. What about beyond that? So all of that is what we'll try to understand. Varsha, anything to add?
Yeah, no. So overall, the two major points that you've covered is, one is tariff proof. And because of that, a lot of analysts are also speaking about why they are bullish on hospital sector and even diagnostic sector. No Trump tariff, no jhanjat at all. The second thing is why hospitals are in focus is because of the capex that they've been doing, and especially brownfield capex. It's just an addition that you do to your building, or you just add floor or you just add beds, that's it. And because of that, your ROE or return ratios improve. And one of the reasons why investors or even analysts are bullish on hospitals because of the brownfield capex that these companies are doing.
Perfect. So I'll allow you to start with about this one in particular.
So starting with KIMS, that's Krishna Institute of Medical Sciences. So they are into hospitals, and mainly they target Telangana and AP, although they are also expanding into other areas as well. They provide multidisciplinary integrated healthcare services, that is nothing but hospitals. Now let me just focus on the operating metrics. Now let me start with bed capacity, which has increased from Q1 FY25 to Q1 FY26 at 5,499 beds. Occupancy, if you see, has been lower. So it has dragged down from 56.5% to 48.8%. Now, one of the reasons is because of the addition of the new units that the company has done, and one of the reasons why you're seeing that drag in occupancy. Also wanted to talk about operational beds, which has of course increased from 3,500 to 4,612. Now, talking about ARPOB, that is average revenue per occupied bed. If you see, we've seen a healthy growth. Now, this is on the back of, so from 38,500 to 43,000. Now, the growth that you're seeing is because of the improved case mix and of course payer mix, which has led to this growth. And also, they have also guided from ARPOB growth of 4 or 5% in mature units. And at the consolidated level, this 43,000 number would go to almost 53,000 as their Thane and Bangalore unit ramp up. Now, moving on, if you see, let's talk about their capex plans. So they've got huge capex plans. So almost 1,800 to 1,900 of beds, they're gonna add, which is so. For example, Bengaluru, if you see, the operation for this will be in Q2 FY26. So a lot of capex that they are doing. And one question that we might want to ask to management: when of all this capex will add to top line? When we are going to see that huge growth in top line, because a lot of capacity expansion that the company has been doing.
And bottom line as well.
And bottom line as well, and because that's under pressure right now.
Yes, with a lag. Yes, you're right.
So, overall, so this is overall the business model and the capex plan that the company has. And, I'll start with the income statement as well.
We can start looking at the metrics. And before we start, let's just quickly look at the metrics we'll cover. It's the regular, usual 8 metrics that we look at: income statement, balance sheet, cash flow, shareholding, return ratios, street cred, street coverage, and valuations. We look at all of those 8. Varsha, income statement.
Yeah, so starting with income statement, over here, if you see, the problem over here is net profit. Now, as Harsh was pointing out, this is because of addition of the new units, and because of that, if you see, your depreciation cost has increased. And your interest cost has increased, which has led to, this net profit pressure. So, revenue, if you see over here, it's 3-year CAGR is 23%, EBITDA 3-year CAGR is 15%, again, because of the addition of new units. And net profit impact that you're seeing is because of new units. Because of that, your depreciation cost has increased, interest cost has increased, which has led to pressure in net profit. Talking about let's talk about the Q1 FY26 performance also. Overall here, if you see, again, there's a problem, or I would say the margins. Margins have decreased. Over here, net profit has also decreased, though revenue has gone up 27%. If you see that their margin trajectory, from 32% to 22%. Now, this is all because of the new units that they have been adding, and this is the reason why you're seeing this pressure in EBITDA margins. And moving forward, we would see some increase in the margins going forward.
I just want to highlight, so your core mature markets, Telangana, etc., they do very good margins. They do 30% plus margins. So that's not where the problem is. The problem, or rather, you can't even call it a problem technically. It's part of the business, part of the growth of the business. As new hospitals get added, they are at lower margin, they are at single digit margin, and therefore your blended margin comes down, and that's why you're seeing the shrink with regard to margins. That trajectory is not something which is unreasonably bad, but the question will be, how quickly can it go back up? Really, that is the question we'd want to address.
Exactly, right. So yes, overall, just in a nutshell, because of the addition of new units, we are seeing, pressure in the income statement, especially when it comes to margins and net profit.
Perfect. Let's look at the balance sheet. And when you're looking at it, largely the ratio of debt to equity is obviously elevated. And that elevated ratio is because they've done a lot of capex. Varsha did put out that slide and presented it in About the Company as to how the capex is stacking up for the company, and a large part of this will peak in FY26 is what the management has said. I'd want to understand whether that is the case. How quickly does the pay down with regard to debt happen, and how can we move forward? What does FY27 and beyond look like from a balance sheet perspective? Because this is a large amount of debt which is sitting on the balance sheet. They've got a decent amount of cash as well. So in that sense, it's okay. You're largely seeing this to be a 30,000 crore company in market cap. And therefore, that 2,000 crore debt may not exactly bother me as much, but surely a 1:1, near 1:1 debt to equity is not something that is sustainable for very, very long. So you want to see it come off, if at all. So we'll wait and watch as to what the management says with regard to that. But cash flow, Harsha.
Yeah, so overall, cash flow, if you see, we would give here a thumbs up. In a hospital business, you don't have any receivables problems, you don't have inventory problems.
Clean.
Clean, exactly. Clean cash flow.
Great business to be in. You get the money before you get admitted. So there's absolutely no concern with regard
exactly.
to that.
So no concerns when it comes to receivables and inventory, and that's the reason you're seeing cash flow from operation is a big positive number. Despite company investing, because if you see cash flow from investing, that has been increasing year on year. So in FY22 it was 412 crore, which has increased to 416 crore, which then increased to 753 crore, and in FY25 it increased to almost 1000 crore. This I'm talking about the investing activity. So company, despite investing huge amount in new units, we are seeing this positive cash flow because of the sole reason, no receivables or very slight receivables and no inventory. So overall,
and CFO to PAT is above 100% because you've got that very large depreciation number which is sitting in the P&L.
Exactly.
So you've got this super large, and I'll quantify it for you, it's 200 crore, trailing 12 months depreciation number is close to 200 crore. This used to be at 70 crore in FY22. So you've got this very large bump up in the last 3 years with regard to that number, which is what is aiding the cash flow from operations to profit after tax. So that's something just to keep in mind.
So what was the pressure for, income statement is a boon to cash flow statement.
Correct. Now let's look at return ratios. The return ratios have traditionally been elevated. They've been around 29-30%, but they've come off sharply, and that's understandable because you've got huge capex that's coming and you've got profitability which is playing out with a lag. So that's why. But even at likely a bottom maybe this year, next year, of 15%, even at its very bottom, not looking too bad, and therefore we've given this one a thumbs up. Shareholding, Varsha.
Overall, when I talk about promoters shareholding, it's like 34%. Now, one of the reasons why we have given a neutral rating to it, because we want that skin in the game. But the good thing is, look at the FII's stake. Though it has decreased by 1%, but good stake of FII is at 15%. Even DII stake is at 31%. So just because of that promoter's stake at 34%, we've been giving this shareholding pattern as a neutral one. But FII's and DII's stake gives us a confidence when it comes to KIMS Hospitals.
Perfect. Now let me cover street cred as well as street coverage. Negative 1% last 1 month, but you look at the 6 month, year to date, 1 year, it's been a phenomenal run for investors. So very, very positive with regard to the way this has played out. And an investor would have sat on this over the last 1 year over any time period has done very well. So that's the positive. 5 years as well. In fact, it's not listed since 5 years, it's listed since 2021. Since then also, it's given a very, very good performance from a stock price perspective, and therefore we've given this a thumbs up. No concern from a shareholder perspective given the kind of returns it has given. But valuations, street coverage, let me try and cover that as well. 14 buy calls, 1 hold, 3 sell, 15% upside, and therefore a thumbs up on that as well. From here, another 15% is what analysts are penciling in. Clearly bullish on this one. Varsha, but valuations.
Yeah, so valuation, if you see at a P level in for FY26, it's at 68, and FY27, 47. Now, this kind of a premium kind of valuation that the company has been given. Now, one of the reasons is we may see a growth in ARPOB. The occupancies tend to increase. That's a positive point. ARPOB growth is a positive point, and the company is doing a lot of capex, which will turn into good growth when it comes to net profit. So because of all these positive points, the company is trading at a premium valuation. Because if you see for Max Healthcare, for FY26 it's trading at 67p, for FY27 at 53, right? So it's not like, it's very close to, the valuations are very close to Max Healthcare, because Max Healthcare is a giant when it comes to hospital, considering the good ARPOB that the company has, good occupancy. And one of the interesting thing in Max Healthcare is they are doing a lot of brownfield capex, which will enhance their margins, which will enhance their ratios. And so KIMS has been given that valuation to the level of Max. Even for Yatharth Hospital, if you see, is at 37p, FY27 26p. So overall, because of all these things, KIMS has been given a premium valuations.
Okay, so let's stack up all of our rating parameters and let's give KIMS its final rating. No thumbs down, so that's one thing that sticks out here, but that's how all of it stacks up. Valuations, of course, at 80 times trailing 12 months, but around 5.5 on 8 is what KIMS gets on its final rating with regard to where a KYC is concerned. So that's how it stacks up. Now let's quickly go across. We have Dr. Bhaskar Rao, who's Chairman Managing Director at KIMS Hospitals, joining us. So great having you. So let me start off with what changes in FY26, because you are likely guiding for an uptick with regard to margins. You feel margins have bottomed, and therefore I would assume that some of the less profitable hospitals are going to start to see a better churn. The newer ones, of course, and understandably so, are going to start to see better profitability. Give us that perspective. Where does it lie? Do we go back towards 25% quickly enough in FY26?
Yes, what's happening when the organization, especially it is an healthcare organization, when it is running and building a good brand image among the patients, what we do and attract is a lot of complex cases. When you get a lot of complex cases, whether they're tier 2 cities or tier 1 cities, the RPOPs will increase. That is one aspect. The second aspect is we have been started Thane, Bangalore units this quarter, and that will usually takes about 12 to 18 months in a healthcare industry. I am expecting at least 9 to 12 months we can able to see the positive bottom line. So that will also improve the margins and as well as the revenue and RPOPs also. You can able to push the RPOPs because both Bangalore and on Thane, they are the little high RPOPs, is almost like Telangana, even better than Telangana RPOPs. Whereas Andhra RPOPs are very, very low. Even in Andhra, we are also adding an additional beds in Srikakulam, Anantapur, Ongole, and Rajahmundry. These are also matured now. The occupancy is very high. When we are doing like that, then definitely those margins also will increase. So this year looks and the coming year also very, very positive outlook. I'm seeing I can believe I can do a better job than what we have been doing historically.
Hi, Mr. Rao. This is Varsha this side. Pleasure to have you at NDTV Profit. About RPOB, I'll just extend that. From 43,000, can we expect RPOB to go, 50,000 to 53,000? And if yes, by when are you targeting that number?
There is nothing like we target. Basically, as I mentioned before, if the complex cases comes and the high-end margins that are there in Thane and Bombay, 43, there is a chance it can go even to that level. But definitely year on year, there will be definitely a better prospects on the RPOPs are concerned.
So, but you've guided, if I'm not wrong, for an RPOB of 50 to 55,000. You've done 43 in Q1. How likely is it that you get there?
Fair chance. Very fair chance.
Okay, and what is it that gives you that bullish construct? Because the kind of bridge between 43 and 50, 55 is quite large. So what is going to change so dramatically over the next maybe 9 months that gives you that optimism that you will get there?
See, the reason is 900 beds what we are opening this year in Bangalore and Thane. And these are all the very, very high RPOPs than Telangana cluster. So that's where whatever margins that is going up, it will be able to show the Thane one is doing a good job. And then this quarter, maybe the third quarter of this year, the Bangalore units will start. It will take about 2 quarters, most probably, if not the end of this year, in the next financial year, about Q1, there should be a good jump of RPOPs.
Sir, so you're doing a lot of capex, and maybe this capex will go on for next 2 years. Just wanted to understand what is the peak revenue, that KIMS may see for next 2 to 3 years, because if I'm not wrong, you're adding almost 1,800 bed capacity in the next 2 to 3 years. So just wanted to have that ballpark number, if you could give us beyond FY27, how KIMS will look like.
So there will be definitely 25 to 30% revenue growth year on year in the next 3 to 4 years.
Okay, and also, sir, just wanted to, revenue is 25 to 30% CAGR that you're targeting. What about margins? Because we've seen some pressure in margins now, of course, because of the addition of new units. But any kind of target that you have set for yourself when it comes to margins, maybe, in next 2 to 3 years?
See, basically, whatever is the matured healthcare, when we are running it and understanding the operational efficiency, and when we set all these things, initially it will be down, and then once it is matured, and then we will be able to see what we are looking around 22, 23 margins. Financial year 22, we are expecting to reach that because there is no reason why it should go down. When we are matured enough, the margins will be more of operational efficiency, talent that is available, and the very, very reasonably we set up the capex. When these are all having been a 2.5 decades, we are in the field and we understand that what we are doing is, and when we are moving forward, the organization becomes bigger and bigger. There will be again an operational leverage of bringing down the cost of the expenditure. So the margins will be able to sustain what we have been achieved before.
It's a great conversation. So I want to understand where and when do you peak in terms of your capex, because, and this is from a perspective of debt. You've guided that your debt will peak in FY26. What will that debt number be? What is it that you're comfortable with in terms of your debt number? And where does your capex for the moment pipeline end? In what quarter does the cash flow going out from your business stop, so that I understand where the debt will peak at?
See, here there is two things which we need to be able to say rather than talking about the debt. If you look into the debt on the listed company is very, very low. Even hardly about 600, 700 crores is the debt when we are taking about the similar amount of EBITDA. Whereas we have a lot of subsidiaries, where the subsidiaries are putting on expansion, like in Bangalore is another subsidiary, and then we have Srikakulam, we have Anantapur, all these subsidiaries, Kurnool, where we are doing an expansion of bed capacity. There we borrowed the loan. That is the reason it is coming into the debt looks like very huge. If you look into the listed company, the less, even it is less than 1 is to less than EBITDA to debt will be hardly less than 1. Whereas because we added those units, because we have taken a long-term debt of 10, 15, 10, 12 years, that's why the debt is showing that, but it is not at all an alarming position of the debt. Listed company is the most important, which we need to look into the debt. It is less than 1:1 of the EBITDA. When it is less than 1:1, if the subsidiary is having any issues, we can able to support it. So we are very, very careful about how this listed company debt will be less than 1:1, whereas in the other things it will be around 3.5, but average blend will be around 2.5. We will be very, very cautious even on the whole. I want to keep the debt 1:2, EBITDA to debt. Maybe that once we come by 27, it comes down. From there, when we are able to put the capex, we will be very, very careful we should not cross more than 2 max.
Understood, sir.
Preferably to be less than 1.5.
Understood. Thank you so much, sir, for coming in and speaking with us. This has been very, very insightful, not just from a KIMS perspective, but also from understanding hospitals. Viewers, it's always great understanding a different sector and completely changes the way in which we look at the metrics as well. But anyway, that's all of our KYC metrics. It gives KIMS Hospitals a 6 out of 8 on our KYC ratings. Mind you, 30% growth for the next 3 years will mean that your top line goes from 3,000 crore to 6,500 crore in 3 years, with a margin closer to 30%, which will likely mean around 1,900 crore in terms of EBITDA, and currently trading at around 16 times EBITDA if we look at the next 3 years. But of course, 3 years is a long time. So you also want to be careful with regard to that. How far are you extrapolating it? But viewers, completely out of time. From Varsha, myself, everyone who puts the show together, thanks so much for watching.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
What is
Bulls take a breather on the Lal Street market. At day's low, Nifty meanwhile slips below 25,000. Sensex also sheds over 450 points, most sectors in the red. US slaps 15% tariffs on European Union's car and pharma exports. This is after Brussels and Washington inked a trade agreement last month. And Dream 11, Gamescraft, as well as other RMG firms likely to take Union of India to court over the blanket ban, companies filing writ petition with Karnataka High Court by next week. And a group of ministers favors two-slab structure for GST at 5 and 18% as centre proposes to scrap 12 and 28% slabs. Panel also recommends 40% tax on high-end cars as well as thin goods. Good afternoon. You're watching Markets at 12 with me, Shreyanshi Singh. First things first, let's take a look at the markets. Markets hovering close to that day's low at this point in time. So it does look like the Friday cheer, in fact, has managed to elude the market. So whether you look at Nifty or Sensex, similar picture coming in. As far as Nifty is concerned, you have Nifty below that 25,000 level. So that's important to note. And when you take a look at Sensex as well, that's the one that's shed about 400 odd points. So that's also the kind of picture that you're seeing for Sensex. But when you take a look at the sectoral picture, clearly, very clearly tilted in the favor of red. So you have Nifty, FMCG, metal, bank, finance, oil and gas, as well as rural and PSU bank sectors as well, leading some of your losses. When you take a look at some of the gainers as well from within the sectoral indices, you have media as well as pharma and defense that are holding on to at least a tinge of green at this point in time. So that's largely the kind of picture that you're seeing emerge. Markets sort of on the back foot at this point in time. When you take a look at the list of gainers from within the broader pack, you do have Godavari Power, Z Entertainment, some of those counters from within the broader markets, the entire pack that is holding on to a tinge of green, BEL, Sun Pharma, M&M, Eternal, Titan, as well as Trent, some of your gainers from within the Nifty 50 pack. On the flip side, when you take a look at the list of losers from within the Nifty 50 pack, you have Grasim Industries, Hero Motocorp, Asian Paints, as well as Ultratech Cement and ITC making it to that list of losers from within the Nifty 50 pack. But let's also move on. Let's get you a very important story, and this is one that we've been talking about for a while, ever since that announcement on the online gaming ban, in fact, was made, because just as the Parliament, in fact, passed that online gaming bill, India's biggest fantasy sports platform, Dream11, Zupi, as well as MPL are already ready to shut down their real money gaming business, and you do have the platforms that are likely to be taking Union of India to court. So these are very important developments. In fact, we have Agni Dev joining in with the latest. Agni, what are you picking up?
Right, so companies, real money gaming companies like Dream11 and Gamescraft, along with other major names in the league, are planning on approaching court over the blanket ban that the Union of India is imposing on these real money gaming firms. Now, remember, the companies have been shutting shop lately. Dream11 was the first one to do so. Yesterday, they shut their real money gaming wing, and even companies like MPL, Zupi, Probo, and Rummy Culture have said in one way or another, whether internally or to their customers, users directly, that they will be shutting their RMG businesses. Now, these companies are taking the government of India to court against the blanket ban, saying that this is too random, too abrupt to be implemented so suddenly, and these firms are deciding on whether to approach as separate individual companies or as a federation of real money gaming companies. Now, we have reached out to Gamescraft and we have reached out to Dream11, but sources tell us that there could be more companies who are part of the process, and that a writ petition can be filed in the Karnataka High Court over the next week. Now, these real money gaming companies have stopped taking on new deposits and have also started returning and allowing customers to take out deposits that they already hold in the bank. Now, remember, the bill still awaits presidential nod to become an act, but this is what the updates are as we are picking up. We have reached out to the companies. Do stay tuned for more updates.
Absolutely. Thank you so much, Agni, for joining us with that update there. We'll get back to you with those, some of those updates as and when the companies get back to us. But let's also take a look at another important story that is very important to note, because you do have influencer Avdut Sathe, who's likely under the radar of SEBI for unregistered advisory services. And in fact, that is the word coming in from sources to NDTV Profit. The illegal gains from the company's operations is likely to be in the range of 400 to 500 crore rupees. In fact, we have Charu, who's at one of the centers at this point in time. Here's a report.
A little over 20 kilometers away from the BKC office of Securities and Exchange Board of India lies Flying Colours Cooperative Housing Society in Mulund. And why is it important? It's important because this is where the corporate office of Avdut Sathe lies, the influencer who has been under the scrutiny of Securities and Exchange Board of India for giving unregistered trading advice. Now, this is a person who has been in the business for quite a while and has offices around the country, be it Bhubaneswar, Kochi, Kolkata, Mumbai and several other areas in the Sahyadri region. And he has a big network of teachers and traders who themselves are unregistered on the SEBI platform and are the people who used to be his own students. Now he is running this business in a way that there are several people on the premises constantly working in a very godman kind of a way, working on a very self-proclaimed God philosophy of trading, where they also have an energy wing where they focus on the resilience and the emotional stability of the traders and keeping them connected with their platform even if they face losses. Now, this is a case where SEBI is looking at impounding illegal gains of over 400 to 500 crore rupees, but the search operation is still going on and it remains to be seen as to what happens. We'll keep you updated.
Well, absolutely, Charu, and we'll trust you to get us all of those details as and when they they also get unraveled. But let's also move on, get you the word as far as cocoa prices are concerned, get your detailed analysis, in fact, because the dry weather in West Africa has in fact slashed cocoa production in Ivory Coast and Ghana, which supplies 60% of global cocoa. What does this really mean for the sector and specifically for Indian companies? Then Mahima is joining in with that analysis.
Right, so Shreyansi, as you rightly mentioned, dry weather in West Africa has raised concern over cocoa production, and that is why the price of cocoa might be elevated going forward. And cocoa forms a raw material for a lot of these FMCG companies that manufacture chocolates and chocolate-related products in India. Now, Ivory Coast processing has fallen over 31% in July to around 39,301 tons, and that is a concerning factor for sure. Overall, in terms of cocoa producers also, they cited that there's poor bean quality and low crop that has been observed in the middle belt, and that is also causing the overall issue. In terms of foreign chocolate makers, they are also cutting their full year guidance with respect to where top line is concerned, and that is also one of the reasons as to why the production is being hampered. Now, in terms of recent developments also in Ghana, there was a protest going on by a lot of farmers because the Ghana government announced a fixed producer price at $4,783, which was just a 4% rise from its last year's fixed price, and farmers were not happy with this, and they said that this will actually go ahead and promote illegal smuggling of cocoa around the Ivory Coast, and because of that more than 3 lakh farmers have protested against it, and they also expressed their outrage over insufficient compensation. Lastly, in terms of key effects on Indian companies, of course, this will have a ripple effect on companies that use cocoa to make their products. Input cost will go on a surge, and plus cocoa constitutes around 35 to 50% of raw material cost for chocolate production, and profit margins will compress on the back of this. Nestle already in Q1 had said that inflation is hitting their margins. Price hikes and shrinkflation will take place, and export competitiveness for India will erode on the back of this. Now, companies that use cocoa as their raw material, Nestle is one of the biggest consumers of cocoa, followed by Britannia. We have ITC, HUL and Lotus Chocolate Company, which use cocoa as their key raw materials. However, Nestle is battling this out in a smart way. What they're doing is they're basically they've unveiled a patented technology that uses 30% more of the cocoa fruit, and that is going to help them use more of that raw material, and rather than depending more on imports of cocoa. And they're still in the pilot space, but they are aiming to reduce the wastage from the cocoa extract overall. So this is the overall view of what's happening in the space and how it can impact some FMCG companies.
All right, and thank you so much, Mahima, for getting us that entire update as far as cocoa prices then are concerned. So there you go. That's the entire analysis for those prices. But let's move on. Let's get you the update as far as GE Shipping is concerned, because let's quickly take a look at their Q1 numbers as well, because the revenue in fact has declined, led by the fall in shipping revenue. And you do have the shipping revenue that has fallen by about 27% on a year-on-year basis. The EBITDA has also declined, led by the rise in other expenses. And there's also a higher depreciation and other expenses that has also led to a profit decline. So let's quickly get in a word from the management. In fact, we caught up with Shiv Kumar G, who's the CFO of GE Shipping. Let's listen in to a slice of that conversation.
Overall, if you have to look at the company, yes, there was a downtick in terms of profitability as well in terms of the first quarter. But taking the overall aspect into consideration and cues from the first quarter, what's the outlook looking like for FY26?
Hello, Hiral. Thank you for having me. Yes, we had a drop in profit in Q1 versus the first quarter of last year. Again, that was because the first quarter of last year was quite an exceptional quarter. In the tanker space, we were fresh into the disruption caused in the Red Sea by the Houthis attacking ships. And therefore, that ton-mile impact was still hitting the market. And that's why rates were unusually strong in the April-June quarter last year. That's now come off, and that's why we had a more normal kind of rate scenario. So that's what we've seen in this quarter. This, as I said, this is a more normal market, and that was the abnormal one last year. That's why we have this drop. If you see it as compared to the immediate preceding quarter, we were slightly better because rates were a little bit better than they were in the previous year, than they were in Jan-March.
So taking this number into consideration and the aspect that you mentioned that yes, now you're seeing normalization that has come in. So if you have to look at a normal rate of growth from here on, what will FY26 then look like? Because that's what the investors need to bake in as well with their expectations.
So growth in profitability can come from two things. One is, as your viewers would all know, rate changes, and second is capacity changes. In our case, capacity has actually come down a little bit in the last year. We've reduced the number of ships that we're operating. So that was one factor also in the Q1 results. While we have the balance sheet to do a lot of capex and a lot of capacity expansion, we are keeping away from that because the markets are hot and we are not really getting the kind of prices that we like for making investments. So for now, at least in the short term, it doesn't look like there'll be any significant capacity expansion. We do some replacements of old tonnage, but that's about it. So that's not a huge trigger. The more important factor really is the rates that ships earn. Now, this is very difficult to predict. As you know, more than 75% of our capacity operates on what is called the spot market. So it's subject to change on a day-to-day basis and therefore extremely difficult to forecast. And that's why we don't give any earnings guidance at all. The fundamentals seem to be lining up for a weaker market because growth has not been great. The growth in commodity movement, which is led by global macro. And you know probably better than me that global macro is not looking great either. So one should tend to see slightly lower commodity movement. But again, there are so many of these factors which affect rates, like changes in trade patterns, or suddenly if you see OPEC coming back into the market with a lot of barrels, then that could help improve tanker rates. So all of these things are really very difficult to forecast. We don't even try to predict those. We just prepare for whichever market may come. So if the market drops off significantly, we are in a position to buy ships. If the market stays strong, our capacity is, a majority of our capacity is open to the spot market and we will benefit from it.
Right. So my question is, how relevant does the Baltic Dry Index become relevant to a company like yours? And if so, what's the trend that you're seeing right now?
So the Baltic Dry Index has been fairly strong for the last couple of months at least. And it dry bulk constitutes about 30% of our overall capacity. Not a huge amount, 30, maybe 35% of our capacity. In fact, we just bought a bulk carrier, which will be delivered in the next couple of months. So profitability has been pretty good. It had a slump in the very early part of 2025. We're coming out of that. And therefore, it's come back to profitability at current market levels. But again, that's only about 30 to 35% of our capacity.
Okay, so but will the capacity addition, now that you've an addition of, I think, Kamsarmax dry bulk carrier, that is what is added if I'm not mistaken. How much will that impact your revenues as well from here on?
As I said, it's adding revenue days. Now, whether those days earn $8,000 or $20,000 is up to the market, really, because we don't have fixed contracts for it. It'll come in and we'll have to face the market on that ship.
Okay, understood. When you talk about own tonnage as well, that is down around 12% on a year-on-year basis. So where do you see it going in the coming quarters?
Again, it's a function of what happens with asset prices. If asset prices come off significantly to where we are happy to invest, we will go out and invest and commit capital. If they don't, then we will probably stay around these levels plus minus 10%. over a longer period of time, we have the ability to grow our fleet very, very significantly. But we will be cautious in doing that because we want to do it only when the price is right.
And taking into consideration the diversified fleet of tankers and dry bulk carriers that you have, what is the company's long-term strategy when it comes to fleet management? Because the plan needs to be with regards to where expansion goes, modernization, or even for that matter, diversification.
So our plan is to continue to have a diversified fleet like this, which are not going by the same cycle. So it helps us to sort of hedge and to have that they're not all pro-cyclical. It also helps us to do our capital allocation between ships which are at different points in the cycle. We will have this. When we are looking at doing capex, we generally look at which is relatively the cheapest. So for instance, we are buying a bulk carrier now because they are relatively cheaper than where tankers are in prices. And that's our approach to it.
Okay. And what's the outlook looking like when you talk about the North American exports, specifically for FY26, because the first quarter has seen a decline?
Yes. So we've had poor oil exports from North America. Some to with Mexican exports into North America, so into US. So US exported a little bit less. They also imported a little bit less oil. We think this is turning around now, and therefore you should see more barrels coming out of there. We're also seeing a lot more OPEC barrels, so that's an even more significant factor really for the tanker markets.
Got it. And with regards to the repricing of LPG ships go, how does actually that affect, your average daily earnings, just to understand?
So we didn't have any repricings recently, except for one. We had one repricing, which was a couple of months ago for a mid-sized gas carrier. It's been marginally lower than the previous contract.
Okay. And if you talk about the offshore business as well, what is the strategic role of Great Ship, which is the company's offshore business subsidiary? How does it contribute overall from a business perspective? And what are the plans for this segment?
Yeah, it contributes. It is a business which is now net debt free and will be making a lot more in free cash flows. They have fixed rate contracts, and we expect that will overall help to stabilize the group's profitability.
Okay, and in terms of freight rate movements, taking into consideration the way tariffs are coming up. We are talking about a 50% with US, lots brewing in the global markets, right? So what are the key risks that GE Shipping sees out of all of this? And what are the opportunities that you see that could actually erupt as well?
The problem with this is that it changes on a daily basis. It doesn't really affect commodity movement, which is our market. And therefore, we don't even try to think about what of these could happen. We'll face the market when it comes to it because we just don't have the ability to forecast.
Okay, and from a freight price perspective, any trends that you're picking up right now?
No, nothing really. Nothing really. The markets it's business as usual.
Okay, my last question to you is, what should an investor actually watch out for a GE Shipping in FY26? What would be those 3 top takeaways?
Yeah, so we hope to have some profitability continuing. We hope to get the opportunity to invest. The big trigger for us really is that we get the opportunity to invest because we haven't done capacity expansion for quite some time, and we would hope for that to come soon. There's no other real thing to watch out for.
All right, and there you go. That was the management of GE Shipping talking about everything from their Q1 results to shipping rates as well as what they expect for the sector going forward. But tell you what, speaking of sectors, what is Citi's investment blueprint looking like? Which are the sectors that they're bullish on? We caught up, in fact, with the team. Let's listen in to find out which sectors they're betting on and what are they really penciling in when it comes to the markets.
Our underlying theme has been good earnings visibility. okay, at reasonable valuations. So sectors like telecom, healthcare, those sectors still look pretty good to us.
Okay.
Okay, so if you look at like the overweights, we have like banks, which Kunal spoke about. We have cement as an overweight, which Rashi already covered. Then you have telecom, healthcare, and some of the travel related stocks. I think those are the three areas I would highlight. The setup looks pretty good. Okay, when you think about it, valuations, stock price underperformance, domestic flows are still quite resilient. Foreign or in the EM segment, foreign investors have an underweight which is close to the highest in 20 years on India. Okay, so I think the setup is good. You have some of these concerns going away. I think the market should do well.
All right, and that's the word coming in from Citi. As far as their sectoral allocation is concerned, that's their investment blueprint roadmap coming in for the sectors that they're bullish on. But let's move on. In fact, we're currently timed out on the show as we close this show as well. Here's an exclusive glimpse with Airbus and Boeing raising the stakes and aerospace giants like Collins Aerospace and Honeywell eyeing India's vast potential. In fact, Neeraj Shah sat down with Ravi Dharamshi as well as his team as they reveal how India's cutting-edge technology and skilled workforce are steering Bharat's aerospace industry to unprecedented heights.
This is like $20 to $30 billion annual opportunity for companies that are from the size of revenue size for probably 100, 200 crores to 1,000, 1,500 crores at best at this stage. So when these companies, they will become, we are talking about these becoming at least 10x in size in next 10 years and with high margins and long visibility. So whenever we look for an opportunity, what we look for is a large opportunity and a long runway. So both the things are present over here. One, the size of the opportunity, and second, visibility for 10, 15 years, which is not very easy in most other sectors.
Yeah, that's true. Okay, Arvind, this entire ecosystem, high growth, etc. Are there now to both of you, right? Are there successful case studies of Indian companies already which have made a breakthrough and are now very large, traditionally relative to the past, very large partners of this OEMs, which is Airbus, Boeing, or some of the others?
2021 is when a lot of the certification and onboarding of the Indian companies started taking place. Since then, there are companies in the listed universe. Azad Engineering is one example of it. They do turbine blades. GE is a large customer. In one of our private portfolio companies is Rungsons Aerospace. Again, they do tubes, ducts, fluid handling solutions, and thermal management systems, again embedded with GE, Honeywell, etc. On the ancillary side, of course, it's not directly linked to this, but there is Unimec Aerospace, for example. They provide tooling for the engine ecosystem for engine MRO side operations, again a listed company. So these are three that are relatively smaller. Then of course there are the large companies like Tata Aerospace, etc. They've been winning contracts with Boeing, with Airbus, both for military and civilian in recent times. So there have been several companies that have suddenly seen a rise in interest. That's one thing from the Indian perspective. And then if you look at outsourcing from a global perspective, which we were talking about, if we were to revisit that, we can see that till very recently for Pratt & Whitney, going out of Connecticut meant outsourcing. Okay. Now they're looking at India. For them, that's like Christopher Columbus going halfway across the world. And in such a short period of time. And Pratt has usually been one of the least, has been very cautious in terms of changes. Avant-garde in technology, cautious in changes. They've been doing this. GE and Collins have been far ahead. They're already in India. And they do have a lot of operations entrenched in India itself. So the whole ecosystem is waking up to India at this point of time.
Very interesting.
But to answer the second part of your question on whether they're significant partners to any one of these OEMs, they're not yet significant partners. We have to look at the scale up in this industry to understand that the kind of revenues that these companies make, they don't even cater to 1% or 2% of the ecosystem today. So over a period of time, as this market share increases from 1% or 2%, maybe 5% to maybe 10% is when we would be serious partners to any one of these OEMs. And I think the stage is set for that to happen over the next decade.
Size is not the advantage here, you reckon?
No. It's engineering talent and capability along with the mindset of the promoter that is an advantage that India has. Also, we are respectful of IP.
ultimately all IP in the aerospace ecosystem is owned by the OEMs.
Right.
And I consider the engine makers also to be OEMs, not tier ones. So with the IP relying with all of these, large companies, we feel that India has the right to win because we have and will continue to respect IP.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
माय बर्थडे गिफ्ट टू पापा, ये उनके पापा की पहली गाड़ी एक गराज में पड़ी थी दार्जिलिंग में, फिर 3 मैकेनिक, पेंटिंग, पॉलिशिंग, जब इसे फाइनली घर लाया ना, तब लगा लाइफ में ग्रो किया है। बुलाओ।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Babish.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell. Oh, wow. Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Hello and welcome to NDTV Profit. You're watching Profit Buzzers. I'm Hiral Datia. With me is Alex Matthew. A downer in terms of markets today, Alex. You are seeing profit booking that has started to creep in. The reasons for that, not really known, but I think it is going to be a truncated week next week as well. So I think the volumes will now start reducing slightly. So that is one aspect we need to consider. But clearly, 24,900 is what Nifty 50 has tested right now.
So very interesting, right, Hiral? And we were speaking about it at the start today. 6 days of gains for the benchmark, and okay, you can argue that a few of those sessions were just poking the nose above the water kind of situations.
And we did speak about the higher highs for 5-6 trading sessions yesterday as well, and that was an interesting data point that we pointed out.
Yeah, and so therefore, I would think that the long-term investor can take this with both hands if there is a level of consolidation that creeps in after a sustained up move for the Nifty 50. And look, we're not too far away from that 25,000 mark. Yes, we faced significant resistance. It took quite a while for the benchmark to break past that. And we've seen outperformance by the broader markets today, of course, is a down day across the board. But then I think you'll take that period of a little bit of a consolidation. Also on the global stage, Hiral, there's that Jackson Hole address by Jerome Powell, his last address. So maybe some caution coming in there as well.
Absolutely. There is some bit of cautiousness that is prevailing, but let's quickly look at Nifty 50, 0.6% lower. You have Bank Nifty as well, and then we'll look at the sectoral heat map to understand what are the gainers and you know, what is losing out. 0.8% lower in terms of Bank Nifty, so that's where the beating is. Media, which was the top losing sector for last 2 consecutive sessions, has actually risen today. 1.2% uptick on that one. Defense is seeing some buying interest yet again today. Pharma, healthcare is positive. You know, the read earlier was that pharma probably will be on a lackluster mode, taking into consideration the 15% tariff that US has imposed on the European Union, but it seems to be on the opposite direction. So that is something that we need to categorically understand as well. Apart from that, what's losing is the metal index is trading under pressure. Consumption is weak today. Private banks are also under pressure. Oil and gas taking a beating as well. So that's the sectoral heat map. But let's quickly look at the top gainers and losers on Nifty 50. The contributors also would do if we can have that screen. RIL, the top gaining stock today. M&M is another one which is seeing some good moves in trade. Maruti is up in trade. Sun Pharma is another one. Titan and Trent also gaining. Grasim is losing out today. As we speak. ITC is also losing out. HCL Tech also under pressure. So those are the movers and shakers, you know, in terms of the large cap space. But let's quickly look at broader markets as well, right?
There are a few interesting counters to pay attention to. So ABFRL, something's cooking there. You have had news items come through during the week. Let's pull up Aditya Birla Fashion and Retail. It's up about 7%. Vodafone Idea. There was that news item that talked about maybe another breather for the stock. The PMO looking at this very closely is seeing tremendous volumes. Take a look at that volume number, and it's actually 400 plus times the 30-day average. ABFRL also seeing significant volume. Another counter that's up and about on very significant volumes is Z Entertainment. It's up and about. It's one of the top gainers of the Nifty 500, up about 5% or so. A stock that caught my eye this morning, and it was building on gains, maybe to a certain extent has given up some of that. Lemon Tree Hotels, let's see where it's at right now. But it's had a few very good sessions. So 4 out of 5 sessions in the green. It was up as much as 4% at the start, but has dissipated somewhat. Pull up the weekly chart for Lemon Tree and you will see that the up move is quite considerable. The entire space, the hospitality space, something that is once again gained attention, as much as 13% up for the week as a whole. IDBI Bank seeing a little bit of profit taking. Of course, the stock is up and about in the recent past, 9% rally over the past few sessions, and now down about 1.3%, but off the low point of the day. Among the losers, you have JK Cement, Ramco Cement, not doing particularly well, losing about 3.5–4%. And you have Ola Electric that's finally seeing a little bit of profit taking after that red hot rally.
Yeah,
but off the low point, no, actually at the low point of the day.
And similar was the trend yesterday as well. I think it did see a lot of profit booking that did come in. And the major reason, apart from everything else, is that Ather has come in to take its position as number 2 in the electric vehicle segment as per the Vahan data. So a lot of fundamental dynamics that are coming to play as well. But it's going to be an interesting day of trade. But let's understand what the derivative and the F&O market is telling you today. Midday check is what we are looking at. Vansh is with us to tell us more. Vansh, what is the F&O snapshot looking like?
So clearly we are trading with a loss of about 0.5% on index, and clearly it's not being supported by open interest. Now open interest is down by just 0.5%. So clearly it's looking like a just a bounce, like a pullback in terms of index. Now if I talk about Bank Nifty, we can see Bank Nifty trading with about a loss of about almost 1%, and the open interest here is strong, so clearly indicating a short build up in terms of Bank Nifty. Now moving on, let's also look at the FII positions. Now the FIIs have recently already added long positions, so clearly a big relief for the markets. At least some long additions is what we are seeing from the FIS front. Now moving on, let's also look at the long-short ratio. Now the long-short ratio for FIS stands at about 0.12. So clearly 90% of the positions still stands in the favor of short positions in terms of FIS. Now moving on with this, now let's also look at the Nifty OI change data. Now if we look at in terms of Nifty, we can clearly see 25,000 mark acting as a strong resistance in terms of Nifty, and 24,900 mark acting as a strong support in terms of Nifty. Now clearly it's also important to note that 20 EMA of the Nifty lies at 24,836, which is also a key level to watch out for. Now if I talk about the open interest gainers and losers, let me start off with the open interest gainers. Now we can clearly see shorts building up for Axis Bank, Shree Cement, Torrent Power, Bajaj Finserv and SBI Life. So clearly short positions being built up for those particular counters. In terms of open interest losers front, we can see short positions being closed for IRDA, CD, SL and Kalyan Jewellers, and long positions being squared off for Varun Beverages and Havells. So this is what the overall picture is looking like for the markets right now.
Got it. Thanks, Vansh, for that update. All right, so that's a derivative picture for you. We are joined this afternoon by G. Chokalingam, who's founder and managing director of Economics Research. Mr. Chokalingam, as always, absolute pleasure speaking with you. I have a question to ask you. And we were speaking with Blue Star at the start today, earlier in the session, and they were indicating, we were speaking with the management, and they were saying that there is, of course, this tailwind that will come through on account of the GST cuts, but there's going to be a period of pain, especially if the implementation of these cuts don't take place immediately. So, and that's across the manufacturing spectrum. Would you agree? And also from that perspective, as an investor, should you be prepared for a weak Q2 and then a pickup in the rest of the year?
Yeah, certainly, September quarter is unseasonal for this kind of consumer durable companies because of the monsoon, which ends in September, and our quarterly results also end coincide with the September ending. So as you rightly pointed out, one can wait for Q2 results before plunging into the stock. Yes, GST cut, ultimate, the good monsoon leading to reversal of interest rate cycle, and therefore lower interest costs will prop up consumer durable demand in this country, and this could be one of the beneficiaries. So best time is to wait for Q2 results.
Wait for Q2 results, that's the word coming in. But let's also understand what's going to happen in terms of the large cap space. NSE will be having a meeting today, and this is to understand what could be the candidates, in fact, which could be the candidates that could come in on Nifty 50, the ones that will go out as well. Nuvama has put out a report on the back of which Puneet is getting us all the details. Puneet, big Nifty reject that is expected today. Who comes in, who goes out, and what's the impact that you're seeing?
Well, thank you for that. So definitely seeing two big exclusions as well as two big inclusions in the Nifty, and one of them is definitely going to be Hero, the much talked about additions. First, Indigo, and this was one which was expected to come in this particular reject. It has seen steady inflows when it entered the Nifty Next 50 as well, and over the last few years since it has been in that index, that's going to be one of the most pivotal ones to come into the Nifty, being the only profitable airline currently in the listed space. So watch out for this one. The other one's another stock that's been expensive on the valuations, but definitely one of the most fundamentally sound hospital chains. Max Health is going to be the other one. On the losing side though, Hero, while it has seen a steady run up over the last 6 to 8 weeks basis on what's happened in the GST rate cut, and could be one of the biggest beneficiaries of that aspect as well, we are going to see exclusion of Hero, as well as something like an IndusInd Bank, which has had its issues amongst others. When you look at the stocks, of course, we're seeing and expecting an inflow of about $500 to $507 million for something like an Indigo. Max Health is going to see over 400 million of inflows, while we've also seen, the likely exclusion of something like an IndusInd and 240 million outflow on this one, along with a similar number for Hero MotoCorp as well. The other one, which is Nifty Next 50, and here is where it gets interesting, because we see a lot of inflows for this index. It generally gets a lot of the mid caps which have done really well in this aspect, and hence the valuation multiple for the Nifty Next 50 is generally much higher than the Nifty as well. So if we can go on to the previous list, solar industries was definitely one of them that I wanted to mention from that list. Mankind, Siemens Energy, Hindustan Zinc, as well as Union Bank. While Union Bank was also expected to come into this list as well. The other ones, Hindustan Zinc was the other one. It did miss, previous inclusion despite meeting key criteria, and that now stands having a stronger chance subject to the parent index that we spoke about as well. Likely exclusion from the Nifty, of course, Indigo is going to be one of them, but Dabur has been underperforming the index for a while now, and hence we're going to see that exclusion happening for the Nifty Next 50. And finally, the timelines. July 31st is the cutoff date. Official announcement is expected in the second half of August, and the effective date is expected on 29 September of 2025.
Got it. All right. So you have a list. Thanks so much, Puneet, for that. You have a list of stocks that are making way and entering. But having said that, it's always interesting to look from an academic perspective and also the short-term impact of flows. But data in the past has suggested that just because there is an inclusion doesn't mean very much for the stock. Ultimately, fundamentals take charge.
Absolutely, because you have an example of a Hinzing itself, right?
Yes.
Which Puneet did mention that actually previously missed the inclusion despite meeting the criteria, though the chances are high taking into consideration it's made an entry in the F&O market. Mr. Chokalingam, your quick views, specifically with the ones which are the likely inclusions. Would you say this could be an opportunity to buy them? And secondly, if you have to look at the potential exclusion, Hero Motor, that stock is trading under pressure today, probably on the back of this news. How would you look at it?
Yeah, very interesting question. Based on my experience for more than 25 years, I would say that exclusion, inclusion, they don't guarantee the success or failure. The history, if you look back, there are cases where the stocks excluded from a broad index, they have done very phenomenally well. Sometimes the stocks included also failed. So ultimately what matters is the valuation. Yes, for traders and short-term traders and speculators, it may mean something for a possible short-term gain, but definitely in the medium to long term, the valuation only becomes very important. So among the stocks which your colleague has mentioned, yes, Indigo deserves to be included in Nifty because it's something very unique industry which is not fairly represented in the broad index, and it's also leader, dominant market share, and long-term prospect looks too good. Of course, the stock has gone up recently. We have closed the call also, but it's a good stock for passive investors. And also, I would not, become negative on Hero Motor Corp. That's because it is excluded. I would rather consider Hero Motor Corp because I found that it's very attractive in terms of valuation. In next 50, the two stocks which are worth mentioning, one is Mankind Pharma and the other one is Siemens Energy. These two also look good to me for medium to long term.
All right, so a fair sense of what you should pay attention to. Of course, if we have the time, we'll go back to Mr. Chokalingam on what he finds attractive in this current market. But for now, let's turn attention to our systems. And it seems D Street is enthused by the acquisition or proposed acquisition of Novigo by this company. Let's bring in Jasmeet to tell you about what this means, what the strategy is, what the details of the deal are. Jasmeet?
Well, right, yes, thank you for that. The stock is buzzing. It's up 11% on the back of acquisition. Let's quickly understand how will this acquisition benefit the company and what exactly is Novigo. Well, Novigo is an IT-based Mangalore company which operates in product as well as AI-based engineering. Well, this will be an add-on benefit for our systems. If you look at our systems as a company, it generally operates in AI-based and product engineering domain. When you look at the revenue of Novigo revenue for the last financial year stands at 264 odd crores, which will be a benefit for the company. On the other hand, the margins are at solid 25%. Now, while the company is paying 400 odd crores for the acquisition, which is nearly 6 times of the adjusted EBITDA. Now, quickly, just to understand how will this benefit our systems, in particular to expansion. While Novigo has been growing at a compounded rate of 44%, while given our systems is growing at nearly 14% of compounded rate over the last 3 years, while this will be a benefit extremely adding on to the growth of the company. When we look at the other capabilities, this will be an assertive EPS starting from the year 1. When you compare the key financials, the revenue of our system stands at 1700 odd crores for the last financial year, while with this acquisition, the revenue is supposed to shot up by 14% and stand at 2000 odd crore. Apart from this, the capabilities would also add on to the niche software and AI-based system for our system, which will help them to expand geographically. And currently, our systems doesn't really cater to Middle East, while this acquisition will help them to cater to the Middle East region as well as the South Indian region of the company. When you look at apart from that, the combined compounded growth of the company is supposed to touch 17% versus that of 14% currently for our systems. This is the reason the stock is buzzing in trade today.
Got it. And thanks so much for laying that out for us. Our systems, 5,500 crore market capitalization as things stand, gotten quite a bit of a pop in trade today as well. It's in the larger scheme of things, one might argue, Mr. Chokalingam, that it's not terribly expensive at, what, 29 times trailing at this juncture, a price to earnings. Do you track the company? And if so, what is the view?
I've tracked it in the past, not intensively now, but I just now looked at fundamentals. Around 28 P, fairly priced. And unlike other technology companies, the OPM is also, operating margin also quite low at around 15-16%. So I think if it rises further, I would give a sell call on the stock based on my valuation.
So that's with our systems. Interesting moves last 6 months as well. 33% is the kind of upside that the stock has seen. How much it will sustain is what we need to see from here on.
Right? Is it on valuations? It's a sell.
So, I mean, viewers take both the ideas into consideration, acquisition and valuations. But let's look at other three counters which are buzzing in trade today on the back of order wins as well. Apollo Microsystems, PTC, as well as Atex Macquarie. Anushi is here to tell us what's happening with all the three counters up in that range of 2 to 15%. Anushi, over to you.
Well, thanks for that, Hiral. So, as we were just speaking about it, a lot of these defense and the rail companies are in focus on the back of these order wins that we are looking at. I'll start off with something like an Apollo Microsystems first. Now, if we just look at the stock performance of this one counter, it's been up over 24% in the past month itself. Even in this year to date, they've clocked in strong gains around 97%. That's the kind of return upside that the investors have seen. In the recent update, though, they did receive a 25 crore of an order win, wherein they emerged as the lowest bidder, and this pertains to orders coming from both the DRDOs as well as the defense PSU companies. Do note that the management expects about 45% of a revenue CAGR for FY26 to 27. So interesting in terms of order inflows coming in for the company. Margin expansion also on cards, and this is post H2 is what the expectation is. Now PTC Industries, what we are looking at is a 110 crore order, and this is from BrahMos Aerospace that we are looking at. And this pertains to supply of these titanium castings that we are looking at. So crucial raw material in terms of place over here, order execution being around 2 years for this particular counter. So this one also in focus. Again, the order was already was somewhat in works. Yesterday also it was declared during the market hours, but it was in the post-market hours that we saw the final order value coming into the picture. So that's PTC Industries for you. And last one, if you're talking about Texmaco Rail, now here the company has been awarded 103 crore of an order, and this is by Leap Grain Rail Logistics that we are looking at. This is to supply certain types of wagons and a brake van as well is what we are seeing. Order delivery for this being around 10 months. So these are a couple of counters buzzing on the back of order wins, as you just specified earlier.
So interesting order wins, Mr. Chokalingam. Anything that fits your bill, because defense as a sector is again seeing buying. And we were just talking to Nilesh Shah of Envision yesterday as well, where he categorically said that defense is a long-term play. It should be a buy on dip strategy right now, but valuations, which Alex and I were arguing yesterday, was that are extremely expensive if you have to look at historical as well as if you have to look at forward. So how would you advise someone to look at the defense plays as well and any of the other names that we mentioned right now?
Yeah, first on defense, I agree with you. The valuations are exorbitant, So particularly when major countries have a nuclear bomb, the traditional, I'm not saying there won't be any demand, but you can't grow in a very big way, non-nuclear arms in a very big way. And of course, even leaving it, ignoring that fact, that logic, the valuation, as you said, are extremely stretched. My only fear is that if you see last 2-3 decades, these kind of themes always play out and then they fizzle out in a very big way and people then wait for another 3 to 5 years. So therefore, I would wait for valuation comfort to emerge. Among the stocks you have mentioned, Apollo Micro, I have recently studied and I given my view to clients also. Valuation is almost in triple digit PE, and there is a pledging of shares by the promoter. And also, if you look at the shareholding pattern, slight decrease in the promoter holding and infusion, particularly the mutual funds do not have dominant shares holding in this company. So all these do not give me comfort in Apollo Microsystem. And Texmaco Rail, yes, one can hold it or even buy for a medium to long term, because I believe that in the next budget, the allocation to railway should see sharp rise, unlike last budget. So that should be beneficial to this company.
Important. In fact, we were just discussing it in the morning. Is this a sign that some orders will come through for these rail companies? Not yet, but it seems like maybe, just maybe, some of those orders are coming through. Of course, one of these rail companies actually gotten an order from Garden Reach Shipbuilders to build shipping vessels. So it's a completely different place that they're playing in. Let's bring in Vansh, though, to talk about a few more newsmakers, stocks that are reacting. Of course, we've discussed quite a few already. But Vansh, what's on your list?
So first one on my list would be IQ Technologies. Now the company has appointed Mr. Sajid Singh as the group CEO. Now it's important to note that Sajid Singh earlier was the CFO of IQ Technologies. Now has been promoted as the group CEO for this particular company. If I talk about the details, the company is a manufacturer and solution provider of LED lights and switches. And if I talk about the Q1 FY26 of the company, there has been a muted revenue growth and there was a EBITDA decline. This was on the back of the higher other and employee expenses. And there was a PAT decline due to higher depreciation costs for this particular counter. If I talk about the financials, what really stood out was the profit. The net profit was down 83% at 2 crores versus 12 crores. And also if I talk about the other highlights for this particular counter, they have guided that they will reduce their dependence on the single customer ODM home lighting, and this will also enable them to expand their customer base for lighting by onboarding their Indian and international customers. They have also forayed into high-end lighting segments. So this is what is something interesting for this particular company. And second on my list is Usha Martin. Now the company has sold around 10 acres of land in Tamil Nadu for about 29 odd crores. And also if I talk about the Q1 FY26 for this particular counter, the revenue growth was largely led by the wire segment, and the revenue growth from the core wire rope segment largely remained stable, and the volume growth was also up by 10% on a year-on-year basis. And the LRPC segment, now this is the lower relaxation pre-stressed concrete segment that has led to the headwinds for this particular Q1 FY26. If I talk about the numbers, what really stood out was the margins that were at 16.3% versus 18.6%. So clearly a cut that is coming in the margins for this particular counter. If I talk about the financials, the 3-year revenue CAGR stands at 5% and the 3-year PAT CAGR stands at 7%. But in terms of stock performance, the stock has rallied 11% in the past 1 year. So clearly the financials need to catch up for this particular stock performance. And also in terms of guidance for this counter, the company is expecting a stronger growth from H2 of FY26, and then this will be followed by transformation initiatives and capacity expansion. So clearly these are some of the stocks that are on my radar.
Thanks so much, Vansh, for getting us those details. Now, Yatra is something that we've been speaking about quite a bit, and we are going to be getting a deep dive for you very shortly on that. But before we do, let me go to you, Mr. Chokalingam. I don't want you to comment on these news makers. I want you to tell me at this juncture, given all of the uncertainty globally and everything that you know domestically, what on a very strong basis are you going out and telling your clients to buy? What do you have conviction on?
Certainly. We have been telling our clients, who have been writing ever since Mr. Trump has become aggressive against India in terms of tariff war, focus on domestic demand-driven stocks. So that is the safest thing to do. And also, second, 40 to 50% of equity allocation should be for Sensex and Nifty stocks. So by any chance, Mr. Trump becomes more aggressive, it starts disrupting even our service exports, then there can be a problem. In such a scenario, a possible scenario, the Sensex and Nifty stock would be very safe. They would become defensive because our domestic institutions have now emerged a strong, predominant institutional investor as compared to FPI, and they would largely provide support to Sensex and Nifty stock. So these are the two equity research strategies we have been suggesting. And there are many domestic demand-driven stocks like housing loan or hotels. There are a lot more. So that is what we have been strongly recommending. And again, third, look back September 2024, even now there are many stocks which are in favor. They have lost 30-40% now. So don't lose valuation comfort zone. And if you are paying 50 PE, see that the profit grows at least by 25%. That is what simple common sense approach we have been advocating to our research clients.
Hotel companies is what you're advocating as well right now. That GVK is what you're looking at. But something that relates to all of these hotel companies with regards to all your bookings as well, and when you have to travel, is a Yatra. And that stock has been on everyone's radar. If you pull up a Yatra, 75% up move in the last 1 month, and that is really very strong. 65% in the last 2 weeks is what you're looking at. Today, yes, seeing some bit of profit booking, but let's understand from Mahima, is there any steam left, Mahima, with regards to Yatra, number one? Or if there is steam left, what are the factors that are really leading to this kind of a rally?
Right, so lots happening with the counter for sure, and the kind of rally it has seen, it is justified as well, because the company is actually shifting its entire model, and we'll take a look at that further. But in terms of where the stock performance stand, as Hiral rightly mentioned, 65% in the last 2 weeks and 75% over 1 month, and also the technicals are also looking strong, because the 14-day RSI is above 85 breaks, and this is the highest level seen since Jan 24. So technicals and fundamentals both supporting the counter, and that's why we are seeing this kind of rally in the counter. Now, in terms of what's working with the stock, of course, a lot of things working in the favor of the company. Revenues have seen a good growth in Q1. It saw growth of around 108%, and this growth has been consistent except for March year ending 2024. Otherwise, 92% in 23, 87% in 25 as well. Now, what's the reason as to why this revenue has seen a good growth? Let's try to pull that up. The reasons are the company is actually shifting from its consumer business focus to a corporate business, and that's probably helping aid the top line. Of course, it's the 4th consecutive quarter where earnings have beaten estimates, and that's also one of the reasons as to why the stock rallied since its Q1 numbers. Last 5 quarters, the company has moved to consumer business. It has moved away from consumer business, trying to focus on the corporate business, and the shift to corporate business is helping a top line. Now, in terms of percentage as to where this works, it's cut down its consumer business from 55% to 35%, and corporate business has increased from 45% to almost 65% plus in terms of where gross booking stands. Overall, in terms of the other factors that are working in favor of the company, if you can try to pull up the margin picture as well, because that's also doing well, and even in terms of path to profitability is doing well. But before that, operational metrics are improving. Gross bookings growth has turned positive after 4th quarter this quarter, and that's a positive in terms of where operational metrics stands. Gross take rates on the group level are stable anywhere between 8.5 to 8.7% mark, and this has been consistent in the past few quarters. Discounts and A&P spends as a percentage of gross booking is also lowest this time in the past 6 quarters, and probably the best thing, one of the best operational metrics in this quarter. Now, in terms of where path to profitability stands, let's try to pull that up and see what has happened over the course of past few quarters. Well, company's profitability has been improving. It came at around 23 crores in Q1 FY26, which was actually a negative 1 crore in March 2024. So, company is improving in terms of profitability as well. Again, the reason here is because the corporate business as compared to a consumer business, though less in volumes, is better when it comes to the overall bottom line as well. Margins are also improving. Let's try to pull that up, because the margin trajectory has also been good. In terms of the overall margins, they have been improving in the past few quarters, and that you can see on the chart. Q1 FY26 they did 11% versus that of a 3% in March 24, 6% in March 25, and that's the overall view as to what's happened with margins. Let's try to pull up the reasons as to what's aiding this margin and the overall business. Again, as I mentioned, the corporate business going up is something that's leading the overall overall uptick in margins, and even in terms of consumer business, it has lower LTV plus there is lower margin. So that's the shift is actually aiding the margins overall. Lastly, in terms of the gross borrowings have also come down for the company, a reduction to almost 2 crores from where it stood at around 24 crores in 23 and 11 crores in 24. So overall, their long-term borrowings are also coming down, but cash flow from operations is overhang still on the company, because cash flow from operations is still a negative number when it comes to Yatra Online, because that is around an overall around 89 odd crores negative number when it comes to operating from cash flow. But lastly, in terms of where ROCE stands, ROCE is also a negative factor because that's on a declining trend from 14% to 4% in March 24 to around 5% in March 25. So that is a concerning factor. Lastly, where valuation stands, of course, it's not a cheap stock per se. Trading 12-month trading at around 45 times, but analysts suggest that this compared to a Ixigo, which is trading significantly higher at 118 times, valuations are actually playing a catch-up here. Lastly, for FIs, they are moving out of the counter from a 9.3% stake in September 23. They have been moving out, and this is where the valuation picture stands. So this is the overall view as to what's happening with something like a Yatra on it and why it's been flying in trade.
Got it. All right. Thanks so much, Mahima, for getting us those details. It's time for a very quick break. We'll be back on the other side to take more stocks, so do stay tuned.
जब मुंबई से वापस कोल्हापुर शिफ्ट हुआ तो सबने कहा कि ड्रीम सिटी को छोड़ रहा है। ड्रीम सिटी, तो मैंने कहा ड्रीम में तो यही गलियां आती हैं। तो जब ये रियलाइज़ हुआ कि कुछ बड़ा करने के लिए बड़े शहर में रहने की ज़रूरत नहीं है, तब लगा कि लाइफ में ग्रो किया। कशी ताई, ऐसे बॉय मिलते मुंबई में? चांस ही नहीं।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from England. Welcome back. You're watching Profit Buzzers here at NDTV Profit. I'm Mahima Vachhajani. Let's take a quick look as to how the markets are doing. The Nifty 50 almost at its day's low point, trading around 0.7% lower. The Bank Nifty also trading at its day's low point, down by about 0.8 odd percent. Overall, if you see the broader markets as well, the mid-cap 150 largely flat, down by about 0.08%. The small-cap 250, however, slightly in the green but marginally flat, 0.03% is where it is trading at. Let's try to pull up the Nifty 50 heat map and see what counters are actually the reason as to why the Nifty is seeing this kind of downtick. Grasim is one of the counters that's in the red, down 2%, followed by Asian Paints also down by about 2%. A lot of consumption names and IT names not doing very well. So all of these counters that you see on your screens right now are not doing pretty well in trade today. There's Adani Enterprises, Hyundai Motor, ITC, all counters down by about 1.8 odd percent. But that's with regards to where the market stands. But shifting focus to the auto space. Now hit brakes on your next car purchase till the next GST reforms come into place. How much will the next GST reform make your car cheaper? Let's go across to Puneet for a breakdown of how much you can save if we get this GST cut.
Well, thank you for that. So it's definitely, one of the key aspects and, of a GST potential cut on electronic consumer durables as well as your next car. Now, we are seeing currently that it's priced at 28%. We've just taken out some key models that are very popular in the Indian market and looking at the comparison with the potential new GST rate cut. Now, the group of ministers have already approved this on 21st of August, and now this goes to the GST Council, which is potentially held in the second half of the month of September. So you might not have to wait too long. But if you're pressing, the payment button right now, you might just want to look at this as well. WagonR as well as Baleno, two of the most popular cars from Maruti in the small car segment, they will move from 29 to 18%. We also have some other models in the bracket as well, like Desire, which will also go to 18%. And the SUVs currently have a GST rate of between 30 to 45%. So something like a Bolero new, since it is sub 4 meters, it does come with a 31% rate. That could also potentially move to 18%. And while the SUVs are at 45%, we could see a 5% reduction. And this is meaningful, as we'll see in what happens finally with your EMIs as well. Something like, the XUV 700 is the other one. It is currently attracting a GST as well as a cess of over 48%. This will go to 40% and will have one of the highest reductions in terms of price points given the new GST rate structure as well. Now, when you look at the old as well as the new on-road price for these cars as well, WagonR currently comes at 7.4 lakhs. We could see the price fall by almost 63,000 rupees because of the GST rate cuts and will now be available potentially at 6.8 lakhs. Similar to Baleno, the new price will be 8.1 lakhs and we will see a reduction of almost 75,000 rupees, which is more than 10% of the car's cost because of this GST rate cut if it happens. The other models, Desire is the one, it's a popular one. It's a new launch which happened last year in May. We've seen the price will fall sub 9 lakh rupees for this one, and we'll see a fall of almost 80,000 rupees on the Desire model as well. Something like a Bolero new, it's a very popular rural SUV, will fall to 12.5 lakhs, and we'll see the maximum reduction of 1.3 lakh rupees if this GST rate comes. Brezza is the other one. We've seen, the key integration for this one. From 11.5 lakhs, this will actually move to 11.1 lakhs. So it shouldn't be 15 lakhs, it should be 11.1 lakh on this model. You will see a 55,000 rupees saving. The Creta SUV is the other one where we'll see the prices actually fall for this one as well. From 16.1 lakhs, this will actually fall less than 16 lakhs for this one as well. When you look at the other ones, something like the XUV 700 will see a reduction of almost 1,17,000 to 20.6 lakh as the new price based on this GST cut as well. And finally, how much will you actually have to shell out in terms of your EMIs for all these vehicles? We've seen that currently, this is of course based on a report by Nomura. We see that on a 10-year basis with a certain percentage of 9 to 10%, which is a general auto loan percentage, we do see that roughly about 12,281 is what you pay as your current EMI. This will fall by almost 1,000 rupees per month to 11,234, and it has a cascading effect because this money is now available per month for you to have additional spending on other items, and hence it will help with the GDP growth as well. Something like a Baleno will fall to 13,300 or 1,200 rupee deduction in your monthly EMI. When you look at the other models as well as the SUVs as well, Desire will fall to 14,100 or 1,300 rupee deduction. The Bolero New will go from 22,800 to just 20,500, and we're going to see almost a 2,200 rupee reduction in your monthly EMI. Something like a Brezza from Maruti will go to 18,300, while something like a Creta, which will go from 45 to 40% in terms of GST rate, will now have a monthly EMI of 25,500 with almost 1,000 rupee reduction. So you get 1,000 rupees additional savings by just this GST rate cut as well. The highest one will be seen in XUV 700. It is currently at 48% in terms of GST and will fall to 33,868. So that's one of the key aspects that we've looked at for your new and your next car purchase. You might want to just put in a few more weeks of additional hold, and in case you've already bought it very recently, it's time to ring that caller to your dealer and probably ask for that some more discount or accessories if you can, because this one is going to be a big one.
Absolutely. Thank you so much, Puneet, for putting that into perspective. And I'm sure this is going to help a lot of viewers watching this entire link. Thank you so much for that. Mr. Chokalingam, and in fact, we're also joined by Akshay P. Bhagwat, who's the Senior VP at JM Financial, joining us on the show now. A very good afternoon to you, Akshay. Mr. Chokalingam, I'll come to you first on this one. We've been talking about how this entire new GST reform is going to help the auto space as a whole, and this brings a whole new perspective as to how this will help buyers as well. Your view on this entire thing that's happening, and especially with regards to the auto space?
Yeah, certainly, we can expect concession to auto sector. There is no doubt. But the magnitude of the concession, I think we need to wait. We need to see how much actual cut would happen. But definitely it will be there. And second point, I would go with the player like a M&M, because even in the tough time, it has done phenomenally well over the peers. So when the industry gets a tailwind, I still believe M&M would do much better. And also, tractor segment is there. As compared to many big players, this is the only one has tractor along with the automobile segments, and there also we are expecting a GST cut. So therefore, M&M would be a biggest beneficiary, I believe. And third, ultimately, it should prop up single-digit growth, which is seen by automobile sector, to decent at least high single-digit or even probably the double-digit growth in the automobile sector. That should help the tire industry, because the tire industry has been growing only because of replacement market. OEM, it has been suffering. And also the tire industry is at a very interesting point now. Both the natural rubber and the oil price, they have crashed 18 to 20% in the last 2-3 quarters. So that also would augur well. So these are the three takeaway points I would talk about, the proposed GST rate cut for automobile sector.
Okay, Mr. Chokalingam. Akshay, I'll come to you as well. Mr. Chokalingam found M&M as the key beneficiary of this. And today, even in Ask Profit, one of our technical analysts said that for the next 6 months, if you want to take a bet on 2 stocks, M&M could be one of them. How is it looking to you on the charts?
Yeah, good afternoon. So on the chart structure, see, M&M has a very strong positive setup on the charts. If you look at the charts, I think we have had a yearly breakout at the levels of 3,200. 3,200 used to be a massive resistance, which was built in right from somewhere around June, July 2024. Multiple attempts were rejected to get past 3,200. But in the last month, we have seen strong volumes along with price getting past the level of 3,200, which is a technical breakout. So in all possibilities, technically, it is very strongly placed. And possibly, if you're looking for target projections, short to medium term targets go as high as 3,600 to 3,650. There is a strong support at 3,200, below which you can maintain your stop losses.
All right, so that's with regards to where M&M stands, and of course the entire auto pack. And sticking with the same theme, Force Motor is another counter which has been in focus, although seeing not some amount of, but a significant amount of profit booking today, but it's ran up as much as 200% in the last 6 odd months. And we have Puneet joining us as to what's happening with the counter. Puneet, what are you picking up?
Well, thank you for that. It's definitely been one of the most outperforming stocks in over the last few years. Especially, it has been now on the focus, up 200% the last 6 months. It has a stupendous run from 6,400 to almost 22,000 is what we touched the high over the last few weeks. Seen some correction post that, and that's largely because of the valuation comfort now, just waning away essentially for this one. It's now trading at 33 times price to earning on a trailing basis. So definitely it is getting into the zone where it has lost some comfort in terms of valuation, but essentially a very big outperformer. When you also look at the positive sales momentum, it has been strong growth when it started with April. So 24% growth is what the company saw in the month of April. But that growth has started to just taper off a bit as we enter July, when we saw just about 11% growth in month of July. So we'll be able to see if the company can maintain the mid-teens growth for this year of FY26. But definitely a stock you should keep on your radar. Has done well for its investors over the last few months, but its incremental new launches such as the Urbania as well as the Traveller are gaining much more traction. So we could see a strong growth in FY26, but valuations have to be kept in check for this one.
Right. Thank you so much for that, Puneet. Akshay, do you think the kind of momentum it's seen in the past 6 months shall continue going forward as well, or considering the profit booking that it's seeing today, there's no steam left?
See, the steam is fizzling out. As you understand, 6 months of one-way rally, there is bound to be some phase now where the stock will take a breather. And most probably we are entering into that phase where a possible time correction will unfold in the stock. By time correction in technicals means the prices might be confined in the range, might be on low volumes, and possibly the range which I foresee right now is 22,000. That's the resistance from where the sell-off has kicked off. And possibly this sell-off could abate somewhere around the levels of 18,000. So again, yes, if you are a trader now, that makes a lot of sense to buy around 18,000 for small recoveries which you might see on dips. But clearly the strong momentum or the major gains which the stock had to reward its investors is off, and their next couple of months can see a breather period in the stock.
And not a cheap stock at all, for sure. But again, sticking with the same space, let's also zoom in and take a look at the sectoral picture for autos. What is being penciled in, and which are the companies that could benefit if these cuts, that is GST cuts, kick in? Listen in to the word coming in from research analyst Mukesh from Anand Rathi, who has a view on this entire space.
So on the packing order, I think the Maruti and Hero could be the bigger beneficiary as they are more exposed towards the entry segment, and a 10% reduction on GST. And then obviously there's a tax on tax of road tax also. So it's a good reduction for the small cars and entry two-wheeler segment. But overall, I mean, the whole PV segment and the two-wheeler segment would benefit. And then CV segment, it could be a partly where there are some truck operators which takes the input tax credit. Then for them, it would not be a major change. And tractors also could benefit with the reduction in the rate. With the higher exposure of Maruti towards less than 4-meter vehicle, that segment could be the major beneficiary.
Okay. In fact, even the FADA president, Vinkesh Gulati, predicts that the proposed GST cut from 28% to 18% on small cars under 10 lakh will reduce prices by approximately 1 lakh rupees, boosting demand by at least 15 to 20% and improving affordability as well. Listen to what he had to say.
The vehicles are being taxed at what, 48% or 50%. So 28 plus 20% cess or 28 plus 22% cess. And all the premium cars or even SUVs are being taxed at that price. If it comes down to 48% to 10% for a 10 lakh car is also a big amount. It is 1.5 to 2 lakh rupees. And if you talk about Mercedes or Jaguars or all those, you're talking of a huge amount of benefit being passed on to the customer. So it's just not entry level. No doubt entry level will get a push, like Sir said, because for the past 2, 3 years, 4 years, we are seeing entry level not getting that tandem because of the price increase, which we have seen because of the regulations and the product change. With this 10% reduction, anything which is 100cc motorcycle or a car which is below 10 lakhs will obviously get that push when they get a benefit of a lakh or a 20,000 in the two-wheeler segment. But this will affect the auto industry on the whole. The growth, what we were talking in this financial year, that it will be subdued or would be a low single digit. I feel we can expect a better number in this financial year because of this GST cut.
All right, so those are the views coming in from experts about how this GST rate cut could benefit the entire auto space. Now, shifting focus from the auto space to the pharma space, Divis is one of the counters that's buzzing in trade today, and this is after Citi that has maintained buy on the counter, and they see a significant upside and also find the valuations reasonable. Varsha joins us with more details on this.
Thank you so much for that. 29% of upside potential is what we are talking about. Now, according to Citi, this is the top preferred pick as per Citi, and according to Citi, valuations are reasonable considering the weakness that the company has seen. So this is nothing but a buying opportunity that Citi is eyeing. But let's see what are the reasons why Citi has been giving this as a buy rating. One is the concerns about their hard drug Entresto. The patent overhang has been overblown now, and so there would be no supply issues when it comes to API from the Divi's point of view. And also Divi's supplies are not for the US market as per the Citi, so their API business is expected to continue. Now, the most significant opportunity that the Divi's has is the GLP, which is anti-diabetics or anti-obesity kind of products that the company has, and the sales. Consider the example of Eli Lilly's Mounjaro. The sales of this product is expected to double, and Divi's is expected to have a good opportunity when it comes to API of these products. The other thing is the future growth catalyst where Citi is eyeing on is several new initiatives are on track when it comes to Divi's, considering their 700 crore capex, the new manufacturing facility with 700 crore capex, and of course the supply of new GLP-1 products that the Divi's is eyeing, and lastly new custom synthesis molecules that the company will make for their customers are some of the key triggers that Citi is expecting for Divi's to play out, and hence 29% of upside potential that the company has in future, and this is why this is the top preferred pick for Citi.
Okay, Varsha, thank you so much for giving us those details. Mr. Chokalingam, I'll come to you on this one. Divis, do you also think that it's reasonably priced right now?
For last 5 quarters, operating profit is more or less stagnating, and 70p now. And I would rather wait for the final outcome from the US president on Indian pharmaceutical exports before plunging into this kind of stocks.
Okay, all right. So that's with regards to where Divis stands. Akshay, your quick view on Divis with regards to where charts are concerned?
See, there's been a short-term weak trend in Divis from 7,000 from where the correction has been triggered. Right now, it is on the verge of building a support zone near its 200-day moving average, somewhere around the levels of 6,000. So still, we need some more concrete evidence about any major long-term upside from here. As of now, technically, there is more likely to be a trading recovery from current level, where you can look forward to targets of 6,450 on the upside.
Okay, all right, Akshay and Mr. Chokalingam, thank you so much for giving us those insights and speaking to us at NDTV Profit.
Thank you.
All right, now the future of any family business depends on the next generation, how they navigate the ins and outs of any family business. In the episode of Building Legacy, we divide into strategies families use to prepare and involve the next generation. My colleague Tamanna Inamdar caught up with Muthu Murugappan, CEO and whole-time director at EID Parry, and Janmejaya Sinha, the chairman at BCG India. Take a look at what they had to say.
What are the lessons here which are important, Mr. Sinha? Because, if we are addressing right now an audience of people who are aspiring to build a legacy in their businesses, continue their family businesses over generations.
First, let's have some fun.
Okay, always.
Let's put him on the spot a bit, right?
Earlier you can get away with it, so I hand it over to you.
So, his father is in the business, his uncle is in the business, cousins are there, how easy is it to deal with your father? How easy is it to deal with your cousins? Do you lack autonomy? Do you have to sort it out at dinner at home, or do you sort it out in the boardroom? You know, how do you deal with some of this? People would like to know, you know.
So, different ways of sorting different things out. I think, you know, you've all grown up around each other, so I guess you all you know where and how everyone is wired. But you know, there is the underlying value system, I think, which everyone in the family gets. Of course, there's always going to be differences of opinion, disagreements, sometimes a lot of agreement as well. I mean, no one specific answer. I think some of these are done over a game of tennis or golf. Some of these have to be done in the office. Some of these are perhaps done where on vacation in Kunur, in the Nilgiris. So I guess you got to pick the place, pick the time, and I think you'll have to really pick the tone of discussion as well. I don't think there's one playbook. This is muscle which you build out of experience and, you know, just out of self-awareness, really.
Yeah. Is there a mechanism in place for resolution, or is it at the end of the day the senior most takes the final call and it ends there?
Not exactly. I think, you know, we've always, Dr. Sinha has been on the advisory board, so we've always had the benefit of, you know, having, you know, very trusted members of the board or trusted advisors to the family. We've often used
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
माय बर्थडे गिफ्ट टू पापा, ये उनके पापा की पहली गाड़ी एक गराज में पड़ी थी दार्जिलिंग में, फिर 3 मैकेनिक, पेंटिंग, पॉलिशिंग। जब इसे फाइनली घर लाया ना, तब लगा लाइफ में ग्रो किया है।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
Hello and welcome to NDTV Profit. You're watching Small Cap Buzzers. I'm your host Anushi Vakharia and with me is Puneet Chaveri. Now, just on the benchmark indices as we discuss every day on this show, if you're looking at the Nifty 50 currently down about 0.64% in trade, currently at the day's low is what we are seeing over here, but it's not a pretty picture for the mid cap and the small cap indices as well. It's a mixed sort of a picture in terms of how both the indices are performing. And just for that, we have Puneet standing by to give us a detailed breakdown on the same. Puneet, over to you.
Well, thank you for that. So definitely seen a lot of pressure on the main board indices today. We're seeing while the mid-cap 150 has also been underperforming, it's performing much better essentially compared to the benchmark index as well. It's down 0.08%, but definitely the 150-point reduction on the Nifty that we're seeing today, we saw that at the start and it's continued throughout the day as well. Let's now take a picture and look at some of the key losers in the mid-cap 150 first. We've seen stocks like JK Cement, Bharat Forge, as well as something like LIC Housing being under pressure. For JK Cement, we did see a rally at the start of the week, maybe some pullback from those levels as well. Let's also look at what's happening with some of the key players in the small cap space. For small caps, we're seeing some positive action today across the board. We're seeing something like Godavari Power being one of the biggest gainers. Something like Apollo Micro is also up almost 15% in trade today. It does come under our other active criteria. Let's go across to the previous graph very quickly and show across the other two stocks as well very quickly. In the previous segment, Royal Orchid is the other one, up 14%, while something like a Lotus Eye is also up 12% in trade today. So been a day where largely has been dominated by the broader markets, while small cap have seen some gains. We've seen some pressure continue on the mid caps today.
Okay, thank you for that, Puneet. So that was overall a detailed market check in terms of what's happening with the small cap and the mid cap space. But an interesting management we have on the show right now, and that's Stalvers Automotive that I'm talking about. And to discuss on the outlook and the strategy forward, we are joined in by Naveen Juneja, the director and the group CFO of the company. First of all, welcome to the show, Mr. Juneja. Now, just on to the environment, if I want to address, the first quarter, we did see muted growth in terms of where the revenue numbers were. Volumes also we saw about a 5% of a dip. But, the commentary remains stronger in terms of how the second quarter and the third quarter is expected to fare out. Just want to understand your overall assessment of the first quarter and the overall picture for FY26 that we are building in.
Thank you for having me on the show, first of all. Regarding the first quarter, you are right. We had a muted growth. We were literally flat on the top line. But on the bottom line, we increased our bottom line by 10% by various VAB activities, etc. And in our second quarter, of course, we see the growth will be there in the second quarter. But as compared to last year, it should be not much growth will be there. And if we look at the year, of course, we are looking at a double-digit growth at the end of the year because a lot of my new projects will come in birthing in the third quarter and fourth quarter onwards. At the end of the year, we will be having a double-digit growth definitely in our business.
Mr. Juneja, very good afternoon to you. Thanks so much for joining in as Puneet this side. So definitely a lot of growth is what you're penciling in will come in Q2. Let me just first start off with the order book, because we've seen in Q1 as well, you had the big order received of 580 crores. What is the expectation essentially that you will, firstly of any new orders that you might get, as well as what's the current order book and how much do you expect to be executed in FY26?
Yeah, if we see for last one year, we have achieved an order book of around 1,000 crore. Out of it, around 140 crore will be commercialized in this financial year, and around 370 crores in 26, 27, and balance 500 in 27, 28 will be achieved.
And Mr. Juneja, is that spread across some of the key verticals that you operate in, or do you see that a larger share is coming from gaskets and as well as heat shields?
So it's the order book which I'm talking about is across all sectors. If we do the breakup of that, around 40% of that will come from our joint venture Marelli, around 30% will come from my venture of gasket and heat shield, and balance from rest of our business of forging and moreover.
And Mr. Juneja, one of the most interesting things from your presentation has been that you're giving revenue by client basis as well. So thanks so much for providing that information. We've seen Maruti being at 17% of our total revenues, and recently we have seen the GST rate cuts, a potential one to say the least, coming in from 28 to 18%. Expected to have a strong fillip on smaller cars as well as entry-level motorcycles. Just talk to us, what is your expectations from the growth from these clients? Have you already spoken to them? Because it's still early days, but what is the expectation of growth coming from these two segments for you going forward?
First of all, of course, there are talks that duty will come down, GST will come down on four-wheelers, especially small cars. In fact, commercial vehicles, which were also at 28%, they are expecting also some duty cut. Of course, the benefit will come down the line and the consumption will definitely grow. And I'm not factoring that in my projections at present.
Okay,
And two-wheeler duty will also come down. We are 15% of my portfolio in two-wheeler only.
Mr. Juneja, just on that, just want to get an overall industry picture, in terms of the second and the third quarter, because, near-term challenges were cited in terms of how the CV segment performed, the two-wheeler segment was, but the expectation is of a stronger growth from third quarter onwards, and this is on the back of various factors, including a stronger monsoon season as well. So just want to get your overall understanding in terms of, how are the few upcoming quarters expected to shape up, given that you have a double-digit growth guidance in place?
So July was a flattish month, and August seems a little better, and we are quite hopeful by September things will start going upward, definitely because of festive season, number one. And I hope so by September end the GST thing will be resolved. And going forward, I don't think so there will be any pullback. We feel so. We feel so.
In terms of exports also, if you're looking at, currently you have about a 28% of a mix or so, and the target is to reach a 35% of a level by the end of this financial year. Now, if you look at the majority of the exports, UK accounted for about 56%. So just want to understand this bridge that we are looking from this 5 to 7% or so. Is UK going to be the contributor going forward, or are there other geographies also in place wherein you see more of these orders coming in place from?
No, of course, you will see a definitely improved performance from the Q3 in the export segment. And I am hopeful that by Q4 will be around 30% of our business will be export, and 35% we said we'll doing by FY 27-28. Definitely will achieve that. And secondly, as regard the geographical thing, my UK and Europe will be number 1 and 2 definitely, because Europe will go further up because my joint venture will start exporting in the European market in the Q3 onwards.
Mr. Juneja, last time we spoke, you did mention aspirations of crossing roughly about 2,000 crores in revenues by FY 27. Yes. Does that guidance still stand? I think you were around 1,200 in FY 25.
So I told last time also that it is getting delayed by 8 to 9 months. We still adhere to that because of the launches by various OE customers abroad has got delayed. Hopefully it will become a reality by next year. So we are still hopeful that there will be a time lag of 8 to 9 months in that achievement. That's all.
So specifically around 2,000 crores of revenue, you are now expecting from FY27, it should go to FY28, and you'll still update us on that, but that could be the tentative timeline. Is that correct?
Yes, absolutely right, sir.
And within the growth parameters, because from FY24 to 25 as well, the growth was slightly slower. You're mentioning for this year H2 that will start to pick up, and your new orders will be executed in next year as well in FY27, about 170 crores. What kind of revenue targets as well as growth that you're anticipating for FY27? And should we expect the margin to go up as well as new products as well as export get integrated? If you can just highlight on these two aspects. Should we expect roughly about 1,600 to 1,700 crores of revenue by FY27?
FY27, then definitely it will be much more. It will be much more. Because this year I'm expecting a double-digit growth of around 12 to 15%. Okay, I can't, if the business continue like this, 12%, otherwise it can go up to 15%. And going forward, it should be around 20%.
And final question from my side, Mr. Juneja, in terms of electric vehicles as well. You've mentioned that you're doing some more new orders with your, the joint venture that you have with Marelli. What is the kind of update as well as the growth that you're seeing over the next 2 years? Because you're seeing these newer ventures and newer orders essentially coming up in growth for you over the next 2 years. So if you can just update us on what's the trajectory that you expect these new ventures to go for you.
So as regards the EV, of course, the Indian OEM manufacturers who have launched the diesel vehicle, because of the problem of real earth has been resolved to some extent from China import has been resolved. So I foresee that this model will be commercialized very soon, and in next 2 years we will see good growth in the domestic sector. As regards my European customer who had delayed the vehicle, we got the news that it will be launching the vehicle by the first quarter of next year. Hopefully, they will be able to achieve, and we will closer to that numbers which we projected there.
Mr. Juneja, just a follow-up on the earlier question that Puneet had asked about the margin picture. Now, if you are looking at the current margins at about 16.5% or odd so, and you expect a further improvement going forward, just want to understand the target that you have for this FY26 and 27 as well.
So, the target we set around 16 to 18%. Of course, we will be in that bracket. It will be between 16.5 to 17% for this year. And going forward, it should be around that 17% plus minus 2-3%.
My final question to you is about the capex plans that you currently have. If you can give us more details on that.
Yeah, and during the year, we are having capex in the standalone business of around 60 crores. In the joint venture, we have a capex plan of around 70 crores, which are under implementation.
And what would be the incremental revenues that you will drive from this?
Of course, so next year we are looking for a growth of around minimum 15% to 20% growth in the business.
Okay, thank you so much, Mr. Juneja, for joining and sharing that outlook on the company for the next 2-3 years forward. But so that was the management of Talbros Automotive that we are looking at. Currently, the stock is down about 1% in trade. But with that, let me welcome in our guest for today. That's Prashant Tapse, Senior Vice President, Research Analyst of Mehta Equities, joining us. Prashant, you heard the commentary from the management. While there are a couple of near-term challenges which took in place in Q1 of this quarter is what we are seeing. But the overall picture ahead looks quite healthy. What is your view on this counter?
So considering the order book, what the management has guided, that is around 2,000 crores top line by 27 or 28. So that looks very much higher on the expectations. But what I'm seeing is from last 12 quarters, the growth was very much muted. And even the YOY as well as QOQ, the numbers were very much flat in terms of top line, in terms of bottom line. So I need to wait and watch how Q2 numbers will really come out as per the management expectations. So I think with these numbers, if I calculate, I think 1,500 to 1,700 can be an expected top line for FY26, 27. So that can be a number which can assume. But again, valuation wise, again, looks very decent. The stock has corrected a lot, and the stock has been underperforming from last 1 year, which almost like 23% down from last 1 year. So a risky investors can consider having a position at this point of time if understanding this sector would really perform well going forward. So overall, wait and watch for a quarter-on-quarter update from the company.
Got the view, Prashant. But Royal Orchid Hotels has recently launched the Regenta Place essentially in Ahmedabad, a 48-key property, expanding its Gujarat portfolio as well. Let's get in my colleague Mahima to give us more perspective on this one.
Right, so the stock is zooming in trade today largely because of this news. The company has opened Regenta in Ahmedabad, and this marks its 16th property in Gujarat overall. It's a 48-key hotel. In terms of the management commitment for future expansion in Gujarat, that's quite ambitious. They've said that in less than 2 years they will go fully bullish in terms of where expansion stands in Gujarat. In terms of where the Q1 performance stands, it's been a decent quarter. Revenue grew around 8%. EBITDA saw a growth of around 11%. Profits have grown around 28%. In terms of operation metrics also have improved a tad bit. The average occupancy at 69%. ARR has improved by around 6%, and they managed ARR, the managed hotels ARR was up by around 5.5%. The management has also given a Vision 2030 and growth strategy where they're thinking of tripling hotels from 115 currently to around 345 hotels, and the keys will grow from around 9,600 to around 22,000 overall keys. Mostly, of course, asset light. Lastly, in terms of full year guidance, FY26 they are expecting a revenue of 100 crores, expecting 15% margins after lease rent. Even in terms of where FY26 cash profit stands, that is estimated to be around at 70 crores, and FY27 profit overall profit projected around 75 crores, and lastly capital deployment at around 70 odd crores. So this is the overall view as to what the guidance is for Royal Orchid, and of course why it's buzzing in trade today.
Thanks so much for that, Mahima. Prashant, let me come to you. It's a very strong growth guidance for Royal Orchid. We're seeing that strong reaction as well. What's your view on the stock, as well as any kind of commentary that you have on the smaller hotel space? We've seen Lemon Tree also be in investors' radar as well. What's your view on these ones as well?
Overall, with respect to the hotel as a sector, very positive in in-house research. Again, we like the company which are mostly focused on the asset-light hotel model. Obviously, Lemon Tree is leading on that. So even Royal Orchid is thinking to go with their target and more about the asset-light model. So many hotel sectors which will go on asset-light model, obviously it looks very strong with respect to the long-term outlook. Valuation-wise, very comfortable to have a fresh position, even though if the stock is up by 15% today. Overall, the management guidance as well as the growth in the hospitality sector looks very much in line. So I think one can have a very strong outlook on the Royal Orchid for long term.
Okay, so that's the view that we are seeing for Royal Orchid. But just before we go ahead with the show and discuss more small caps stories, sources tell NDTV Profit that the Department of Telecommunication has escalated Vodafone Idea's and Bharti Airtel's pleas for adjusted gross revenue relief to the PMO for a final decision. My colleague Aishwarya Patil joins us with more details on this one. Aishwarya, over to you.
Well, what we're picking up currently is that the Prime Minister's office will be reviewing latest documents and a plan that the DOT has put forward, a proposal as far as the AGR dues are concerned, relief towards Vodafone Idea as well as Airtel. That is being reviewed by the PMO is what we're picking up from our sources. Now, if this plan is approved, what is on the cards for both these telcos who have massive amounts in terms of AGR dues? As far as Vodafone's AGR dues are concerned, that is likely to be reduced to about 28,000 crore rupees from the current due of over 83,400 crore rupees, while Airtel's AGR dues, those currently which stand at about over 42,000 crore rupees will be reduced to about 10,000 crore rupees, is just one part of the proposal. Apart from that, DOT has also pitched a relief plan as far as the penalty and interest on penalty is concerned for both Airtel as well as Vodafone, so as to restructure and take a look at how that can also be extended in terms of moratorium as well as interest payments. That will also be reconsidered by the PMO is what we're picking up from our sources. PMO may consider about 2 to 3 options, especially for Vodafone Idea. Now, overall, if we talk about Vodafone Idea's debt in total, that stands at about over 2,14,000 crore rupees in terms of payment obligations towards the government, of which about 83,000 crore or so is in terms of AGR. and that's the update so far. We'll keep you posted as and when we hear about what steps the government will take going forward to give relief to both the telcos, Airtel as well as Vodafone Idea.
Okay, thank you for that, Aishwarya, for all those key details. But another stock that we should be focusing on today is Ather Systems, and this is on the back of an acquisition news that we are looking at, the acquisition regarding Novigo. It's a 400 crore of acquisition size that we are seeing, but for more details, we have Jasmeet joining us to talk to us about this.
Well, right, yes, thank you for that. The stock is buzzing in trade today and it's up nearly 11% from the 12% high earlier. Quickly understand what exactly happened with the company. The company recently acquired 100% stakes on Novigo. Well, Novigo is a Mangalore-based IT company which also services in product engineering as well as AI engineering. While this acquisition to create a lot of synergies, and that's why the stock is buzzing in trade today. Well, now let's quickly understand. Novigo's financial revenue stands at 264 odd crores with a margin of 25 odd percentage. When we look at the sales consideration paid by the company, it's nearly 400 odd crores, which is a 6x of adjusted EBITDA that a company is willing to pay for the acquisitions of Novigo. Now, how will Novigo exactly add value to our systems? Let's quickly understand that. Now, well, firstly, Novigo's compounded growth stands at 44 odd % for 3-year average, while on the other hand, our system has a growth of 14%, while this would add a synergy of increase in the compounded growth of the company. Secondly, when you look at the capabilities, Novigo to add capabilities in terms of niche software development and in AI domain experience. On the other hand, this acquisition to be EPS assertive starting from the year 1 itself. When you look at the regions and other synergies, their company says they will be having synergies across various cost and revenue as well. And when you look at the expansion, with this, the company, our systems will be able to tap into a newer market of Middle East as well as southern part of India, given Novigo basically operates in Mangalore region. Now, when you look at the financial benefit that a company can get by this acquisition, firstly, the Ather Systems clocked in a revenue of 1,700 odd crores in the previous year. With this acquisition, the revenue would increase by 14 odd % and go up until 2,100 crores going forward. When you look at the margins, the combined compounded growth would stand at 17 odd %, given that 14% earlier for our systems. When you look at the other highlights, why the stock also is buzzing is on the account of the NCD the company is raising of roughly 275 odd crores. While we also have brokerage that came up with the note on particular acquisition, what they say is they maintain the long rating with a target price of 484 rupees per share, while they also see that this would add an increased revenue for the company of roughly 15 to 16%. While this is the reason why stock is buzzing in trade today.
Okay, thanks for that, Jasmeet. Prashant, coming to you on this counter, now, as Jasmeet was just saying that 15 to 16% is the kind of incremental revenues that we're looking at. Along with that, the company also has a healthy profile in terms of where the margins are concerned. What is your overall assessment of this particular stock?
So after understanding what the anchor has just updated, I think there's a good synergy between two companies which are getting merged, and there will be a good liquidity with respect to EPS expansion, as well as the company is going to expand towards a new geographical center like Middle East as well as in the South India. But what I was looking at would be the AI engineering. AI engineering is in demand right now. I think many companies are going into those companies. So it is better to acquire a company and then build up the scale of instead of getting everything done inside in-house with respect to development. So I think our system has done the right way to go and acquire this company and create good value for the shareholders. In terms of valuation, looks very decent at this point of time, even though yesterday as well as today the stock is up by almost 15%. So overall, very positive outlook with respect to the merger.
Got the view, Prashant, but let's get in my colleague Vansh now. We're putting the focus on Gujarat Apollo. Vansh, over to you.
Well, so if I talk about the details of the business, now the company manufactures different types of mining and road construction and maintenance machinery. They also manufacture high quality crushing and screening equipment. Now if I talk about the other details, the company has a debt of about 50 odd crores and the market cap stands at 600 odd crores. So not a concern out there, but if I talk about the financials, the revenue was up at 11 crores versus 8 crores. The EBITDA a loss of 2.3 crores versus a loss of 2 crores. And the net profit at 1 crore versus 4 crores. So clearly a disappointing set of financials in terms of Q1 for this company. But if I talk about some of the interesting things for this company, the renowned investor Mr. Ashish Kacholia owns 1% stake in the company as of June quarter. And if I talk about the technicals, the stock is already trading at the highs of 2008. So clearly a positive thing to watch out for this particular stock.
Thank you so much, Vansh, for that. Prashant, a very quick view on this one. I'm not sure if you have any coverage on this one. We've seen, as Vansh was mentioning, that the profits have actually fallen this particular quarter. But any kind of expectations that you have from this one if you track it?
Yeah, you are right. I was not tracking this stock, but again, just having a look at the quarterly numbers were really bad. Despite this, again, I think it is only because of the technical structures which has given some kind of spike today in the stock. But overall, the valuation-wise still looks very expensive. I think we should wait and watch for more clarity with respect to their earnings going forward. But again, if somebody is holding it, it's better to exit at this point of time. I think with respect to earnings, with respect to the price action, there is some kind of mismatch.
Okay, just a quick note on this counter. If you're looking at it, was just in the June quarter that Ashish Kacholia marked an entry in the stake in this particular stock with a 1.06% of stake. But that's all the time that we had on this edition of Small Cap Buzzers from Puneet and my side. Stay tuned for India Market Close coming up next.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
जब मुंबई से वापस कोल्हापुर शिफ्ट हुआ तो सबने कहा कि ड्रीम सिटी को छोड़ रहा है। ड्रीम सिटी, तो मैंने कहा ड्रीम में तो यही गलियाँ आती हैं। तो जब ये रियलाइज हुआ कि कुछ बड़ा करने के लिए बड़े शहर में रहने की जरूरत नहीं है, तब लगा कि लाइफ में ग्रो किया। कशी ताई, ऐसे बॉय मिलते मुंबई में? चांस ही नहीं।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Welcome, you watching India Market Close here at NDTV Profit. I am Mahima Vachrajani. With me is Harsh, Sayata and Neeraj Shah. Let's take a quick look as to how the markets are doing. Well, it's not a good Friday for sure, certainly where markets are concerned. The Nifty 50 down by about 0.6%. The Bank Nifty down by about 0.8%, probably at its day's low point. If you can try to pull up the Nifty 50 chart as well as the Bank Nifty chart, see where they're doing, see what they're doing. Nifty not at its day's low point, slightly up, it bounced back from its day's low point, but still down 0.6%. But the Bank Nifty, that most certainly is at its day's low point, trading out 0.8% lower. Let's try to pull up the Nifty heat map and see what are the counters that are actually leading to this kind of downtick in markets. There are counters like Asian Paints, Grasim, ITC, some consumption names that are not doing well. Both down 2%, Grasim as well as Asian Paints. ITC also down by about 1.6%. There's also Adani Enterprises, Ultratech, HCLT Tech as well as JSW Steel, which are down by about 1.5%. But some counters that are keeping the Nifty in check includes your M&M, which is up 1.1%, followed by something like a BL, Maruti down by about up by about 0.5%. Sun Pharma, Dr. Reddy's, some pharma counters marginally in the green. Let's also try to pull up the advanced decline ratio and see how the broader markets paint a picture. There you go. It's skewed towards the sellers market today, and the chart throughout the day has been kind of widening. There is around 1300 odd declines versus that of 920 odd advances. Let's pull up the mid cap 150 and see what it's doing in trade today, and then followed by small cap 250 as well. Almost flat. The mid cap 150 is in fact flat itself. The small cap 250 marginally probably in the green. Yes, it's up by about 0.08%. Let's also try to pull up the BSE 500 and see what are some of the counters that are buzzing in trade today. There's KIOCL, which is down by about 4.5%. Star Cement down by about 4%. Godfrey Phillips seeing that profit booking, continued profit booking, down by about 4%. Polyplex Corp, JK Cement, Supreme Petrochem all down by about 3%. Also Vodafone Idea doing well in trade today, up 8%. Aditya Birla Fashion doing very well in trade today, up 7%. Poly Medicure up 5.8%, and Z Entertainment also trading 4% higher. So that's with regards to where the markets stand. Neeraj, what are you picking up?
Some flyers of the last few days or weeks are also coming under a bit of pressure. So you're seeing profit booking, for example, in Force Motors, and that stock stood out for me, down about 6%. Select cement names, Star Cement, for example, has had a bit of a pushback today. So that stock has corrected. Shankara Building Products is down about 7%. On the separate side, Foseco is up another 11.63%. And if you see this week's charts for Foseco, you will see it's had a phenomenal run. So good move there for that stock. And on half decent volumes, by the way. The volumes haven't been too bad either. There is strength in Poly Medicure today, up about 6%. Godavari Power is up about 6%. And the big one is, of course, Vodafone Idea, with the news break that just happened on the show as well. Maybe AGRDs of some of these companies coming off. I think that is something you want to keep in mind. Okay, so those are a few names to keep in mind. But the question is, in this slightly quiet morning of trade or afternoon of trade, would you want to take some hands off the table? Would you want to stay invested? Ruchit Jain, Vice President, Equity Technical Research, Wealth at Motilal Oswal with us. Ruchit, how are you approaching trade this afternoon ahead of the weekend?
Yes, hi, very good afternoon, Neeraj. Very good afternoon, Mahima. Well, if we look at last 1.5 months, we have already seen a price-wise corrective phase in the market where the index had corrected from that high of 25,650 to the recent swing low around 24,150. Now, in this correction, the 200 DMA has not yet been breached. So we believe that the price-wise corrective phase is behind us now. And what we are witnessing right now could be more of a time-wise correction in the short term. But looking at the overall momentum in the broader markets, which seems to be much positive, so we think that it would be a buy and dip market where any declines towards the support of 24,800 should be used as a good buying opportunity. So the broader momentum seems to be a bit sideways as of now for the very short term scenario. But considering a bit medium term, I think the downside seems to be very limited. So whenever in this consolidation market comes towards the support and around 24,200 is a major support which is placed. So that should be used as a good buying opportunity.
Okay, viewers, keep in mind that people who are wanting to take trades on either side, right? While Jackson Hole is one key event, if some resolution around this whole stress happens, then you might actually see the markets have a good mood as well. So even shorts would be a bit worried about taking very high positions into the weekend. So that's the other thing to keep in mind. By the way, some flashes on your screen, just before we talk more with Ruchit, some flashes on your screen, maybe some cap on this whole cap for premium hikes for health insurance. IRDAI, as we learn, is currently only in internal talks to consider capping health insurance premium hikes. There is no consultation that is happening with the companies as yet. So bear that in mind. That's the latest in this whole piece of insurance premium hikes that we are learning. No talks with companies, but internal chats on right now. And a lot of these general insurance companies which have got the health plan, or even for that matter, life insurance companies which might be now doing this, certainly remain in focus, Mahima, because of this.
They're also saying that they may cap health insurance premium hikes by around 10%, but by next year. But this is, of course, if the talks fructify, is what the sources are telling right now. So that's with regards to where all these health insurance companies stand. But Ruchit, coming to you. Your picks for the day, and then if you have a view on any of these health insurance companies that you're liking, specifically where charts are concerned.
So I have a couple of buy recommendations, purely based on the relative outperformance in the recent correction. So first is a buy recommendation in Nykaa. In fact, we have seen that many of these new age technology stocks have shown a good momentum over last couple of weeks. So Nykaa is one stock where technically there has been a breakout above its previous swing high. The price up moves have been supported by good volumes, and not only the daily chart, but even some higher time frame chart of weekly time frame chart are also showing a positive momentum. So we believe that Nykaa should show a good momentum on the upside from current levels. So keeping a stop loss below 215, we have even recommended our clients to go long in this stock for potential targets around 245, 248. And another name which we are picking up from a relative outperformance basis is Mphasis. Now, this is not an outperformance, compared to the whole market, but within the IT space, if you see, last couple of months, the IT space has not seen any significant up move, from in the recent correction. Now, for the first time in yesterday's trading session, I think after 1.5 or 2 months, Nifty IT index is closed above its 20-day exponential moving average, indicating signs of some pullback move. It may not be a bottom out or not be a reversal, but within the IT space, if you look at stock specific corrections in this last 1.5 months, Mphasis is the only name which has shown a relatively strength where the prices have not seen any sort of significant correction, holding above its key 50-day exponential moving average as well. So we think that some pullback move would be there in the IT space in the coming week, in which Mphasis could be an outperformer, since it was an outperformer during the corrective phase as well. So Mphasis can be bought with stop loss below 2,800 for potential near-term targets of 3,000. And as far as the insurance space is concerned, I think overall trend still remains positive. There are no signs of no reversals technically as of yet. Certainly the outperformers being stocks such as SDFC Life and SBI Life. So one can be very stock specific, or maybe wait for the clarity on the news flows to come out. But yes, on a charts basis, SDFC Life I think stands out amongst the other names.
Okay, all right. So that's with regards to where these health insurance companies stands, and of course life insurance as well. Ruchit, one counter, that's not doing really well today is Asian Paints, but a lot of technical analysts have come out and suggested a buy on this counter. Do you think this is just an occasion where one can go and buy on the dips, or do you think that charts right now are not looking attractive enough?
There has been a big underperformance in Asian Paints. If you look at 1 year ago, the stock prices had made a high of around 3,300, 3,400 range. From 3,400, we had seen a correction right towards 2,100, and this entire period, markets have done considerably well. At least for 6 to 7 months in this period, our markets have done quite well. So I think there has been a significant underperformance just because of oversold momentum setups. Recently, we have seen a pullback move, but I would wait for some price volume action to turn further positive going ahead. We may see some sort of time-wise correction now, if not price-wise correction, but 2,600 remains a significant hurdle for the near term, and on the low side, 2,300 is the support. So we think that there could be some time-wise correction in Asian Paints for now. If one is looking for any sort of contra trades over here, then maybe if we get some dip towards the 2,400, 2,300 range, then the risk-reward ratio could become favorable over there.
Mahima, the other thing is the conversation that we have had through this week with market veterans, and one of them was, of course, Mr. Ramdev Agrawal. And yesterday in the conversation that we had, while we played out about 10-12 minutes of that conversation, the part that we were not able to play out, and we'll try and do that right now, had him speak about the capital markets theme and how people should have that in the portfolio. So we'll, of course, wait for him to say it out. But the long and short of it seemed to be that if you have a 10-12 year vision in mind, then a collective of some of the stocks in this portfolio would serve you a lot of good. In fact, hear out, he's the co-founder and chairman of Motilal Oswal Financial Services, of course, spoke at length in detail about the capital markets theme.
I'm telling you, this capital market services, you might club it wherever you want to be. It will become very large. Right now, approximately, see, the way to think about it is 0.5% of the total market cap. So market cap is about, say, 5 lakh crores or say, 470, 480,000 crores. So the total addressable services brokerage or commission and fees is about 160, 170 on the free float. Actually, our free float is about 2/3. So on the free float, the revenue base for the industry is about 0.5%, which is about 155, 160,000 crores. Now free float is growing at, so the market cap is growing at about 15-16%, but since promoters are selling, now that's the only block left to be sold to the investors who are coming in day out. So now promoters blocks are coming. You might be seeing so many promoters blocks coming. So promoters are selling a little more. So I think the free float market cap in India is growing at about 18%. So in 4 years flat, it will double. So the addressable commission or addressable market is growing at about 18%, which goes from 1.5 lakh crores to 3 lakh crores in 4 years flat. And it is the nature of the business of the capital market is very consolidating. I mean, you have only about 10-12 meaningful brokers. 10-12 brokers have 80-90% market share in asset management, in wealth management, in broking, and in other market intermediaries. There are only 1 or 2. So it's very, very consolidating. So and asset light, very, very asset light. So I think there is going to be a lot of wealth creation from this particular segment also.
All right, so that's a holistic view of Ramdev Agrawal on how he is bullish on capital markets. But talking about this one counter, that is Yatra Online, it's been flying in trade. In the past 2 weeks, it's gained over 65%, and in the past 1 month has seen gains of about 75%. Even in terms of where the overall technicals are concerned, the 14-day RSI is above 85 and has broken the level of 84 seen in Jan 24. So technically looking very strong in terms of fundamentals also. The revenue growth has been at a steady state, except for 1 year, that is 2024. The revenues have grown 92% in 23, 87% in March 25, and 108% in Q1 FY26, post which we've seen the significant rally in the counter. And a couple of things, working for the counter in terms of operational metrics as well. Now, why are the revenues actually improving and what's leading to the growth? It's the 4th consecutive quarter where earnings have beaten analyst estimates, and last 5 quarters, the company has kind of shifted from its consumer business to its corporate business. The corporate business is where the top line growth is coming in from, and of course the margin expansion as well. It's cut down its consumer business from 55% to 35% and increased the corporate business from 45% to gross bookings of around 65% plus. In terms of the overall picture as to where operational metrics are concerned, gross bookings growth has turned positive after 4 quarters. One of the reasons as to why the stock has rallied after its Q1 numbers. Gross take rates at group level are also stable between that 8.5 to 8.7% mark. Discounts and A&P spends as a percentage of gross bookings are lowest in the past 6 quarters, and that's one of the reasons that's aiding margins as well. Even in terms of the overall picture as to where path to profitability stands, where it was at a loss of 1 crore in 2024, March 2024, March 2025 it did a profit of 35 crores. In Q1 itself it's done a profit of around 23 crores, and this is a quarter where we have seen a lot of geopolitical headwinds as well. In terms of where the margin picture is concerned, margins have improved quite significantly from 3% in March 24 to 6% in March 25. It's at 11% in Q1 FY26. Now what has aided the margins and profitability? Couple of reasons. One reason being the overall shift to the corporate business from the consumer business, because there's lower LTV there and consumer business also has lower margins, so that's one of the key reasons. The second one being high customer acquisition costs in consumer businesses there, and that is also one of the reasons as to this shift will help aid margins to the corporate business. In terms of the overall picture of long-term borrowing, that has also reduced quite significantly from a 24 crore in March 2023 to a 2 crore in March 25. So we'll have to know as to whether they become, the total borrowings will completely go off this year or not. In terms of where the operating cash flows are concerned, that's a tad bit concerning because they are still in the negative. As of March 25, it stands at around negative 89 crores. ROC also on a declining trend, so that's also one of the pain points for the company because that's come at 5% in March 25. 4% in March 24, and which was originally a 14% in March 2023. Lastly, in terms of where the overall FI picture is concerned, because FIs have been reducing their stake in the counter, it stood at around 9.3% earlier in September 2023, which has overall come down to around 2.8% in June 25. In terms of where the valuations are concerned, and before that, in terms of where the management guidance stands, 20% growth is expected in terms of revenue in FY26 and a 30% growth in EBITDA is what they are expecting. Lastly, where valuations are concerned, analysts believe that it's trying to play a catch-up with regards to where the Ixigo valuations are concerned. Ixigo valuations are as high as 181 times trailing 12 months, and Yatra stands around 46 times, and because the volumes here are much higher than something like a Ixigo, probably that is one of the reasons as to why the stock has been flying in trade. So this is the overall view. In terms of lastly what brokerages are saying, a lot of brokerages have either initiated or maintained buy on the counter, and the target prices range anywhere between 130 to 175. So this is the overall view as to what's happening with Yatra Online, and we are also joined by Dhruv Shringi, who is the whole-time director and CEO of Yatra Online, joining us now. Dhruv, hi, very good afternoon to you, and always a pleasure speaking with you. My first question to you is that while I was doing this deep dive, I was going through a lot of changes that you've made, and the first one, and we've talked about this as well, because the shift from that consumer business to the corporate business is something that's going to probably aid your top line and bottom line margins as well going forward. Give us some sense as to how this entire mix will change going forward from a longer term perspective.
Good afternoon to you as well, and thank you for having me on your show. Like we've been discussing, I think now it's the last 3-4 quarters where we've been talking about this change in business mix that we've been actively working on, and you're beginning to see the benefits of that flow out. We are today at a stage where about 2/3 of our bookings are coming from corporate travel. We would expect that over the next year, this number will increase to about 75%. And that then becomes the equilibrium state for us between a 75-25 mix between corporate and consumer. We feel that's the right mix from a profitability point of view, and also allows us to balance growth and profitability.
Dhruv, good afternoon. Neeraj here. And of course, you had a fabulous quarter after which you spoke to us. Now just trying to understand the pace at which travel is picking up. The big picture, for how long a time frame can you predictably say that if not the exact quantum of growth, but the nature of the growth that you've shown recently can continue? Is it possible to kind of hypothesize that?
See, Neeraj, in terms of the way the market itself is also growing, And there are two factors that are benefiting Yatra. One, the overall business travel market is growing anywhere between 1.5x to 2x of GDP growth, right? So you've got strong fundamental GDP growth happening in the country. That's driving nearly double-digit growth in the industry. Secondly, within that, we've seen a big shift in the large corporates from an adoption of technology point of view. It's becoming more and more important for organizations now to automate their business processes. And as they go about automating business processes, travel and travel related business processes is another important aspect of automation. So we are benefiting from that increase in the automation also, just at a more macro level across the industry. On the back of these two elements, I think we should be able to maintain, these kinds of growth rates from a gross booking point of view, and higher growth in the gross bookings closer to between 15 to 20% for, I would say, over a CAGR of a 3-year period.
Okay, and I think on the call you had mentioned that 20% growth in gross bookings could result to what, a 35 to 40% growth in terms of EBITDA. You stick by that. You believe EBITDA can grow at a 40% CAGR for the next 3 years.
We are positioning it as 30%, yes, but obviously we are confident of what we are talking about from that perspective.
Okay, and one more thing, what can help extend this growth period? Is it effectively a factor of GDP growth northwards of 6%, or does it then need some extraordinary efforts around tourism, for example, for you to be able to be confident of growth being 20% beyond 3 years as well?
So there are two aspects to it. One, you're absolutely right. From a gross bookings point of view, you would need the more macro number to grow at a faster pace, which means the underlying economic growth has to be faster. The second that we are also looking at is adding more products and services. And within that, we've seen, the cross-sell of hotels take off in a very meaningful manner. We'll be adding more products like car rental, etc., to our portfolio as well. So those should bring in another newer layer of growth as well as we go forward. So one, on the aviation side, I think it's going to be to a great extent dependent on the underlying macro. But over and above the underlying macro, we will also have the cross-sell, which will come in and drive further growth and profitability.
Dhruv, hi, this is Harsh here joining in. I want to understand this larger focus with regard to corporate. What kind of a risk does that bring? From largely trying to first understand how sticky is the product from a corporate standpoint, and second, how many new corporates are you tapping into? Is that something that you all are doing on a recurring basis, going out in the market and tapping in, and how easy is it to acquire those new customers?
It's a highly sticky business, Harsh. We integrate deeply within the organizations, right? We'll be connected into the ERP systems, the HRMS systems. Their employees will, do their purchasing workflow, approval process mechanism, everything on our platform. So it leads to a very high stickiness on the part of the customer as well. Our overall churn rates are less than 3% a year. So it's a very sticky business once we implement the solution. In terms of corporate wins, that's something that we are quite actively pursuing. In the last quarter as well, we had about 34 corporate wins with cumulative annual business of 200 crores. In the previous year, we had almost 750 crores worth of business that we had won, which is currently in the process of being implemented, some of which has already gotten implemented. So there is a very healthy pipeline and momentum behind the business.
And Dhruv, as you grow and as you scale, you're expecting retail to largely be as is, but is there a conscious effort to grow that part, the B2C part of the business as well? You're now guiding for the 75% mix in terms of your top line coming in from corporate. How much of the growth will come from retail and how much from corporate? Give us those numbers broadly.
So in the near term, the larger part of the growth will come from corporate only. Retail will grow more gradually. A reason being that, we feel fundamentally at this point on the corporate side, we are able to create a high lifetime value of the customer. There is a big defensive barrier that gets created once the technology solution gets employed at the end of the customer. Hence, we are better off focusing on getting that more defensible business as of today, create that stronger moat for us, and then we can make another push, a renewed push sometime later on the B2C part. But from an internal bandwidth point of view, internal focus point of view, at this point, it's important for us to make sure that we go deeper in the corporate travel segment.
What about the margins? What is the sustainable range that you're aiming at in FY26? Because Q1 for sure was that at 11% mark, but 2025 you ended with that 6% mark. So what is the kind of margins that you'll do in FY26? And even in terms of bottom line, you ended with 35 crores in 2025, but Q1 itself you've done a bottom line of 23 crores. So give us some perspective as to where this number will go from 35 crores to by the end of FY26.
So in terms of margins, firstly, right, margins, we would expect the margins to be in the early teens this year. There is a certain amount of seasonality in the business as well. So to that extent, one should look at this on a trailing 12-month period basis as opposed to just looking at one particular quarter. But in terms of margin, we would expect margin to be in the early teens this year. In terms of, from an overall profitability point of view, our guidance is about 30% growth in EBITDA, and we stand firmly behind that guidance.
Okay. And if you just do a back of the envelope, Dhruv, I mean, if you indeed hold on to these numbers well, then I'm not surprised with the kind of moves that have happened on the stock. The question mark only is, in order to achieve all of these things, this is my last question at least, would you need to raise any kind of equity capital or result in any kind of equity dilution, inorganic moves, other moves, etc., or does it happen entirely through internal accruals?
So at this point, firstly, I want to just highlight one thing, that it's not just one quarter where suddenly we are seeing
of course.
For the last 5 quarters, we've consistently been delivering. Markets also take time, right? Markets see consistent performance, and then overnight, what happens, what should have happened maybe over a 12-month period. But still, I'm not complaining about that. Having said that, in terms of from a cash point of view, I think we had over 200 crores, almost 220 crores of free cash on the balance sheet. We have almost 180 plus crores of unutilized banking facilities. So we don't see any dilution happening anytime in the future. We've got more than enough cash. And even at an operating level right now, we are generating sufficient cash to take care of working capital requirements.
Dhruv, just one last question from my end as well. Any specific guidance with regards to where tech spends are concerned this particular year?
See, our tech spends have been around the 25 to 30 crore kind of range. They will be slightly, maybe about 10% higher than that in the current year as compared to the last year. And that's because, firstly, there is a little bit of one-time tooling that's happening, you adopting new AI tools and building out new AI solutions. But I feel in the second half of the year, or maybe at least in the exit quarter, the fourth quarter, we'll see the optimization benefit also of the tools that we are implementing right now pay through.
All right. Dhruv, thank you so much for giving us those insights, and thank you so much for taking our time and speaking with us at NDTV Profit.
Thank you.
All right, Ruchit, I'll come back to you. Your quick view on Yatra, though seeing some profit booking today, but has had a significant run up in the past 2 weeks.
Yes, so I think the kind of volumes that have been seen post the recent results, I think it clearly indicates a fresh buying interest in the stock. But since the stock is already up by around 60% in this last 2 or 3 weeks, so I think one should keep a buy and dip approach, and any declines towards that range of 135, 140, if it comes in the near term, then I think one should use those dips as a buying opportunities.
Use those dips as buying opportunities is what the technical charts are also indicating. All right, Ruchit, thank you so much for joining us and giving us those insights. With that, it's time to slip into a very short break, but lots lined up on the other side, so do stay tuned.
माय बर्थडे गिफ्ट टू पापा, ये उनके पापा की पहली गाड़ी एक गराज में पड़ी थी दार्जिलिंग में, फिर 3 मैकेनिक, पेंटिंग, पॉलिशिंग, जब इसे फाइनली घर लाया ना, तब लगा लाइफ में ग्रो किया है।
बुला
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're
Yeah.
going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Ganesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Okay, welcome back. Thanks for staying with us here on India Market Close. Also joining us, Kunal Shah, Mere Asset Sher Khan and Dipan Mehta. Founder at Elixir Equities. Hi Dipan, great chatting with you, great having you here. Let me first start with you, Kunal. Let's take some of the levels out of the way. The Nifty Bank, where are you seeing it? Of course, we've given up a large part of the gain we've made all through this week. So it's been another week where we've seen the market trade absolutely flat. How are you viewing it? What are the expectations for next week? Set it up for us.
Good afternoon. Good afternoon to everyone.
Firstly, if you look at the indices, what we have seen that Nifty from 24,300, the support what we took, we have seen a good pullback towards 25,100, 150 zone. Now, the entire correction which started from 25,600 to that mark of 24,300, we have completed a 50% retracement over here. And now we expect Nifty to test the 20 DMA on the downside, which is placed for the Nifty indices at 24,730. So that would be tested on the downside, and that would decide from those levels. If we are able to maintain that level, then probably we'll see the rally resuming again towards the mark of 25,100, 200 zone. So for us, it is a buy and dip market. Utilize dips to buy the market. That would give you a better risk to reward ratio. Now, on the Bank Nifty front, this has been the spoil sport in this pullback. Bank Nifty has not been able to surpass 56,000 mark, and that is where the real pain point for the market is. And if Bank Nifty breaks 55,000 on the downside, which is the recent swing low on technicals, you can expect further downside towards 53,500. So it's the Bank Nifty index that is playing a spoil sport in this rally what we had for the past 6 days. And probably some more downside could trigger in, because today Bank Nifty will be closing below the 100 DMA. So again, that trend stands negative for the Bank Nifty index. So Bank Nifty remains as a sell on rise mode. Below 55,000, the selling pressure would increase, and Bank Nifty could touch 53,500 on the downside.
Okay, so that's how you're seeing the market swing. What are your top picks this afternoon, Kunal?
So I think two. One is on the buy side. One is Poonawalla Fincorp. In the weak market, the stock has seen a sharp reversal on the technical charts, and we can expect this bullish momentum to continue in next week. So that will be a buy, keeping a stop loss of 440, looking for targets of 480 to 490 on the R end for Poonawalla Fincorp. The second is on the sell side, and this is Bharat Forge. Again, Bharat Forge in this pullback rally didn't witness any strength, and it has been trading below the 20 DMA, and there is selling pressure on Bharat Forge, so we can expect further downside into the counter. One can keep a stop loss of 1180 and look for a target of 1050 on the downside.
Excellent. Okay, Deepan, let me start off with a general question. How are you viewing markets? What are pockets you're liking at this point? There's of course plenty happening on the domestic front. There's just so many things with regard to stimulus that we're seeing both from the government as well as from the RBI. What are you taking, and what's the best bet in this market, value versus growth?
Yeah, good afternoon, and thank you for having me on your show. Yeah, I think that basically what is happening is that the funds which are coming into the market through mutual fund, through retail investors, that is keeping the market afloat, but the fundamentals are not preventing the market from going to new highs or going into another range or a new orbit. And that's why we are stuck in this particular narrow range for the last several months or so. And only once we see the earnings growth improve, I think the markets can go to the next level. And I'm sure the government has done a lot of programs, a lot of effort to improve the earnings, to improve the overall economic activity. And hopefully this festive season may turn out to be good. But I think that, we thought the growth in earnings would come earlier in June quarter. That did not happen. So I think investors are waiting and watching to see real solid signs that earnings are going to the next level before taking the values up higher from these levels and deploying even more cash in the market.
Okay. Deepan, the other piece that's been moving, and since the last couple of days, is insurance, right? We got a GST cut, likely nil rate on the insurance sector as a whole, which is a key positive. Of course, only for buyers of insurance who are individuals. But the other, on the flip side, we had news trickling in today from our sources which seem to suggest that there'll be a cap with regard to how much insurers can hike premiums. So there's likely going to be a cap there with regard to how many price hikes they can undertake. And that will be capped to the extent of inflation, and medical inflation in particular. And there is deliberation going on within the IRDAI with regard to that. We've seen how insurers have been able to drive up premium value, and maybe this is a risk to pricing. Your take with regard to both of those developments?
See, I think if insurance GST comes to zero, then also it's a problem, because then the GST credit cannot be set off. and that will, is another issue, and one is to really work out how much the premium will actually come down. You cannot expect it to come down by the exact quantum of the GST which has been cut. So that is one aspect. And also to an extent, I think, premium levels are not the only determining factor for insurance. I think a lot of selling has to be done around the actual reason for taking an insurance and convincing the customer that he needs this particular policy. That is one part. At the same time, anything which is done to curb the pricing power of the insurance companies will certainly be received negatively. In any case, Mediclaim and the medical insurance, health insurance is not a great profit driver for a lot of insurance companies. And if there are going to be curbs over there, then that may be even further detrimental. So on the whole, I think we are broadly neutral on insurance. It's not that these companies have been around for last 10 years or so, even more longer. It's not that they have created a great deal of value that one should look at them in extremely positive light. They are good, steady businesses. They may give returns in line with the broader market, slightly lower. They are good defensive stocks also because of the kind of business they are in. But it's not a growth business, according to me. Where from these levels, these stocks can generate 25-30% or 15 to 20% type of returns going forward.
Okay, all right. So that's with regards to where these insurance companies stand. But shifting focus to the auto space, hit brakes on your next car purchase till the next GST reforms come into place. How much will the next GST reform make a difference in your next car, and how will your next car be cheaper? Let's go across to Puneet to break down as to how much will you save on this GST cut from 28% to 18%. Over to you, Puneet.
Well, thank you for that. So it's definitely going to be the most, the biggest actually gift, essentially a pre-Diwali one to say the least for all the car makers. We've put together a list firstly of reduction of GST on some popular models. So this is not an exhaustive list, but let's go across that first. First, we're going to see for small cars specifically, models like WagonR as well as Baleno currently, taxed at 29% in terms of GST. If the rate cut is supposed to happen, it will come in at 18%. A whole 10% on 7 to 9 lakh rupee cars is going to be a big change, and we're going to get the numbers as well. Amongst others, we have seen the SUV space also getting the benefit for Dzire as well as something like a Bolero Neo, currently between 29 to 31% GST rate will reduce to 18 as well. For SUVs, they are currently taxed at 45% in terms of GST. If that is expected to be reduced to 40%, we'll see that benefit trickling down to someone like a Creta as well as a Brezza, and the XUV 700 will be, the production and the prices will come down by almost 8% because of the GST cut, and is expected to see the maximum benefit amongst the SUV makers. When you look at, the key other aspect of the comparison between the old GST rate prices as well as the new ones, and we're going to see some incremental savings on all of these. For something like a WagonR, it is going to be cheaper by almost 63,000 rupees and will now fall below 7 lakh rupees for this particular model, while something like a Baleno will now be available at just 8.14 lakh rupees, and that will be cheaper by almost 75,000 as well. When you look at the other ones, the new Dzire launched in May of 2024 will be cheaper by almost 80,000, and we're going to see a huge benefit of something like a Bolero Neo, which is sub 4 meters, so attracts the lower tax rate, as well as is a SUV in the rural space, much more very popular. We'll see almost 1.3 lakh rupees of savings because of this potential GST rate cut. Amongst the SUV makers, and these have been growing at a much faster clip compared to the overall market, we're going to see something like a Brezza and the Creta reduce prices by almost 55 to 60,000 rupees in terms of models, while the XUV 700 will be cheaper by almost 1.17 lakh rupees and closer to 20.6 lakh as well. But finally, how does this rate cut and the potential rate cut in prices of these cars impact your wallet positively? Because you're going to see the EMIs as well reduce materially because of this. We've taken a computation from this brokerage note from Nomura. They've taken basic condition of a 10-year loan at 9 to 11% and essentially come up with these calculations. For something like a WagonR, we're going to see the monthly new EMI come to 11,200. This will be a benefit of almost 1,000 rupees per month. And that is the discussion going on. The 12 to 20,000 rupees additional savings that you get every month will be helping the economy grow much faster in other spends as well. And here is that big benefit. For Baleno, that benefit is roughly about 1,200 rupees per month, while for models like Desire as well as something like a Bolero New, which we spoke about, the benefit is roughly between 1,300 to 2,200 rupees per month. Amongst the SUV makers, and here we'll see the quantum being slightly lower in terms of EMI reduction because the GST rate is being reduced by 5 to 8%, but something like an XUV 700 will finally be reduced by roughly about 1,900 rupees per month in terms of EMI. The final question though, if you've already booked a car in Q2, what should you do? It's essential that you go back to your dealer and have a conversation, because you could get some material benefit out of this, because we have the government of ministry, the GOM will already approve this one, and it will go to the GST council in the month of September. So the rate reduction is not too far away, but it's time to call your dealer if you've already booked a car, and that's about the reduction of GST on the impact on SUVs amongst other cars.
I want to lay this out. Puneet, this is fantastic work, by the way. Just want to lay it out that calling this dealer, the last piece that Puneet has added is a tip which may or may not work. So please keep that in mind. But the other pieces of research and the numbers, etc., really, really helpful. So if you're trying to think of whether or not you want to buy the car now or later, go ahead and take the decision based on the numbers. Puneet, super work. Thank you so much for this. So, I was wondering, either of you thinking of buying a car?
I was going to ask that to Puneet actually, whether he's planning to buy a car or not, considering he's done so much homework.
Actually, maybe. But no, it certainly helps and helps everybody. So I wonder, I know that Dipan is here with us. Dipan, you reckon that is the kind of behavior that could happen, that people would postpone their buying because the discounts on some of these are pretty hefty?
Yeah, I think this whole GST thing has created a big problem for a lot of consumer businesses, vehicles, and even I would say air conditioners, a lot of other big ticket items, because these are not discretionary spends. And if you know that a GST cut is around the corner, you can easily postpone it by a month or two. And the GST cut may be significant, so it's a very good reason to postpone purchasing. And existing companies engaged in those businesses have a big problem, because they have the inventory at the dealer level. What happens to all those inventory? Because on that, the GST has already been paid at a higher rate. So it is a bit of a problem. And I don't think your dealer will give you a discount or anything. You may try. These dealers, I know how they operate. You have to pay the money upfront and then get the delivery whenever it's ready. So it's a cut and dry deal. But yes, I think it's going to be a problem in the interim. No doubt, long term it is great. But one-time damage can certainly come to the profitability of these companies, and that may be visible in the September quarter also itself.
Kunal, any thoughts on buying cars, and any thoughts on either buying or selling the stocks of some of these vehicles for trade? Both.
Yeah, I think firstly to buying cars, I've been looking out for buying a car since the month of January, February. Have not finalized on anyone. Still confused on that front.
Wait for a month and a half, I guess, now.
Yeah, exactly. That's why I hope my wait was useful for me. So firstly, on the auto packs, recently we at Sher Khan had come out with a festive pick, and that is where we picked up Bajaj Auto there as an buy. So Bajaj Auto for us on the technical charts, it looks really attractive to us. Already it had corrected sharp from the higher levels, and now we expect this correction to get over, and we see a next leg of up move that will begin. So Bajaj Auto is one which is there on the buy side for me, and any dips would be a buying opportunity. We have kept a target of 9,300 to 9,800 on the upside, and we expect this momentum to catch up in the next 3 to 4 weeks.
Okay, let's also zoom out a bit and take a look at the sectoral picture for autos. What's being penciled in, and which are the companies that could benefit if these GST cuts actually kick in. Listen to a word coming in from research analyst Mumukesh Mandlesha from Anand Rathi with regard to the views coming in on the auto pack.
So on the packing order, I think the Maruti and Hero could be the bigger beneficiary as they are more exposed towards the entry segment. and a 10% reduction on GST. And then obviously there's a tax on tax of road tax also. So so it's a good reduction for the small cars and entry two-wheeler segment. So but overall, I mean, the whole PV segment and the two-wheeler segment would benefit. And then CV segment, it could be a partly where there are some truck operators which takes the input tax credit. Then for them, it would not be a major change. And tractors also could benefit with the reduction in the rate. With the higher exposure of Maruti towards less than 4-meter vehicle, that segment could be the major beneficiary.
Okay, we also had the chance to interact with former FADA president, listening to, and he predicted that the proposed GST cut from 28% to 18% on small cars under rupees 10 lakh will actually reduce prices by approximately a lakh or so. Listening to what he had to say.
Currently, the vehicles are being taxed at what, 48% or 50%. So 28 plus 20% cess or 28 plus 22% cess. And all the premium cars or even SUVs are being taxed at that price. If it comes down to 48% to 10% for a 10 lakh car is also a big amount. It is 1.5 to 2 lakh rupees. And if you talk about Mercedes or Jaguars or all those, you're talking of a huge amount of benefit being passed on to the customer. So it's just not entry level. No doubt entry level will get a push, like Sir said, because for the past 2, 3 years, 4 years, we are seeing entry level not getting that tandem because of the price increase which we have seen because of the regulations and the product change. With this 10% reduction, anything which is 100cc motorcycle or a car which is below 10 lakhs will obviously get that push when they get a benefit of a lakh or a 20,000 in the two-wheeler segment. But this will affect the auto industry on the whole. The growth, what we were talking in this financial year, that it will be subdued or it would be a low single digit. I feel we can expect a better thing, better number in this financial year because of this GST cut.
Okay, so you know, if you look at what's happening in the markets right now, quite a bit of pressure coming in during the close of trade. And the mood a little somber more than anything else that we are seeing. Just wondering if you're going to see some action at least due to this nifty rejig. Now, what's expected is that Indigo and Max Healthcare could enter the index. Not that you've been seeing too much action in them. Let's pull up what's happening with an Interglobe and a Max Healthcare in terms of their stock prices. They are supposed to be replacing a Hero and an Indus Ind. This is Nuvama's bet, by the way. Nothing that has been said so far. There's a meeting on today and then we'll know what exactly comes out of it. No action at all, even with those passive flows possibly coming in for both of them. You could also see the inclusions of Solar Industries, Mankind, Siemens Energy, Hindustan Zinc or Union Bank. Likely exclusions from the Nifty Next 50 would be Indigo, Swiggy, Dabur, ICICI, Pru. Having said this, I think BSE is another stock that we should talk about because there was a lot of speculation about whether BSE would make the cut in this nifty rejig, but that view seems to be unchanged. In fact, a UBS note which came in about 24 hours ago on BSE continues to see some pressure in that stock as well. And Deepan, I'm going to come to you. Just to talk about what you expect to see from these capital market plays and BSE specifically.
No, I think that certainly it puts a cap on these stocks, and SEBI is taking very proactive measures to curb volatility, to curb volumes in the FNO, and that's going to impact discount brokers. It's going to impact the exchanges as well. NSE, although unlisted, also value will get impacted, and this is going to be the way going forward. You know, I mean, then end of the day, the growth rates will be determined by the growth in the capital market, the cash market, new listings. And that's a more sedate growth as compared to the growth they were getting in FNO volume. So it's negative, and it's not that these stocks are really cheap. BSE is pretty expensive, trades at very rich valuations. Angel broking are sensibly moving away from trading and more into mutual funds, wealth management. So this may be like a one-time hit for them, but long-term prospects are great. So I would say that I would like to be a bit cautious on these capital market-related stocks, NSDL, CDSL included over there, and focus more on the wealth managers I think they've done a great job in terms of managing people's wealth and even rewarding shareholders through excellent returns. So likes of Nuama, 361, Anand Rathi, I think they are the top picks within the so-called financialization of savings investment thing.
No, that's true. What's really also hurting today are financials. And ahead of the whole Jackson Hole speech that we'll have to look out for, Deepan, is there anything that you would pick up here? Because your leading private sector banks are seeing quite a bit of pain today.
Yeah, see, Tamanna, the biggest disappointment were the banking sector in the June quarter. And I thought that interest rate cuts and overall improvement in business activity would lead to better numbers. I genuinely thought that the provisioning requirements would flatten out or at least move in tandem with the pre-provisioning profits. That has not happened. So I'm getting a bit skeptical on the banking sector. It's becoming more and more of a red ocean, and lending in a sensible way is getting very difficult. So I would like to be neutral rate, but banks are such a large proportion of the Sensex Nifty that you really just can't avoid them. So one needs to be a bit cautious and selective. I would say that one should go for the public sector banks. I mean, after so many decades, I feel that they offer better risk return profile than the private sector banks. Their market share now has stabilized. It's not that the HDFC and Axis banks are gaining market share at the expense of PSU banks. And in a lot of other parameters, they have done a good catch up, financial as well as qualitative. So I would say that within the banking space, preferences for PSU banks, but overall view on banks is a bit cautious.
What about, let's get the technical view on this as well, Kunal, on private sector banks and ICICI, HDFC, Axis.
I think definitely. If you look at the private sector banks, specifically Axis Bank, the pullback what we had got in this rally was really not much. So clearly we can witness a relative weakness in Axis Bank, and probably we could be heading to further lower levels on the downside. So that is on the bearish side. The resistance for the stock is at 1100, and the swing low what we made a few days back was 1050. So this is a broad range for the stock, and we expect if the breakdown comes below 1050, this could lead the stock towards 960, 980 as well. So probably some pain point which is still left in the private banks, which definitely is reflected in the Bank Nifty, and that is the reason why Bank Nifty has been underperforming. So there could be more pain point. Once Bank Nifty breaches 55,000, expect further correction in stocks like Axis, HDFC, and ICICI.
Okay. On to now the bull versus bear segment. Today we're talking about Divi's Lab. The stock is trading up a fair bit, about 2% in trade actually, on the basis of a Citi note. What is the bull case, Varsha, and of course the bear case as well?
Yeah, thank you for that. As you mentioned, yes, the stock is buzzing on the back of Citi's note. So let me start with that. You see, according to Citi, now considering Divi's valuation, so they find it attractive, and the concerns over the patent issue of hard drug Entresto now are over, and this is one of the reasons why a bull case for Citi. But onto the bear case. So Divi's, if you see the business model of Divi's provide API to the innovator companies like Pfizer and big innovator companies. If innovator companies start making an API in-house, that would be a bear case for Divi's. But moving on. The next bull case when it comes to Divi's is the GLP product. Now in the con call, Divi's has mentioned that they are going big when it comes to GLP-1, their anti-diabetic and anti-obesity drug. And the Eli Lilly's Mounjaro product is expected to double their sales by FY30, and Divi's will have a massive opportunity there because Divi's is also planning to make or to manufacture API for these anti-diabetes or anti-obesity drugs. But failure to scale up the GLP-1 drugs or failure to scale up the production of these drugs is the bear case when it comes to Divi's. But moving on, the other advantage that Divi's has is the 700 crore capex that they have done, plus new launches when it comes to custom synthesis, and also the contrast media itself, which is growing into a double digit, is one of the advantage that the Divi's has. But again, lower than expected because market is actually betting on their custom synthesis
the new launches and contrast media, if DVS is not able to scale up that production, it will have a massive hit on their financials and of course on the valuations. Moving on, the next thing is the benefits from, so DVS is one of the companies which will of course benefit from China 1+ strategy, but the persistent supply chain issues and logistic disruptions and of course the pricing pressure that the generic segment has seen, and management has also said in the con call that they are also figuring out when it comes to pricing pressure, when it comes to generic products is one of the disadvantages that the company has. So overall, because of the tailwind in the sector and of course the attractive valuation is what driving the DV stock price as of today.
Okay, so Divi's, there's this bit about GLP-1 and you mentioned that in your bear case, Varsha. I reckon that's going to be a possible bear case for a lot of companies because the flux of companies coming in with those GLP-1 products. Now, how many of them are going to work? How many of them won't? Is this going to be a fad? Is there going to be down the line suddenly some big side effect that people discover? I think it's a bit of a risk and it's a risky bet because so much of the street has bet on GLP-1 being the next big thing. It can't be the next big thing for everyone. Yeah?
Well, arguably that seems to be the right point. Now, but who wins therefore is a what, $1 million question, or maybe slightly more than that in terms of gains. But yeah, pertinent point. Everybody can't be the winner.
Yeah. I wonder, Deepa, if you have a view over here, who do you think will come out on top in this GLP-1 race? And how much of the pharmaceutical industry can go after? Yes, obesity seems to be the biggest problem, but how much of the pharma industry can go after that part of the pie?
I think a lot of Indian pharma companies are chasing this particular opportunity. Some CDMO player also, like I think OneSource is targeting this particular opportunity. I'm sure that as and when the drugs over the molecules over there go off patent, Indian companies will be the first off the block to try and get that particular sales going, and certainly I think it improves the overall market for Indian generic drugs. So I think it's generally positive for Indian pharma companies. But look, the problem is with these Trump tariffs. Who knows what's happening next? I mean, I never thought in my wildest dream that India would be taxed at 50%. There was a time when markets were factoring in kind of a 12.5-15% type of a tariff, and that we amongst the most favored, and therefore business from China would come to us, and this China plus one strategy would get stronger. But now with 25 and another 50 coming in a week's time or so, another 25 coming in a week's time or so, I think all export-oriented businesses, including electronics, including pharma, we need to view with a bit of skepticism. Tomorrow, who knows if there's even a 5-10% tariff on pharma products, it's going to impact the Indian pharma companies quite severely because it's a very price-conscious product. So I would just wait and watch for Indian pharma companies for the time being and maybe look for other opportunities.
Yeah. Okay. Right. Okay. Thanks, Dipan, for joining us. We'll let you go on that note. And what we'll also do is we'll slip into a very, very short break. On the other side, we'll get you stock of the day. And we'll get you buy today, sell tomorrow picks as well. Stay with us here on NDTV Profit.
जब मुंबई से वापस कोल्हापुर शिफ्ट हुआ तो सबने कहा कि ड्रीम सिटी को छोड़ रहा है। ड्रीम सिटी तो मैंने कहा ड्रीम में तो यही गलियाँ आती हैं। तो जब ये रियलाइज़ हुआ कि कुछ बड़ा करने के लिए बड़े शहर में रहने की ज़रूरत नहीं है, तब लगा कि लाइफ में ग्रो किया। कशी ताई, ऐसे बॉय मिलते मुंबई में? चांस ही नहीं।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're
Yeah.
going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders
Back with India market close right here on NDTV Profit. Remember, I mean, select buckets have come off quite a bit. There are individual pockets which might be doing well and perking up. A KSB, for example, has inched up in the last, whatever, half an hour, 45 minutes, 1 hour of trade. Aditya Infotech, another 6.5%. Remember, this is a new kid on the block, listed 2 days ago and has had a spectacular uptick today. Nectar Life Sciences had a bit of an up move. So there are a few stocks which are doing well, but by and large, we're having a quiet day of trade with now the Nifty trading at the lowest point of the day. Forget 25,000. We are now 24,875. Now we are closer to that 24,800 mark that we were talking about. And we'll talk about it in detail as well. But let's talk about the stock of the day. And we're talking about our systems. It did really well. We spoke about it in the morning on the 9 stocks that the 3 of us highlight as well. But now, the detailed piece around our systems. Anushi joins in with all of that. Anushi, good afternoon.
Good afternoon, Neeraj, and thanks for that. So, our Systems International in focus on the back of the acquisition piece that we are looking at, the street taking it in a positive manner as reflected by the stock performance that we are seeing in trade today. Now, what is happening over here, if you are looking at now, the company has made a 100% acquisition in Novigo is the news update that we are looking at. The company, this is an IT services provider that we are seeing in the digital and the product engineering services segment itself. So, how does the company benefit from this? Novigo, if we see, has a revenue of 264 crore and this is with a 25% of a margin that we are looking at. So considering this, you know, there's a 15 to 16% of an incremental revenue consideration that we are looking at. So overall, the consideration size for this is also 400 crore, which is about 6 times its adjusted EBITDA value. Why is this acquisition beneficial for our system is now the question. Now, Novigo, if you are looking at, is growing at a 44% of a revenue CAGR, and this is over the last 3 years period itself that we are looking at. Even in terms of it, if you look at its EPS performance, it's expected to be EPS accretive from the first year itself. So that is a benefit that we will see flowing for the company as well. You know, with the 400 crore of acquisition value that we are looking at, the future performance in terms of more stake that also we are seeing is based on the EBITDA performance of the company as well. Now there are multiple synergies as well in terms of the geographical presence. They will be able to expand their presence in Middle East as well as select pockets of southern India as well. So that is another benefit that our systems would benefit from this particular domain. Now delivery expansion in southern India is also what we spoke about. Now Novigo's team will also continue to be a part of the combined platform. That's the plan ahead that we are looking forward for this as well. So in terms of financial benefit, if you are looking at now, our system it has an annual revenue which will rise to 2,061 crore, implying about a 15% of an increase going forward. So that is one benefit in terms of financials going forward. Even if you look at the combined compounded growth, that is expected to be 17.3% as compared to the 14.3% that we have seen. Even the acquisition now in context with the acquisition, now acquirers came out with a note wherein they've maintained their long rating with a target price of 484. They believe that this acquisition is to be accretive in terms of revenue going forward for the business. Nearly 15 to 16% is kind of the upside potential that they see based on their quick calculations as well. Acquisition of Novigo will also enhance the system's capabilities going forward, which relates to a couple of areas that we are currently seeing. So 2-3 benefits from there as well. It will enhance their niche software product engineering as well. That's one select bracket that we are looking at. Acquisition to aid the agentic AI domain as well for the company. So with this, they've also raised the multiple that they've given for the stock. And the Middle East expansion is also something on cards for this one. So this is the stock in focus today, and this acquisition will play out in terms of where the revenue upside is for the business going forward.
Okay, thank you for that, Anushi. So our system stock of the day, I think another candidate, not quite for stock of the day, but definitely one which is revving up today, is Vodafone Idea. I want to look at what's happening with Vodafone and with Indus as well. And this is, just because of reports that the DOT is looking at possible waiver of AGR dues, even for Bharti Airtel. Actually, you're going to have quite an up move and an advantage for both those stocks if that's actually what happens. Let's pull up Bharti Airtel for a second. That's pretty much flat because Vodafone Idea needs that reprieve more than anything else, I suppose. Nearly an 8% gain as sources tell NDTV Profit that the Department of Telecommunications has escalated Vodafone Idea's and Bharti Airtel's pleas for adjusted gross revenue relief to the PMO for a final decision. My colleague Ashwarya Patil joining in with more details.
Well, what we're picking up currently is that the Prime Minister's office will be reviewing latest documents and a plan that the DOT has put forward, a proposal as far as the AGR dues are concerned, relief towards Vodafone Idea as well as Airtel. That is being reviewed by the PMO is what we're picking up from our sources. Now, if this plan is approved, what is on the cards for both these telcos who have massive amounts in terms of AGR dues? As far as Vodafone's AGR dues are concerned, that is likely to be reduced to about 28,000 crore rupees from the current due of over 83,400 crore rupees, while Airtel's AGR dues, those currently which stand at about over 42,000 crore rupees will be reduced to about 10,000 crore rupees, is just one part of the proposal. Apart from that, DOT has also pitched a relief plan as far as the penalty and interest on penalty is concerned for both Airtel as well as Vodafone, so as to restructure and take a look at how that can also be extended in terms of moratorium as well as interest payments. That will also be reconsidered by the PMO is what we're picking up from our sources. PMO may consider about 2 to 3 options, especially for Vodafone Idea. Now, overall, if we talk about Vodafone Idea's debt in total, that stands at about over 2,14,000 crore rupees in terms of payment obligations towards the government, of which about 83,000 crore or so is in terms of AGR. And that's the update so far. We'll keep you posted as and when we hear about what steps the government will take going forward to give relief to both the telcos, Airtel as well as Vodafone Idea.
Okay. All right. Neeraj Devan joining our conversations this afternoon. Kunal Shah, of course, still with us. Neeraj, very good afternoon to you. Just, what are you making of Vodafone Idea? This is the standard, I think, trigger for the stock, that there's going to be some big grant coming in from the government yet again. Is this a story that you buy into right now? If you hold the stock, would you exit?
Yeah, I think, good afternoon. I think that if based on this story, you see an uptick in the stock, I think you'll get an opportunity to exit the stock, because generally, even if you take out the AGR dues, it's still a very heavy balance sheet, so much debt on the company. They're losing subscribers. Even in that front, they're not improving. So there's nothing operationally which I feel makes a case for one to stay invested in Vodafone. So I've been avoiding this stock, since last so many years. I think I'll say the same, that you are still holding on to it. If you get a pop-up because of this news flow, I think you should use this opportunity to exit.
Okay, use the opportunity to exit. Kunal, you agree with that thesis?
Yeah, I think, definitely. Even on the charts, if you look at, I think whatever bounces you will be getting, that would be a good opportunity to exit the stock. The stock, again, has seen some buying interest from the lower levels, but this pullback in the entire downtrend could go towards the mark of 8 or 9, but that could be a good level to exit the stock.
Exit the stock. Okay, not surprised.
This is one advice no one listens to. Everyone comes and says, exit the stock. There is some inherent faith people have in the Vodafone stock.
In the recovery of Vodafone at some point of time. Light at the end of the tunnel.
It's saying, apna time aayega, and that's going to happen for Vodafone.
But the beauty is, and you rightly put it, if we can pull up the 5-year chart of a Vodafone versus an Airtel. And for the longest time, people have waited for apna time aayega, or apna time Airtel mein aa gaya hai. For the last 5 years, just look at comparative for both and you will see the difference. Just the kind of wealth that has been created in Airtel over 5 years versus what's happened in Vodafone. Somehow the quest for trying to buy the cheaper alternative has not quite paid off. But Neeraj, the third largest market cap, Airtel, or an Indus or something, would you go out and invest there? Or if that's too expensive now?
Yeah, I think if one is a long-term investor, even at these levels, one can invest. But then you're talking about 2-3 years. You should not be in a hurry that you invest today and get returned in 6 months, 1 year. But for a long-term investor, I think even at these prices, one can enter, because the company has proved themselves. The kind of improvement they've shown in the balance sheet, the performance, it's improved over the year. So I think that performance will continue improving there. So for a long-term investor, I think like we say for other stocks, like other sectors, Mahindra & Mahindra or a TVS, the kind of performance they've been showing, Bharti is in the same league as far as telecom is concerned. I think for an investor, it will still make sense to get into Bharti even at this rate.
Okay, get into Bharti even at this level. All right, what's buzzing this afternoon? Let me go across to Vansh, who's telling us about the buzzers, top 3 buzzers really this afternoon. Royal Orchid, Texmaco and Eclerx is what you're talking about, Vansh.
Yeah, so let me start off with Royal Orchid Hotels. Now, the company has announced the opening of the new hotel called Regenta Place in Ahmedabad. Now, it's a 48-room hotel, and now the company operates 16 properties in Gujarat along with this. Now, the company has also committed for a future expansion in Gujarat in less than 2 years. And if I talk about the financial performance of the company, the PAT for the company has been up by 28% on a year-on-year basis. And if I talk about the operational metrics, now the average room rent for the company for their hotels is up by 6% on a year-on-year basis. And the average occupancy for them stood at 69%. Now, if I talk about the 2030 target, now the company is targeting to tripling its hotels from 115 to 345 hotels by 2030. In terms of guidance, the company has guided for 100 crore revenue by FY26. Second on my list is Texmaco Rail and Engineering. Now, the company has been awarded a 103 crore order from Leap Grain Rail Logistics. Now, the order is to supply bogie-covered hopper grain for food grains and a bogie brake van. Now, the order is to be delivered within 10 months. And third on my list is Eclerx. Now the stock is already down 2.5% and now the Kotak has come up with, Kotak has initiated the coverage and they have also reduced the target price to 4,000. The brokerage believes that the leverage in the delivery can lead to the healthy growth for this particular counter, and they have forecasted the constant currency revenue to grow at about 12% and they expect a 150 basis point margin expansion over FY25 to FY28. So these are some of the stocks that are buzzing in trade.
Okay, a lot of action that is taking place in the last few minutes in terms of news break as well. We're learning that RBI has approved the nomination of Indranil Bhattacharya as an ex officio member of the MPC. There's going to be a rejig in the MPC, so that is important as well. That's the other one that we are breaking right now with my colleague Charu. SEBI panel may propose cap on big intraday bets is what we are learning. SEBI's secondary market panel has proposed a 1,500 crore cap on intraday index derivative trades. This follows SEBI's scrutiny of Jane Street. At present, there is no limit on intraday. Exchanges have been asked to monitor big intraday trades closely. Sources say SEBI is also looking at broker level limits. That's important. Of course, we had earlier reported that these positions were under review, and this is what you can, possibly see panning out now when it comes to intraday trades. We spoke a little while earlier about BSE, Angel One, etc., and the capital market space. This is clearly something that the regulator is very happy to go after. So, one space you need to watch out for. Okay, Neeraj Devan, just quick views coming in on what we're reporting this afternoon, and we'll get Charu in just about a minute for more details on it. But we already saw some action of this coming in with SEBI indicating that they want to change the frequency of expiry from weekly maybe to once in 2 weeks or something like that. Now we're talking about caps also of intraday trade.
I think definitely all this will impact the volumes because if you see last couple of years or 3-4 years, the volumes had gone up a lot because of the weekly expiries. Earlier they've limited it to one per exchange. Now they've put a further limit or make it fortnightly. But it will definitely impact the volumes on stock exchanges and for the broker. So let's see how it actually comes because still there are proposals. What actual shape they take will depend on, I think, a lot of representation by the, by the broker community, by the exchanges. So let's see what finally comes out of it. But if this is what they are planning to do, a broker level limit, an intraday limit, and reducing the number of expiries, the volumes will definitely get impacted on the exchange.
Charu's joining in with more details. Charu, at what level or what stage are these proposals?
So, as NDTV Profit reported exclusively on the morning of August 19, a meeting was held with the Secondary Market Advisory Committee of Securities and Exchange Board of India, and the members were juggling with a lot of proposals. One of these proposals was to, reintroduce the topic of intraday position limits. Now, currently there is no limit on these intraday trades. However, SEBI is looking to get into this again after the Jane Street saga. So, to sort of control and curb proliferation of any sort of market manipulation and to protect the innocent investors, SEBI is sort of thinking if some, limit on intraday positions can be brought in. Now, this is something that was also brought in as a suggestion while the open interest calculation consultation was brought in 2 to 3 months back. However, when the final circulation on the same came out, intraday position limit suggestion was dropped because of the market, sentiment and the market suggestions that were sent in response to that proposal. However, it is being explored again, and we'll get to know as to what developments take place further. The limit that is being considered currently is about ₹1,500 crore.
Okay, this is Charu, thanks for that. And this now is becoming a bit of a predictable piece that wherever there is a measure or a move happening which involves the really big fish, which could lead to, for lack of a better word, manipulation of any fashion, SEBI is clamping that down.
Yeah.
And
aggressively.
Very aggressively. And no measures held back. So I think that's interesting. I wonder if this further quells the earnings projections for high frequency brokers and exchanges, etc. And does that hinder the near-term earnings multiples for these businesses? Neeraj Devan, and it's fine if it happens because you ultimately want to protect every consumer in this or every participant in this long chain. But I wonder, this whole piece that is happening, do you reckon that stocks like NSE, BSE, or NSE is not a stock, but well, it kind of gets invested and traded on the private markets like a stock, or a Angel One, etc., could all come under a bit of pressure?
Yeah, I think we already saw some pressure coming in also yesterday. in some of these stocks like Angel One or BSC, I think there will be near-term pressure on their earnings if all these measures are brought into force, like lesser expiries and even intraday limits. If all these things are brought into play, then they will get impacted for a shorter term. Though, over medium to long term, the volume in the, I think, monthly will improve. So slowly things will get averaged out. But initially there's going to be some disruption there. So one will need to work out on the valuation that you've been taking for the current year or the next year on some of these brokerages and the exchange.
Okay. Kunal, we want your closing strategies, but just a word on BSC, on Angel One, the two stocks that really cracked earlier this week.
I think overall the trend continues to be on the negative side. I think there's still further downside left here. So firstly, I'll talk on BSC. BSC, I think still there's a potential that the stock can go towards the mark of 2,000, 1,800 on the downside. So even from the current level, a good 10 to 15% correction could be seen in the very short term. Angel One as well, I think here the stock is already trading in a big downtrend, and we can expect this correction to go further on the downside. I can expect the stock to test the levels of 2,300, 2,325 on the downside.
Okay, let's quickly pull up Edelweiss. Edelweiss under some pressure after the announcement that Westbridge Capital is picking up a minority stake in Edelweiss. I think the valuation that has been assigned is something that the street is not perhaps liking at this point. So you're seeing some issue over there. They're acquiring a 15% stake in Edelweiss Financial Services Limited for a consideration of 450 crores in Edelweiss Asset Management Limited. That's the announcement has been made by EFSL. So you are seeing some pressure over there. So the note says a current transaction values a business at 57 times PE, which aligns with industry benchmarks of 30 times to 60 times. I don't know if the valuation is the concern that has got the stock pulled down or what it is. One pocket of weakness there. Cement is the other pocket of weakness that I'm seeing very, very clearly coming in. And you look at the mid-size cements, look at a Ramco right now, look at a JK Cement, all of them seeing a bit of weakness there coming in. Just your thoughts on both of these, Neeraj and Edelweiss. Let me start with that deal. Have you had a chance to look at that deal at all?
No, I have not actually. I don't track Edelweiss, so I have not looked at the deal.
Okay. And what about your mid-cap cement? I mean, the street's favorite for the longest time, but seeing some pressure. I don't know if it's a GST concern or what we're seeing, because you already saw them run up on GST rates coming down, and they'll come down significantly if they do on cement, because you're going to go from 28%, even if you go to 18%, that's going to be a huge, huge reprieve. But today, we're even seeing an India Cements doing badly, a Ramco, a JK Cement, all of them seeing some profit booking here. Is that what you put it down to, Neeraj?
Yeah, I think it's profit taking, because even before the GST news came in, cement stocks were doing well. So there was expectation that demand is picking up now and will be very good for the rest of the year. After the monsoon season is over, the kind of order book with most of the infrastructure companies also declared, and kind of project launches that real estate companies have. So there's expectation that cement demand is going to pick up. So the stocks were already doing well, and with the GST news coming in, there was again a feeling that GST will come down on cement, and that will also impact their volumes. They should go up going ahead. So all that really created a short-term moment in the stock, most of these stocks. So I think the stocks had touched 52-week high, close to that, some or most of them. So I think there is some profit taking which is happening. I'm still positive on this segment. I think I also believe that second half will be very good for the cement companies, and they'll also be able to maybe increase the prices, excluding the GST cut. So I feel that I think this is an opportunity, and this is just a profit-taking phase which is happening right now.
Kunal, let me come to you with regard to an ABFRL. Okay, before that, your top BTST idea, Kunal. Let's get that out of the way.
I think here I'll be focusing on the pharma space, and my pick would be Torrent Pharma. Good reversals on the technical chart, strong buying interest from the lower levels. We expect this move to continue on the higher end. So Torrent Pharma would be a buy from the current levels for targets of 37.20 to 37.50, and one can keep a stop loss of 3645 on the downside.
Okay. Torrent Pharma there on target. I also want to look at Reliance Industries that's feeling a bit of the heat. Asian Paints among your nifty top losers, those are the ones which are seeing some pain over there. Any buys at these levels that you're finding interesting, Kunal?
Buy for me on dips. The support for Reliance is at 1400, 1390 zone, and we are near the support zone. So I think that would be a good buying opportunity. I'm expecting Reliance again to resume the rally towards 1450, 1460 on the higher end.
Okay, thank you so much, both of you gentlemen, for joining us this afternoon. We'll let you go on that note, and we're just a minute and a half from close for the day as well as for the week. Let's look at where the Nifty is stacked up. At close, nearly 1% lower, in fact, 0.9% lower. 24,900, well taken out in that sense. Let's look at the intraday chart as well. That'll give us a good sense. Of course, banks were one of the culprits in trade, 1% lower on the Nifty bank. But we've still landed up closing at the day's low, so it's not looking as pretty. Let's look at it for the week as a whole, and that'll give us a better picture of how the week has played out. Well, it's not been as good. We've largely traded in a range, and we've actually, due to today's near 1% fall, we're down in fact for the week gone by. So it's not been the best week there. Let's look at the heat map on the Nifty, and that'll also give us a picture of how sectors have played out today. But the breadth has been extremely tough on the Nifty, and that is evident. A few names, especially in maybe an auto, Maruti is there, M&M is there, Bajaj Auto is there, probably dominate that list of stocks in the green, but really it's so marginal that there's just no strength there. Among the losers, well, it's a broad brush, so really no specific stocks there, but you will see IT names, you will see banks, so some of the financials, IT, and a couple of auto names also there. A Hero is sitting there in the top 5 losers of the day. So broadly, that's how it's playing out. Let's look at sectors. That'll also give us a sense. The Nifty India Defense is up 1/3%, so is the Pharma Index. But outside of that, broadly, it's red. Nifty Auto, just a slight negative bias, but it's metals and banks which have been the culprit today. Metals, even FMCG to a certain extent, 1% lower on the Nifty FMCG index as well. Realty also within broader markets is down around 0.9%. IT is down 0.8%. Let's look at the advanced decline. And that too will try and get the texture. There you go. Not looking pretty. It's one of those days where we've seen the declines outstrip the advances. Not seen that too often this week, but nonetheless, that's the case. Let's pull up the Nifty mid-cap and small-cap index as well. Let's see how those have performed. Well, 1/4% lower. We've largely held, again, a good range all through the day, but we've slipped at the fag end. Let's look at the Nifty small-cap. There you go. And that too around 1/5% lower. So some outperformance seen in broader markets. Can we look at the week-to-date numbers on both the Nifty mid-cap and small-cap on how the week has gone by? Well, flattish. Okay, percent higher on the Nifty mid-cap, so that's a key positive. And the Nifty mid-cap, please. The Nifty small-cap 1.2. The Nifty mid-cap also nearly 1%. So some bit of green on your screen where broader markets is concerned. So you've seen a bit of an outperformance there. But that's a wrap for the week, frankly. Let's look at the BSE 500 top gainers, top losers before I hand it over to what we could be doing over the weekend. Well, that's broadly some of the names. None of those really stand out. AB Fashion, some amount of a good volume leading to that 7% uptick that we saw on the stock. But let me bring in Shreyanshi. She takes us through what you can be watching out for this weekend. And I certainly watch out for this segment. So, Shreyanshi, over to you.
Well, absolutely, so there are no big ticket releases this week, but that doesn't mean that you can't be booking your tickets, because there's a couple of movies that we should be looking at. Let's take a look at the entire list of movies. Of course, you do have Coolie the Powerhouse. That was made with a budget of 350 crores. That's the one that's managed to rake in 230 crores. that's one movie that you can be looking at. We'll also be going through the reviews, but for now, let's also take a look at War 2, because that was also a big budget movie made with a budget of 300 crores, has just managed to rake in 200 crore rupees, because there's a lot of competition coming in between the two movies. Of course, you have, in terms of reviews, there are no points for guessing that Thalaiva's gotten rave reviews when it comes to Coolie the Powerhouse. So it's packed with energy, it's got a mass appeal, and those are some of the reviews, but there are no fireworks when it comes to the collections, and we'll go through those collections also in a bit. But lukewarm reviews for War 2 as well, because one review that I in fact really liked was that the movie has, it's gone on a world tour, left the story behind. So those are some of the reviews coming in for War 2 as well. Let's quickly take a look at some of the top performers when it comes to Thalaiva. There's 14 crore rupees being raked in by 2.0, Jailer that managed to rake in 345 crores. And against that, Coolie at this point in time compares with that 230 crore thereabout collection for the blockbusters. But let's see how it pans out for the rest of this coming week as well. But Peacemaker Season 2, John Cena is coming back with this one. Jio Hotstar is where you could be watching this one, so keep an eye on this one. Other than that, this of course is the season 2, so let's see if fans can make peace with the ending of the first season. But this one is the one that I really like, because Map That Leads to You is a very interesting rom-com that you have. Prime Video is the one where it's released on August 20th. So this is the one to watch out for. One review that stands out to me is that this is Ye Jawani Hai Diwani with a visa. So if you are in the mood to watch a travelogue, this is that was the one that you should be looking at. And Invasion Season 3 is the one that's releasing on Apple TV Plus. So this is quite underrated. If you're in the mood to watch something and catch up on the previous seasons and watch something new, then Invasion Season 3 is what you should be looking at. But with that, thank you so much for tuning in.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Ganesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahuguna. Now let's get straight to the show. So viewers, Indian benchmark indices took a hit today, erasing this week's gains with cuts nearly 1%. The Nifty wrapped up trading at approximately 24,800 levels, while the Sensex concluded at around 81,200. However, broader markets defied this trend, outperforming both the Nifty and Sensex on a weekly and intraday basis. Mid and small cap indices were the bright spots, surging over 2% this week. And on the flip side, HDFC Bank, Reliance, ITC, ICICI Bank and TCS were the major contributors to today's downward pressure. Despite this, the overall sentiment remains cautiously optimistic, with investors eyeing benefits from potential GST reforms. Most sectors ended in the red zone as Nifty Metal, PSU banks and FMCG led the decline. Media, pharma and defense were the only sectoral gainers in trade today. However, auto, realty and consumption clocked the highest weekly gains. Just over a quarter of stocks ended in the green, wrapping the market breadth in favor of the bears. And on to our topics closer today. Market regulator SEBI has turned its attention to finfluencer Avadhoot Sathe, with sources suggesting that illegal gains from his operations could be between 400 to 500 crore rupees. SEBI was reportedly on the verge of releasing an order against Sathe before deciding to conduct a more detailed inquiry. The investigation is expected to scrutinize Sathe's activities very closely. The US and European Union revealed fresh details about their trade framework, including on hotly contested and anticipated pharma and semiconductor tariffs. After weeks of heated negotiation, Brussels and Washington finally arrived at a trade agreement late last month, setting out 15% blanket tariffs on EU exports to the US. Under the deal, the EU also committed to purchase $750 billion worth of US energy and invest at least an additional of $600 billion in the US. Our Systems, a leader in digital product engineering, has announced the acquisition of Novigo Solutions, which is an IT services provider specializing in low-code or no-code and intelligent automation, for 400 crore rupees, valued at 6 times Novigo's adjusted EBITDA. So Novigo, with 264 crore rupees in revenue and 25% EBITDA margin, has achieved a 44% revenue CAGR over the past 3 years. Now, the deal is funded partly by 275 crore rupees in the non-convertible debentures at 1 lakh rupee face value via private placement basis, and that also makes it the stock of the day. Apollo Microsystems stock soared 24% in the past month and 97% year to date, driven by its selection as the lowest bidder for 25.12 crore rupees orders from DRDO and defense PSUs. Now, the company, which is a key player in defense electronics, expects robust revenue growth of 45 to 50% CAGR over FY26 to 27, which is fueled by a strong order book and production ramp-up. Management anticipates margin expansion in H1 FY26 due to improved operating leverage. PTC Industries has secured a 110 crore rupee order from BrahMos Aerospace for the supply of critical titanium castings essential to BrahMos missile programs. Now, the order is scheduled for execution over 24 months, deepening a partnership that dates back to 2019. PTC is a leading manufacturer of precision metal components for defense and aerospace applications. Now, with a strong domestic and international footprint, this contract reinforces India's push for indigenization and technological self-reliance under the Atmanirbhar Bharat initiative. The company recently reported a 5.3% rise in the net profit with strong sales growth in Q1 of FY26. Texmaco Rail and Engineering Limited has won a 103.16 crore rupee order from Leap Grain Rail Logistics Private Limited to supply bogie-covered hopper wagons for food grain and a Type C bogie brake van. So the order is slated for delivery within 10 months, reinforcing Texmaco's presence in India's rail freight logistics sector. Now, this domestic contract highlights growing demand for specialized freight wagons and, in the agriculture supply chain. The company emphasized that neither promoter nor related parties have interest in the awarding entity. The order win boosts Texmaco Rail's order book and revenue visibility for the near term. HG Infra Engineering subsidiary, which is HG Narol Sarkhej Highway, has secured a 781 crore order to upgrade a key 10.63 kilometer stretch of National Highway 47 from Narol Junction to Sarkhej Junction in Gujarat. Now, the project involves upgradation of an existing 6-lane road, including construction of an elevated corridor. It will be executed under the hybrid annuity mode, commonly known as HAM, with a construction period of 30 months. Now, this order adds to HG Infra's robust 14,656 crore rupee of order book, highlighting the company's growing footprint in infrastructure development and highway construction across India. Citi has raised its target price for GMR airports to 103 from 90 rupees, maintaining a buy rating. The brokerage highlights a robust mid-term international traffic growth outlook driven by resumed China-US flights and Indigo's Airbus A350 orders. Now, additionally, Citi sees potential upside from Delhi's commercial land portfolio, enhancing the company's long-term growth. So GMR stock is expected to maintain positive momentum into calendar year of 26, supported by air travel demand and real estate monetization. L&T Finance has partnered with Google Pay to offer personal loans, aligning with its product diversification strategy. Now, this collaboration opens a new digital channel for loan sourcing, leveraging Google Pay's 67 million active users and 36% of market share in India's UPI payment sector, as per the NPCI data. Now, the move aims to enhance customer acquisition and drive digital financial inclusion across urban and rural markets. Force Motors posted a robust Q1 of FY26 performance with consolidated revenue rising 21.9%, which is nearly 22% year-on-year, to 2,297 crore rupees, and EBITDA growing 33.3% to 332 crore rupees. Now, the EBITDA margin improved to 14.5% from 13.2%. Net profit also surged 52.4% to 176 crore rupees. Now, this is reflecting strong sales momentum across the vehicle portfolio. The stock has gained over 200% in the last 6 months and currently trades at 33 times trailing earnings. So the company's continued focus on operational efficiencies and expanding market share underpins its positive outlook despite some profit booking at the higher stock levels. Citi maintains a buy rating on Divi's Labs with a target price of 7,750 rupees, offering strong 29% upside. Now, it remains a top pick in India's pharma sector with recent stock weakness seen as a buying opportunity. Valuations are reasonable, supported by positive sector tailwinds and a robust pipeline. Concerns around oral GLP-1 phase 3 trials appear overblown, while strong adoption of injectable GLP-1 signals growth in the peptide market. Worries about, Entresto going generic in the US are likely to fade. Citi's FY26 to 28 EPS estimates are between 8 to 20% ahead of consensus, reinforcing confidence in the stock's potential. Dream11, Gamescraft and other real money gaming firms are set to sue the Union of India over a blanket ban on their operations. The companies are planning to file a writ petition with the Karnataka High Court as early as next week. RNG firms are deliberating whether to file petitions individually or collectively as a federation, seeking to overturn the ban and protect their business interest in India's online gaming industry. Ashoka Buildcon has bagged a 500 crore rupee order from Northwestern Railway for upgrading the existing electric traction system. The project, part of the company's strong railway EPC portfolio, strengthens its order book, already valued at 16,457 crore rupees as of December 2024. Royal Orchid Hotels has launched Regenta Palace, Ahmedabad, a 48-key premium hotel tailored for leisure travelers, which is business and leisure, marking its 16th property in Gujarat. Now, the hotel, located near SG Highway, features vegetarian dining, a fitness center, and 6,000 square feet of event spaces. Management plans further expansion in Gujarat within 2 years. Financially, ROHL reported an 8% year-on-year revenue growth, 11% year-on-year EBITDA increase, and 28% year-on-year PAT rise in its latest consolidated results. The Reserve Bank of India has released a discussion paper to review its flexible inflation targeting framework ahead of the mandatory second review due by March 2026. Now, the paper examines the nature and format of the current 4% consumer price index inflation target with a plus minus 2% tolerance band in place since 2016. Now, stakeholders are invited to share feedback by September 18 of 2025 to shape the framework amid global economic challenges like commodity price volatility and climate change. OpenAI, the company behind ChatGPT, is set to open its first office in India, located in New Delhi. Now, this move marks a significant step in OpenAI's global expansion, with India emerging as one of the fastest growing markets for AI adoption. OpenAI is actively hiring for roles in India and plans to announce further details about the new office in the coming months. The company aims to make advanced AI more accessible across the country and build AI for India in partnership with the government. US manufacturing is expanding at the fastest pace in 3 years, driven by stronger demand. The S&P Global US Manufacturing PMI, an index based on questionnaires sent to purchasing managers at around 800 manufacturers, rose to 53.3 in August. Now, that's up from 49.8 in July, well above the market expectations of 49.5. Now, it's the largest monthly rise since May 2022. The government is considering slashing adjusted gross revenue dues for Vodafone Idea and Airtel. Now, if approved, Vodafone's AGR dues could actually drop down from 83,400 crore to 28,000 crore rupees, while Airtel's dues might decrease from 42,000 crore rupees to 10,000 crore rupees. Now, the Department of Telecommunication has proposed relief on penalty and interest on penalty for both the telcos. Prime Minister's office is reviewing the proposals and may consider 2 to 3 options to support Vodafone. Macquarie has warned that scrapping GST on insurance without input tax credit will lead to higher insurance prices, increasing by 6 to 10%. Now, this move would contradict the GST's purpose of reducing cost and boosting the penetration. Macquarie emphasizes the need for clarity on ITC treatment before making any changes. The GST Council is expected to finalize its decision on the matter in its September meeting. Insurance regulator IRDAI is considering capping health insurance premium hikes. Internal discussions are underway to potentially limit the annual premium increases to 10% starting next year. Notably, IRDAI is not currently in talks with insurance companies, and any decision will be made independently. The government has approved 23 chip design projects under the Design-Linked Incentive Scheme. Now, this initiative aims to boost semiconductor design innovation in India. The DLI scheme provides financial incentives to encourage domestic design and development of semiconductor products. Renowned investor Ramdev Agarwal predicts a bright future for capital market services in India. He believes the sector has immense growth potential driven by high market capitalization and revenue growth. Despite this, Agarwal notes that people are estimating the sector's potential. Currently, the free float market capitalization is growing at an impressive 18% rate. Agarwal also highlights the consolidating and asset-light nature of capital markets, making them an attractive investment opportunity. Prime Minister Narendra Modi has arrived in Gaya, Bihar to launch multiple development projects worth around 13,000 crore rupees. Now, these projects span various sectors including power, road, health, urban development and water supply. The Prime Minister will also inaugurate the Onta-Simaria Bridge project on the river Ganga, significantly enhancing the connectivity between North and South Bihar. Also, he will flag off 2 new trains, the Amrit Bharat Express connecting Gaya to Delhi and the Buddhist Circuit train linking Vaishali to Kodarma. The Supreme Court has directed the Election Commission of India to accept Aadhaar cards as a valid document for establishing identity. Now, this is alongside 11 other documents for the special intensive revision exercise in Bihar. The court emphasized the need for transparency and instructed the EC to publish district-wise list of approximately 65 lakh voters proposed to be deleted along with reasons. The EC has been asked to consider Aadhaar cards and voter ID cards for the enumeration process to avoid mass exclusion of voters. The Supreme Court has issued guidelines for the management of stray dogs. According to the directive, stray dogs will be dewormed, vaccinated and returned to their original areas. However, dogs displaying aggressive behavior or suspected of having rabies will be immunized and not released. The court has also instructed the Municipal Corporation of Delhi to create designated feeding areas and a helpline number to report the violations. Also, NGOs and animal lovers will be required to pay 25,000 rupees to adopt stray dogs. Real money gaming firms including Dream11 and Gamescraft are considering taking the Union of India to court over a blanket ban of real money games. Sources reveal that these companies may file a writ petition with Karnataka High Court as early as next week. The firms are currently discussing whether to file individual petitions or collectively as a federation. A powerful magnitude 7.5 earthquake struck the Drake Passage, the waterway between the southern tip of South America and Antarctica yesterday. The earthquake occurred at a shallow depth of about 11 kilometers, with the epicenter located over 700 kilometers southeast of Ushuaia, Argentina, while Chile issued a tsunami warning for its Antarctic territory shortly after the quake. The Pacific Tsunami Warning Center later confirmed no tsunami threat for distant regions, including the United States. The area is known for seismic activity due to tectonic plate boundaries, but there have been no immediate reports of damage or casualties. US Senator Marco Rubio has announced an immediate pause on issuing worker visas for commercial truck drivers. Rubio cites concerns over safety, saying the growing number of foreign drivers on American roads is endangering lives and undercutting US truckers' livelihoods. So the senator's move aims to protect American jobs and ensure road safety. The pause on visas will be in effect until further notice, affecting commercial truck drivers from abroad. Chinese ambassador has slammed US tariffs on India, calling Washington a bully for imposing up to 50% duties, including a 25% penalty for India's Russian oil and arms purchases, effective August 27. Now, speaking on August 21, Zhu criticized the US for using tariff as a bargaining chip after benefiting from free trade. China firmly opposes these measures and pledges to stand with India, advocating for deeper cooperation to counter such actions and uphold the multilateral trading system. Israel's Defense Minister Katz warned Gaza City faces destruction if Hamas refuses to disarm and release all the hostages. Now, this follows the Israeli cabinet approval of a massive assault plan on Gaza City despite international opposition. Although Hamas agreed to a 60-day ceasefire proposal involving partial hostage release, Israeli Prime Minister Netanyahu rejected it, demanding the release of all the hostages and an end to the war on the terms of acceptable to Israel. So Netanyahu confirmed plans for IDF to take control of the Gaza city, linking the defeat of Hamas with the freeing hostages. So the UN has warned escalating attacks are worsening a dire humanitarian crisis. US President Donald Trump's trade advisor Peter Navarro has launched a scathing attack on India over its continued import of Russian crude oil. Navarro accused India of running a profiteering scheme by refining and re-exporting oil products at premium prices. He claimed India's actions are motivated by profit, not energy security requirements. The US has imposed 50% additional tariffs on Indian goods, citing India's failure to stop buying Russian oil. Well, with that, viewers, it's a wrap on this edition of Market Express, but please don't go anywhere and stay tuned to NDTV Profit.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Banish.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the
SEBI conducts search operations at Finfluencer Avdut Sathe's office for running unregistered advisory services. Illegal gains from his operations are likely to be around 400 to 500 crore. Benchmarks gain for second week in a row with Nifty closing below the 25,000 mark. Mid and small cap indices gain over 2% for the week. Nifty Auto makes the best weekly gain since May 2025. IRDAI may consider capping health insurance premium hikes. Sources say the regulator is conducting internal talks on this but is yet to engage with the insurance companies. If talks fructify, health insurance premium hikes may be capped at 10% from next year. SEBI is likely to propose a 1,500 crore rupee cap on large intraday bets. Sources say the move follows market regulator scrutiny of Jane Street. In a relief for telcos, government may slash the AGR dues as the PMO revise the latest DOT proposals. If approved, Vodafone Idea's dues could be slashed to 28,000 crore rupees, while Airtel's AGR liability may be cut to 10,000 crore rupees. Real money gaming firms such as Dream11 and Gamescraft may sue the government over the passage of online gaming bill. Sources say the companies plan to file a writ petition with the Karnataka High Court next week. Supreme Court impledes all the states and union territories in the matter of stray dogs, expands the scope for final solution, says dogs with aggressive behavior or with rabies shall be immunized. OpenAI is set to open its India office in New Delhi in a few months. Company says it's begun hiring to expand its local team. Hello and welcome. This is Profit 360 on NDTV Profit, and I'm your host Himakshi Bahuguna. Along the next half an hour, we'll be, bringing you latest on the markets as well as national and international news. So, viewers, starting with the big NDTV Profit exclusive. SEBI is intensifying its scrutiny of financial influencer Avdut Sathe. Sources have told NDTV Profit that Sathe allegedly made illegal gains of 400 to 500 crore rupees from unregistered advisory services. SEBI has launched a thorough search at Sathe's Mumbai Trading Academy, part of its drive to crack down on unauthorized investment advice and bring more discipline to the market. Sathe's business activities and online content are now under detailed investigation, with SEBI making it clear that only registered advisors can give investment calls or guarantees. My colleague Charu is on the ground at one of the Academy's centers. Here's her report.
A little over 20 kilometers away from the BKC office of Securities and Exchange Board of India lies Flying Colours Cooperative Housing Society in Mulund. And why is it important? It's important because this is where the corporate office of Avdut Sathe lies, the influencer who has been under the scrutiny of Securities and Exchange Board of India for giving unregistered trading advice. Now, this is a person who has been in the business for quite a while and has offices around the country, be it Bhubaneswar, Kochi, Kolkata, Mumbai and several other areas in the Sahyadri region. And he has a big network of teachers and traders who themselves are unregistered on the SEBI platform and are the people who used to be his own students. Now he is running this business in a way that there are several people on the premises constantly working in a very godman kind of a way, working on a very self-proclaimed God philosophy of trading, where they also have an energy wing where they focus on the resilience and the emotional stability of the traders and keeping them connected with their platform even if they face losses. Now this is a case where SEBI is looking at impounding illegal gains of over 400 to 500 crore rupees, but the search operation is still going on and it remains to be seen as to what happens. We'll keep you updated. Right, Charu. In fact, SEBI whole-time member Kamlesh Chandra confirmed a major search operation targeting a prominent influencer was conducted. Now, this underscored the regulators' intent to act against big names to create impact and deter misconduct in the financial industry.
We have carried out a big search operation on some big name in this industry, because idea is, this chairman has given a very clear direction that quality is more important than number. So your enforcement action must be directed at big people where you can show impact. See, what is the idea of enforcement? Enforcement is not for revenue collection. That is, sorry, I'm using this word because of my previous background. But idea is to create a fear in the market that there is a law enforcement agency, there is a regulator who is watching you, so people follow the law voluntarily. So that is the purpose of enforcement, and that purpose is best achieved by focusing on big people and showing that, SEBI is effectively watching everyone.
Coming up at 5:30 p.m. on NDTV Profit, we take a closer look at Avadut Sathe's who he is and how he allegedly swindled the investors out of 300 to 400 crore rupees. Now, don't miss this special show. And viewers, now switching gears. So markets ended higher for the second week in a row, with Nifty closing below the 25,000 mark. Mid and small cap indices also gained over 2% for the week. Most sectoral indices ended higher for the week, with Nifty Auto seeing its best weekly gains since May this year. Harsh is now joining us with a quick wrap of all the market action.
There's clear and evident pressure in markets today, and we saw a bit of those gains that we've clocked through the week being given away. 24,900 been taken out. We closed below that mark. In fact, 24,860 is where we were trending at close. So some pressure coming through. The breadth was what contributed to that pressure. And outside of a couple of auto names, really there was no trend with regard to favorable or unfavorable breadth either. But of course, on a day when banks and IT, both of those were key drags on the index, it was difficult to find favor, or it was going to be difficult for the index to sustain anything at all. So the banking index was down 1%. So that's where the pressure came from. The Nifty IT also down nearly 1%. And FMCG was the other drag. So when you have these three sectors trending negative, very tough to sustain. Among sectors, and talking of it, pharma was the one which probably stood out 1/3 higher, and within broader markets more than anything, the Nifty India Defence Index was the other one. But just very minor gains for both of those. So really nothing material or market moving on any of those. So that's broadly how the texture played out. You look at the advanced decline as well on the exchange as a whole, and you did it was negative, but not as negative as we were seeing on the Nifty 50. So on the exchange, the advanced decline was just about 1,500 to around 800 odd gains, but nonetheless it was negative, and therefore the Nifty mid cap and small cap index, while they were in the red and we slipped a bit right at the fag end, were largely broadly flat, maybe a slight negative bias creeping in right at the fag end of trade, and that's how both the mid cap and small cap indices trended. In fact, for the week gone by, the Nifty closed in the red, so really no positives there to take out from the week. But the Nifty mid-cap and small-cap indices, both of those closed nearly 1% plus in the green. So that was how the week also played out. In terms of course, there were some gainers, losers. The likes of an ABFRL was one that really stood out, 7% higher. But outside of that as well, there were plenty of big gainers in trade today.
Thank you so much, Harsh, for that market roundup. Now, here's a glimpse of another exclusive conversation. With Airbus and Boeing raising the stakes and aerospace giants like Collins Aerospace and Honeywell eyeing India's vast potential, my colleague Neeraj Shah sat down with Ravi Dharamshi and his team as they revealed how India's cutting-edge technology and skilled workforce are steering Bharat's aerospace industry to unprecedented heights. Have a look.
This is like $20 to $30 billion annual opportunity for companies that are from the size of revenue size for probably 100, 200 crores to 1,000, 1,500 crores at best at this stage. So when these companies, they will become, we are talking about these becoming at least 10x in size in next 10 years and with high margins and long visibility. So whenever we look for an opportunity, what we look for is a large opportunity and a long runway. So both the things are present over here. One, the size of the opportunity, and second, visibility for 10-15 years, which is not very easy in most other sectors.
Yeah, that's true. Okay, Arvind, this entire ecosystem, high growth, etc. Are there now to both of you, right? Are there successful case studies of Indian companies already which have made a breakthrough and are now very large, traditionally relative to the past, very large partners of this OEMs, which is Airbus, Boeing, or some of the others?
2021 is when a lot of the certification and onboarding of the Indian companies started taking place. Since then, there are companies in the listed universe. Azad Engineering is one example of it. They do turbine blades. GE is a large customer. In one of our private portfolio companies is Rungsons Aerospace. Again, they do tubes, ducts, fluid handling solutions, and thermal management systems, again embedded with GE, Honeywell, etc.
Viewer sources tell NDTV Profit that IRDAI is currently having internal discussions about capping the healthcare, insurance premium hikes. So although it is not, currently in talks with insurance companies, the regulator may decide to limit the premium increases soon. So for more details, my colleague Pallavi Nahata is joining us on the phone line. Pallavi, over to you.
Right. So as you've mentioned, the IRDAI is currently internally talking about capping insurance premium hikes at 10%, which means that insurance companies will not be able to hike health insurance premiums annually by more than that. Now, this comes on the back of, very steep hikes by several insurance companies in the health insurance category that we have been seeing has resulted in is several consumers, showing hesitation at renewing their health insurance premiums, simply because of their issues around how expensive and unaffordable purchasing a health insurance is becoming. Let's also remember that the IRDAI has already put in place a similar cap for senior citizens to ensure accessibility and affordability. Now, as you mentioned, this is currently something that the IRDAI is deliberating on internally. It is likely that post these internal deliberations and consultations, should these work out, they are likely to consult with private health insurance companies. And if these talks do fructify, we could see a cap on health insurance premiums by next year.
Right, Pallavi. Thank you so much for bringing us those details there. And now turning to a story on the market regulator, sources have told NDTV Profit that large intraday derivative trades may be capped at 1,500 crore rupees. Now, this comes after SEBI's recent probe into the high-frequency trading firm Jane Street.
So, as NDTV Profit reported exclusively on the morning of August 19, a meeting was held with the Secondary Market Advisory Committee of Securities and Exchange Board of India, and the members were juggling with a lot of proposals. One of these proposals was to, reintroduce the topic of intraday position limits. Now, currently there is no limit on these intraday trades. However, SEBI is looking to get into this again after the Jane Street saga. So, to sort of control and curb proliferation of any sort of market manipulation and to protect the innocent investors, SEBI is sort of thinking if some, limit on intraday positions can be brought in. Now, this is something that was also brought in as a suggestion while the open interest calculation consultation was brought in 2 to 3 months back. However, when the final circulation on the same came out, intraday position limit suggestion was dropped because of the market, sentiment and the market suggestions that were sent in response to that proposal. However, it is being explored again, and we'll get to know as to what developments take place further. The limit that is being considered currently is about 1,500 crore rupees.
Absolutely, Charu. Thank you so much for getting us those details there. Now, Vodafone shares have surged over 7% as sources have told NDTV Profit that Department of Telecommunications has escalated the pleas from Vodafone Idea and Bharti Airtel for adjusted gross revenue relief to the Prime Minister's office for a final decision. Now, for more details, my colleague Aishwarya Patil is with us now.
Well, what we're picking up currently is that the Prime Minister's office will be reviewing latest documents and a plan that the DOT has put forward, a proposal as far as the AGR dues are concerned, relief towards Vodafone Idea as well as Airtel. That is being reviewed by the PMO is what we're picking up from our sources. Now, if this plan is approved, what is on the cards for both these telcos who have massive amounts in terms of AGR dues? As far as Vodafone's AGR dues are concerned, that is likely to be reduced to about 28,000 crore rupees from the current due of over 83,400 crore rupees, while Airtel's AGR dues, those currently which stand at about over 42,000 crore rupees will be reduced to about 10,000 crore rupees, is just one part of the proposal. Apart from that, DOT has also pitched a relief plan as far as the penalty and interest on penalty is concerned for both Airtel as well as Vodafone, so as to restructure and take a look at how that can also be extended in terms of moratorium as well as interest payments. That will also be reconsidered by the PMO is what we're picking up from our sources. PMO may consider about 2 to 3 options, especially for Vodafone Idea. Now, overall, if we talk about Vodafone Idea's debt in total, that stands at about over 2,14,000 crore rupees in terms of payment obligations towards the government, of which about 83,000 crore or so is in terms of AGR. And that's the update so far. We'll keep you posted as and when we hear about what steps the government will take going forward to give relief to both the telcos, Airtel as well as Vodafone Idea.
Right. Thank you so much, Aishwarya, for that. Now, the government's online gaming bill seems to have thrown everyone into a panic mode. From companies to gamers, everyone is worried about something. So as industry giants get ready to battle it out with the government and court, my colleague Agni is here to break down what the real concerns are. Agni, over to you.
That's right. So a lot of panic and confusion going both ways. So let's just look at it from the beginning. First of all, what has actually been banned? So companies which involve online games like poker, rummy, fantasy sports, and games which involve real money, so as to say, are the ones that have been banned. Now, the bill does not differentiate between games of skill and games of chance. So games of skill will be like your games like poker and chess, and games of chance will be games like your betting on sports and everything, which again involve real money. Now, it's still a bill. It doesn't become an act till it is passed. It gets the presidential nod. But yes, this is what has been banned. Now, if we look at who is actually shutting shop, so if you go on to the next slide, a lot of companies have been affected. There's Dream11, there's Winzo, there's MPL, Zupi, Probo, Rummy Culture, Pokerbazi, which is owned by a listed company, Nazara Tech, and even Gamescraft, other companies, among a large list of companies that have been affected. Now, the next question is, what will the platforms do now? There's a blanket ban, so what can they do? So first of all, they can focus on in-app purchases and ad revenue. That's how they can generate revenue instead of getting involved in real money. The next thing they can do is sell their businesses to overseas companies. Now, these companies can't operate in India, and any company, any gamer involved in such a platform will be considered as a criminal. So the best solution again is to sell the company to an overseas fund. And the next thing that they can use is established tech stacks can be used for other businesses, which is again a very hypothetical situation. We are not sure how many companies will actually go about. Now, as a gamer who might have been involved in these companies, what are your deposits doing? So are your deposits safe? So most platforms are now blocking new deposits. To answer your question, yes, the deposits currently seem to be safe. Gamers are currently able to take their existing deposits out of the platform. So if you have, say, put in 200 or 500 rupees into your Dream11 account, you can now take that out. There seems to be no pause in that. But experts warn that there can be concerns of a mass system overload as more players start taking their money out of these platforms, and there are mass withdrawals. Now let's move on to understand what the flip side of a bill that aims to be all good are. Experts we have talked to have warned us that there can be banned users might shift to unregistered peer-to-peer betting apps, and they can use UPI mule accounts to help proliferate offline gaming. And next, if we go on, that there are courtroom battles that are going on. We have reported exclusively that Dream 11 and Gamescraft are looking to take the government of India to court, and a petition can be filed anytime over the next week. So these are the details, basic ones. Back to you.
Agni, thank you so much for breaking down that for our viewers there so precisely, and I'm sure our viewers are going to benefit from that. Now, in a significant development, the Supreme Court has modified its earlier directive on stray dogs in the Delhi NCR. A bench of justices today clarified that stray dogs can now be released back into their original habitats after being dewormed and vaccinated. Now, the court has put a hold on its previous order that mandated the confinement of all the stray dogs in shelters and prohibited their release. However, it made it clear that dogs are showing aggressive behavior or infected with rabies will not be released into the public spaces. My colleague from NDTV, Nupur, is now bringing us more details on this story.
Well, first of all, the Supreme Court has for now stayed the earlier directions pertaining to relocation of dogs. That is, the Delhi NCR dogs can now roam freely for now on the streets. Secondly, the Supreme Court has for now said that ABC rules should be complied with till the time a national policy is framed in that regard, and thus it has in fact issued notices to union territories and states seeking their response on how to go forward with a combined uniform national policy on as to how the menace of stray dogs, increasing stray dogs or dog bites should be dealt with by the authorities. Thirdly, the Supreme Court has also stayed this direction, which was earlier in fact passed by the two-judge bench of the top court, which had caused massive furor and protest by dog lovers. The Supreme Court has now said that the ABC rule, which mandates that you need to pick up stray dogs, sterilize them and vaccinate them, and cannot relocate them, but have to leave them back to their original places where they were picked up from.
Right, and now while the court now says that sterilized and vaccinated dogs can be released back into their original localities, lingering questions still remain. How will the authorities ensure that all dogs are vaccinated? How will they relocate the dogs to original areas? Let's go over to my colleague Arushi for more on this. Arushi, over to you.
Right. So on August 11, the Supreme Court mandated rounding up all stray dogs across Delhi NCR and placing them permanently in shelters. Now, no provision was made for returning sterilized and vaccinated dogs to the streets. Now, shelter infrastructure had to be created and strict action threatened for non-compliance. After widespread protests and opposition to this ruling, exactly after 10 days, the Supreme Court reversed its stance. Strays will now be sterilized, vaccinated and released unless aggressive or rabid. But there are a few questions that arise looking at the order. Let's take a look at them. Point number one is that sterilization and vaccination are key to controlling the stray dog population. But in large cities as Delhi NCR, logistics and follow-up remain challenging. So number one question is that how municipal bodies will sterilize and tag dogs while keeping a record to make sure that no dog is missed or treated repeatedly. Point number two is that the order mandates releasing sterilized dogs back to their original localities to maintain ecological balance and avoid territorial conflicts among other dogs. However, enforcing this requires coordinated monitoring systems and cooperation from local authorities. So question number two is that how will the court ensure that directive to release stray dogs is in the same area is being followed? Point number three is that designated feeding zones aim to manage where dogs gather. So clear definitions of aggression, procedures for assessment and plans for containment or rehabilitation of such dogs are essential for safety. A question that arises is that how will the authorities control aggressive dogs in designated feeding areas? Garbage dump sites provide food source that attract strays into urban areas. The absence of directives on garbage control leaves a critical root cause unaddressed. Question number 4 is that why is the court silent on garbage dumping, which is a key cause for strays entering cities? Final point is that animal welfare groups and concerned citizens often take legal recourse to protect stray dogs' rights. Imposing fees or legal costs on such petitioners might discourage public participation and advocacy. So our final question is that why are dog lovers and NGOs being asked to deposit a fee for moving to court? Now in the end, the real test will be whether these directives translate into practical solutions on the ground.
Absolutely, Arushi. These questions are there in the minds of our viewers and for everybody who's a dog lover or even who's not. These questions still persist, and let's see how, time will only tell that how they're going to pan out. And with that, viewers, it's a wrap on this edition of Profit 360. But please don't go anywhere, as there's a lot of action for you all on the other side of the break.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture? Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Varsha Chandnani, and we're going to be talking about to a hospital company today. It's obviously inflation proof to a certain extent from a business standpoint. It's also to a large extent geopolitical and tariff proof as well. So you've got all of those largely not likely to impact something like this, and hospital companies have come to the forefront in a large fashion. It's a sector which has done extremely well over the last 12 to 18 months. you've seen a huge valuation re-rating, and therefore you'd want to understand whether that growth can actually sustain or not. And therefore, what we're going to start with is trying to understand what I want to know with regard to this one. It's a KIMS that we're going to talk to, and we're going to talk about KIMS hospitals. And what I want to know is the first thing is that they have launched a lot of new hospitals, and all of that is impacting the numbers negatively. Mind you, from a business perspective where hospitals is concerned, you launch a hospital and it doesn't give you the best numbers in year one. The launch is more where the first and the second year numbers will reflect some bit of softishness. Thereafter is when the ramp up will start with regard to numbers, both on margins as well as on top line. And therefore, what I want to understand is this trend of a taper down with regard to profitability, and we will look at those numbers and you'll see what I'm talking about. Is that going to change going forward? When do we see a ramp up on profitability as well as on average revenue per operating bed? This is a very common metric used for the hospital business in particular. Average revenue per operating bed. It is only the top line number coming into the hospital's kitty for every operating bed. So non-operating bed is not included, right? And this is termed as RPOB. And RPOB for a KIMS is growing substantially because they are growing in the markets where there is better revenue versus the markets where there is lower revenue, which they have traditionally been in. The third lever is occupancy. We spoke about average revenue per operating bed. Occupancy is a measure of how many beds remain unoccupied. So all of those factors is what you consider when you're looking at hospitals. Occupancy ramp up, and you will see that ramp up, as I did mention during the first metric. You see that ramp up in occupancy only from year 2, year 3 onwards. In year 1, you will see muted occupancy in most new hospitals, and therefore overall occupancy for the company as a whole has fallen. And are we likely to see a recovery there is my question. The fourth piece is with regard to margins and profitability. How will these two, therefore, given all of these metrics, how will these two metrics also move, and how do we see an increase there? The fifth piece is with regard to capex. They've been doing acquisitions as well. They fund that through debt to a larger extent, and therefore you've seen a ballooning of debt as capex has played out. They have revamped their strategy. They're trying to do asset light. They're trying to lease land rather than buy land, which is asset light. But nonetheless, how far are we with regard to the top of the cycle? And the sixth point, debt. Therefore, has it peaked? When will it peak, and at what amount? And the last piece is with regard to expansion beyond FY27. I'd want to know what the plans are, because till FY27 we have clear visibility on what they're doing. What about beyond that? So all of that is what we'll try to understand. Varsha, anything to add?
Yeah, no. So overall, the two major points that you have covered is, one is tariff proof. And because of that, a lot of analysts are also speaking about why they are bullish on hospital sector and even diagnostic sector. No Trump tariff, no jhanjat at all. The second thing is why hospitals are in focus is because of the capex that they have been doing, and especially brownfield capex. It's just an addition that you do to your building, or you just add floor or you just add beds, that's it. And because of that, your ROE or return ratios improve. And one of the reasons why investors or even analysts are bullish on hospitals because of the brownfield capex that these companies are doing.
Perfect. So I'll allow you to start with about this one in particular.
So starting with KIMS, that's Krishna Institute of Medical Sciences. So they are into hospitals, and mainly they target Telangana and AP, although they are also expanding into other areas as well. They provide multidisciplinary integrated healthcare services, that is nothing but hospitals. Now let me just focus on the operating metrics. Now let me start with bed capacity.
which has increased from Q1 FY25 to Q1 FY26 at 5,499 beds. Occupancy, if you see, has been lower. So it has dragged down from 56.5% to 48.8%. Now, one of the reasons is because of the addition of the new units that the company has done, and one of the reasons why you're seeing that drag in occupancy. Also wanted to talk about operational beds, which has of course increased from 3,500 to 4,612. Now, talking about ARPOB, that is average revenue per occupied bed. If you see, we've seen a healthy growth. Now, this is on the back of, so from 38,500 to 43,000. Now, the growth that you're seeing is because of the improved case mix and of course payer mix, which has led to this growth. And also, they have also guided from ARPOB growth of 4 or 5% in mature units. And at the consolidated level, this 43,000 number would go to almost 53,000 as their Thane and Bangalore unit ramp up. Now, moving on, if you see, let's talk about their capex plans. So they've got huge capex plan. So almost 1,800 to 1,900 of beds, they're gonna add, which is so. For example, Bengaluru, if you see, the operation for this will be in Q2 FY26. So a lot of capex that they are doing. And one question that we might want to ask to management: when of all this capex will add to top line? When we are going to see that huge growth in top line, because a lot of capacity expansion that the company has been doing.
And bottom line as well.
And bottom line as well, and because that's under
with
pressure right now.
Yes, with a lag. Yes,
Yeah.
you're right.
So, overall, so this is overall the business model and the capex plan that the company has. And, I'll start with the income statement as well.
We can start looking at the metrics. And before we start, let's just quickly look at the metrics we'll cover. It's the regular, usual 8 metrics that we look at: income statement, balance sheet, cash flow, shareholding, return ratios, street cred, street coverage, and valuations. We look at all of those 8. Varsha, income statement.
Yeah, so, starting with income statement, over here, if you see, the problem over here is net profit. Now, as Harsh was pointing out, this is because of addition of the new units, and because of that, if you see, your depreciation cost has increased, and your interest cost has increased, which has led to this net profit pressure. So revenue, if you see over here, it's 3-year CAGR is 23%, EBITDA 3-year CAGR is 15%, again because of the addition of new units, and net profit impact that you're seeing is because of new units. Because of that, your depreciation cost has increased, interest cost has increased, which has led to pressure in net profit. Talking about let's talk about their Q1 FY26 performance also. Overall here, if you see, again, there's a problem, or I would say the margins. Margins have decreased over here. Net profit has also decreased, though revenue has gone up 27%. If you see that their margin trajectory, from 32% to 22%. Now, this is all because of the new units that they've been adding, and this is the reason why you're seeing this pressure in EBITDA margins. And moving forward, we would see some increase in the margins going forward.
I just want to highlight, so your core mature markets, Telangana, etc., they do very good margins. They do 30% plus margins. So that's not where the problem is. The problem, or rather, you can't even call it a problem technically. It's part of the business, part of the growth of the business. As new hospitals get added, they are at lower margin, they are at single digit margin, and therefore your blended margin comes down, and that's why you're seeing the shrink with regard to margins. That trajectory is not something which is unreasonably bad, but the question will be, how quickly can it go back up? Really, that is the question we'd want to address.
Exactly, right. So yes, overall, just in a nutshell, because of the addition of new units, we are seeing pressure in the income statement, especially when it comes to margins and net profit.
Perfect. Let's look at the balance sheet. And when you're looking at it, largely the ratio of debt to equity is obviously elevated. And that elevated ratio is because they've done a lot of capex. Varsha did put out that slide and presented it in About the Company as to how the capex is stacking up for the company, and a large part of this will peak in FY26 is what the management has said. I'd want to understand whether that is the case. How quickly does the pay down with regard to debt happen, and how can we move forward? What does FY27 and beyond look like from a balance sheet perspective? Because this is a large amount of debt which is sitting on the balance sheet. They've got a decent amount of cash as well. So in that sense, it's okay. You're largely seeing this to be a 30,000 crore company in market cap, and therefore that 2,000 crore debt may not exactly bother me as much, but surely a 1:1, near 1:1 debt to equity is not something that is sustainable for very, very long. So you want to see it come off, if at all. So we'll wait and watch as to what the management says with regard to that. But cash flow, Harsha.
Yeah, so overall, cash flow, if you see, we would give here a thumbs up. In a hospital business, you don't have any receivables problems, you don't have inventory problems.
Clean.
Clean, exactly. Clean
Great
cash flow.
business to be in. You get the money before you get admitted. So there's absolutely no concern with regard
exactly.
to that.
So no concerns when it comes to receivables and inventory, and that's the reason you're seeing cash flow from operation is a big positive number. Despite company investing, because if you see cash flow from investing, that has been increasing year on year. So in FY22 it was 412 crore, which has increased to 416 crore, which then increased to 753 crore, and in FY25 it increased to almost 1000 crore. This I'm talking about the investing activity. So company, despite investing huge amount in new units, we are seeing this positive cash flow because of the sole reason: no receivables or very slight receivables and no inventory. So overall,
and CFO to PAT is above 100% because you've got that very large depreciation number which is sitting in the P&L.
Exactly.
So you've got this super large, and I'll quantify it for you. It's 200 crore. Trailing 12 months depreciation number is close to 200 crore. This used to be at 70 crore in FY22. So you've got this very large bump up in the last 3 years with regard to that number, which is what is aiding the cash flow from operations to profit after tax. So that's something just to keep in mind.
So what was the pressure for income statement is a boon to cash flow statement.
Correct. Now let's look at return ratios. The return ratios have traditionally been elevated. They've been around 29-30%, but they've come off sharply, and that's understandable because you've got huge capex that's coming, and you've got profitability which is playing out with a lag. So that's why. But even at likely a bottom maybe this year, next year, of 15%, even at its very bottom, not looking too bad, and therefore we've given this one a thumbs up. Shareholding, Varsha.
Overall, when I talk about promoters shareholding, it's like 34%. Now, one of the reasons why we have given a neutral rating to it, because we want that skin in the game. But the good thing is, look at the FII's stake. Though it has decreased by 1%, but good stake of FII is at 15%. Even DII stake is at 31%. So just because of that promoter's stake at 34%, we have been giving this shareholding pattern as a neutral one. But FIIs and DII stake gives us a confidence when it comes to KIMS hospitals.
Perfect. Now let me cover street cred as well as street coverage. Negative 1% last 1 month, but you look at the 6 month, year to date, 1 year, it's been a phenomenal run for investors. So very, very positive with regard to the way this has played out. And an investor would have sat on this over the last 1 year over any time period has done very well. So that's the positive. 5 years as well. In fact, it's not listed since 5 years, it's listed since 2021. Since then also, it's given a very, very good performance from a stock price perspective, and therefore we've given this a thumbs up. No concern from a shareholder perspective given the kind of returns it has given. But valuations, street coverage, let me try and cover that as well. 14 buy calls, 1 hold, 3 sell, 15% upside, and therefore a thumbs up on that as well. From here, another 15% is what analysts are penciling in. Clearly bullish on this one, Varsha, but valuations.
Yeah, so valuation, if you see at a P level in for FY26, it's at 68, and FY27, 47. Now, this kind of a premium kind of valuation that the company has been given. Now, one of the reasons is we may see a growth in RPOP. The occupancies tend to increase. That's a positive point. ARPOB growth is a positive point, and the company is doing a lot of capex, which will turn into good growth when it comes to net profit. So because of all these positive points, the company is trading at a premium valuation. Because if you see for Max Healthcare, for FY26 is trading at 67p, for FY27 at 53, right? So it's not like, it's very close to, the valuations are very close to Max Healthcare, because Max Healthcare is a giant when it comes to hospital, considering the good ARPOB that the company has, good occupancy. And one of the interesting thing in Max Healthcare is they are doing a lot of brownfield capex, which will enhance their margins, which will enhance their ratios. And so KIMS has been given that valuation to the level of Max. Even for Yatharth Hospital, if you see, is at 37p, FY27 26p. So overall, because of all these things, KIMS has been given a premium valuations.
We have Dr. Bhaskar Rao, who's Chairman Managing Director at KIMS Hospitals, joining us. So great having you. So let me start off with what changes in FY26, because you are likely guiding for an uptick with regard to margins. You feel margins have bottomed, and therefore I would assume that some of the less profitable hospitals are going to start to see a better churn, and the newer ones, of course, and understandably so, are going to start to see better profitability. Give us that perspective. Where does it lie? Do we go back towards 25% quickly enough in FY26?
Yes, what's happening when the organization, especially it is an healthcare organization, when it is running and building a good brand image among the patients, what we do and attract is a lot of complex cases. When you get a lot of complex cases, whether they're Tier 2 cities or Tier 1 cities, the ARPOBs will increase. That is one aspect. The second aspect is we have been started Thane, Bangalore units this quarter, and that will usually takes about 12 to 18 months in a healthcare industry. I am expecting at least 9 to 12 months we can able to see the positive bottom line. So that will also improve the margins and as well as the revenue and ARPOBs also. You can able to push the ARPOBs because both Bangalore and on Thane, they are the little high ARPOBs, is almost like Telangana, even better than Telangana ARPOBs. Whereas Andhra ARPOBs are very, very low. Even in Andhra, we are also adding an additional beds in Srikakulam, Anantapur, Ongole and Rajahmundry. These are also matured now, the occupancy is very high. When we are doing like that, then definitely those margins also will increase. So this year looks, and the coming year also, very, very positive outlook. I'm seeing I can believe I can do a better job than what we have been doing historically.
Hi, Mr. Rao. This is Varsha this side. Pleasure to have you at NDTV Profit. About ARPOB, I'll just extend that. From 43,000, can we expect ARPOB to go, 50,000 to 53,000? And if yes, by when are you targeting that number?
There is nothing like we target. Basically, as I mentioned before, if the complex cases comes and the high-end margins that are there in Thane and Bombay, 43, there is a chance it can go even to that level. But definitely year on year, there will be definitely a better prospects on the ARPOBs are concerned.
So, but you've guided, if I'm not wrong, for an ARPOB of 50 to 55,000. You've done 43 in Q1. How likely is it that you get there?
Fair chance, very fair chance.
Okay, and what is it that gives you that bullish construct? Because the kind of bridge between 43 and 50, 55 is quite large. So what is going to change so dramatically over the next maybe 9 months that gives you that optimism that you will get there?
See, the reason is 900 beds what we are opening this year in Bangalore and Thane. And these are all the very, very high ARPOBs than Telangana cluster. So that's where whatever margins that is going up, it will be able to show the Thane one is doing a good job, and then this quarter, maybe the third quarter of this year, the Bangalore units will start. It will take about 2 quarters, most probably, if not the end of this year, in the next financial year, about Q1, there should be a good jump of ARPOBs.
So you're doing a lot of capex, and maybe this capex will go on for next 2 years. Just wanted to understand what is the peak revenue, that KIMS may see for next 2 to 3 years, because if I'm not wrong, you're adding almost 1800 bed capacity in the next 2 to 3 years. So just wanted to have that ballpark number, if you could give us beyond FY27, how KIMS will look like.
So there will be definitely 25 to 30% revenue growth year on year in the next 3 to 4 years.
Okay, and also, sir, just wanted to, revenue is 25 to 30% CAGR that you're targeting. What about margins? Because we've seen some pressure in margins now, of course, because of the addition of new units, but any kind of target that you have set for yourself when it comes to margins, maybe, in next 2 to 3 years?
See, basically, whatever is the matured healthcare, when we are running it and understanding the operational efficiency, and when we set all these things, initially it will be down, and then once it is matured, and then we will be able to see what we are looking around 22, 23 margins. Financial year 22, we are expecting to reach that, because there is no reason why it should go down. When we are matured enough, the margins will be more of operational efficiency, talent that is available, and very, very reasonably we set up the capex. When these are all having been a 2.5 decades, we are in the field, and we understand that what we are doing is, and when we are moving forward, the organization becomes bigger and bigger. There will be again an operational leverage of bringing down the cost of the expenditure. So the margins will be able to sustain what we have been achieved before.
It's a great conversation. So I want to understand where and when do you peak in terms of your capex, because, and this is from a perspective of debt, you've guided that your debt will peak in FY26. What will that debt number be? What is it that you're comfortable with in terms of your debt number? And where does your capex for the moment pipeline end? In what quarter does the cash flow going out from your business stop, so that I understand where the debt will peak at?
See, here there is two things which we need to be able to say rather than talking about the debt. If you look into the debt on the listed company, is very, very low. Even hardly about 600, 700 crores is the debt when we are taking about the similar amount of EBITDA. Whereas we have a lot of subsidiaries, where the subsidiaries are putting on expansion, like in Bangalore is another subsidiary, and then we have Srikakulam, we have Anantapur, all these subsidiaries, Kurnool, where we are doing an expansion of bed capacity. There we borrowed the loan. That is the reason it is coming into the debt looks like very huge. If you look into the listed company, the even it is less than 1 is to less than EBITDA to debt will be hardly less than 1. Whereas because we added those units, because we have taken a long-term debt of 10, 15, 10, 12 years, that's why the debt is showing that, but it is not at all an alarming position of the debt. Listed company is the most important, which we need to look into the debt. It is less than 1:1 of the EBITDA. When it is less than 1:1, if the subsidiary is having any issues, we can able to support it. So we are very, very careful about how this listed company debt will be less than 1:1, whereas in the other things it will be around 3.5, but average blend will be around 2.5. We will be very, very cautious even on the whole. I want to keep the debt 1:2, EBITDA to debt. Maybe that once we come by 27, it comes down. From there, when we are able to put the capex, we will be very, very careful we should not cross more than 2 max.
Understood, sir.
Preferably to be less than 1.5.
Understood. Thank you so much for coming in and speaking with us. This has been very, very insightful, not just from a Kim's perspective, but also from understanding hospitals. Viewers, it's always great understanding a different sector and completely changes the way in which we look at the metrics as well. But anyway, that's all of our KYC metrics. It gives Kim's Hospitals a 6 out of 8 on our KYC ratings. Mind you, 30% growth for the next 3 years will mean that your top line goes from 3,000 crore to 6,500 crore in 3 years, with a margin closer to 30%, which will likely mean around 1,900 crore in terms of EBITDA, and currently trading at around 16 times EBITDA if we look at the next 3 years. But of course, 3 years is a long time. So you also want to be careful with regard to that. How far are you extrapolating it? But viewers, completely out of time. From Varsha, myself, everyone who puts the show together, thanks so much for watching.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Ramesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
It is a mathematical rule that if you overpay, you are borrowing future returns. He is not buying in thin air, someone is selling. The only truth in investing and in markets is nothing is certain and trends end.
You would have a strategy towards pure equity, fixed income, and maybe a little gold, right?
Whatever asset allocation I tell you is not perfect because it is all individualistic. I started my career seeing a 60-70% fall in the year 2000. I am generally a conservative investor. There are points in time you need to choose strategic mediocrity. As an investor, you should not get excited about what others are buying.
The ownership pattern of Indian equities is changing. amidst everything that's happening around the world with wars and Trump tariffs, foreign institutions have been selling. And meanwhile, retail investors continue to pour money into our capital markets, particularly through mutual funds. That's pushed domestic institutional buying to unprecedented levels. In fact, the inflow into Indian equity markets from domestic institutions was 4.1 lakh crore rupees in 2025 as of July. That's already 80% of the inflows in 2024 as a whole. You're probably wondering why I'm talking about this. I want to ask my guest today what he thinks about the implications of the flood of retail money pouring into Indian equities, whether SIP is really the way to go, how to buy the dip, and whether international equities really need to be part of your diversification strategy. This is MoneyWise on NDTV Profit, and my name is Alex Matthew. My guest today is Kalpen Parekh, the Managing Director and Chief Executive Officer of DSP Mutual Fund. Kalpen, as always, a pleasure speaking with you.
Likewise. Thank you for inviting me.
So let me ask about this. There's so much swirling uncertainty, and we've seen so much selling by foreign institutions. Equally, we've seen a large amount of buying. SIP figure 28,000, I'm talking about gross. People keep buying, and the argument is that valuations are expensive. They're not cheap. Earnings are not necessarily the best. Is there a problem with this? Is there the possibility of dislocation?
I want to clarify a doubt. Should my answers be from the lens of us, the institutions, or the lens of the viewers, investors?
The investor. Important. Okay.
Great.
Sorry, before you start, I want to ensure that my question is absolutely clear. The fear is that you're buying too much of an asset, and because the flood is not stopping, the fund manager has no choice but to deploy, because I can't keep a large amount of cash. So you're pushing up the price and not allowing the price to drop. That is the worry.
So, there are two dimensions to this, that for every time someone is buying, let's say, you come up with a headline that huge buying by FIIs. He's not buying in thin air, someone is selling.
Yes.
Even when they were buying. Or likewise, today if we are buying, the domestic retail investors are buying, someone is selling. So buying and selling always equalizes. Yeah. Having said that, as investors, I feel, and I have also learned over a period of time, that these dimensions don't matter in your outcomes. They actually confuse you, because you should not worry whether the fund manager is buying more and more of the same, because you as an investor have a choice of what type of funds you should look at. And before I get into that, your point is very valid that over the last few years, we've had a great run in profits as well as stock prices. Post-COVID, we've had a great 4-year, 5-year run. That created a huge swell in investors coming into capital markets, so much so that people have, started saving only through stocks or SIPs or equity products. So the demand-supply tilt has moved in favor of demand, and it is bidding up prices, it is bidding up valuations. And it is a mathematical rule that if you overpay, you are borrowing future returns. You see great returns today or in the last 2 years, but it means future returns will be moderate. And it's not today that you should worry about. This should have been a matter of worry 1 year back. And last 1 year markets have been flat, zero returns. Small and mid caps are down 5 to 10%. So already the consolidation has happened in spite of record buying. So, just imagine the last 12 months have seen more buying by domestic investors than the prior 12 months or the prior 12 months. Yet markets have finally consolidated and started, respecting gravity, which is valuations. So clearly valuations are high. There is no debate. You don't need to ask me. Numbers show that. Each one has to form their own inferences. So if you want to be a blind buyer at any price, then you will give any argument to justify that. But at 25p, earnings yield is 100 divided by 25, 4%, versus that bond yields are at 6.5%. So relatively, the attractiveness of equity as an asset class is lesser than what its fair value should be. And in that context, as investors, investors have to make the choice that if you're a very long-term investor, buy equities now also doesn't matter. If you are an investor who worries about fluctuations and volatility, choose hybrid funds, choose balanced funds, choose multi-asset funds. There are choices available. So we feel that valuations are high, and the next few years, most likely returns will be moderated. They won't be as high as last 5 years. But there are certain core reasons why, Indian markets over the last 30 years have delivered around 12 to 14% return. It comes from a very core dimension, which is 15% return on capital.
Is the time for 15 PE gone? Is a related question. If buying does not stop, and there's no reason why it should, we're still talking about share of household finances in equity for retail investors or India per se, is not very high. We're still talking about 5% or thereabouts, right? So therefore, if the argument is that more people will come to the fold, more people will buy, mutual funds sahi hai, SIP sahi hai, more money flows in, are the days of lower multiples gone?
I don't know, first of all, and
you can't answer that question.
And I don't think so. Also, one should think that way. The only truth in investing and in markets is nothing is certain, and trends end. They don't last forever, because if they last forever, you will create a 15% return in equity with a straight line, FD type of outcome. It's almost impossible. And look at, again, the last 12 months. Is a classic example. The buying has increased, yet markets have been zero returns. So it is also possible that buying may continue, but yet markets could have some reasons to correct. And remember, for every 5 lakh crore that we have bought, someone has sold 5 lakh crores. We are missing out that other side of the coin. Someone is selling. It doesn't matter to a retail investor or to an investor like me who is on the other side. I have to only focus on 2 or 3 things. How long is my time horizon? What is my appetite for volatility? And accordingly, I can choose an equity fund or a hybrid fund or a fixed income fund, because this buying and selling will continue. And there is immense buying coming from global investors. There is immense selling coming from global investors. It's coming from high net worth individuals. It is coming from promoters who are diluting their stocks, or IPOs are coming. So there is supply as well. So at some point in time, when the tilt moves, you could see sharp corrections. And sometimes corrections don't come only because of buying and selling. There is a trigger, and suddenly you could see a 10-20% drop in markets. We saw that. We just saw it in September to February.
Jan and Feb for the broader markets.
Absolutely. So the buying selling had not stopped. Yet markets fell. Look at the largest and the most liquid market of the world, which is US market, or just take the NASDAQ stocks. Every year, the top 20, 30 stocks have a 20-30% divergence from peak to low. So buying is happening there also. So this notion that we will have permanent flow of money could be a notion of overconfidence and complacency. And this notion of hence buying at any price and not worrying about it just because flows will keep coming is, in my view, not wise investing or sound investing. Sound investing has 2 principles. What you buy should be reasonable quality, and at what price you buy should be at reasonable valuations. Anything poor quality and expensive valuations are generally recipes for poor returns or capital loss.
So then juxtapose that with the whole idea of SIP, because ultimately what you're doing is buying on an ongoing basis, irrespective of the price.
True.
And the argument is that you are adjusting your price, and you're dividing your acquisition over a period of time. And so therefore over the long term it's beneficial. That's the argument. Is this a challenge to that?
So it all depends on the path of returns in the next 5 years. So if let's say my SIP horizon is 5 years, and we have a path similar to 2008 to 13. It was a patch of 5 years where we saw a 50% fall first. Then in 1 year markets doubled. So 100 became 50, 50 came back to 100, and then for 3 years it remained sideways. So in a span of 5 years, you saw a bear market, you saw a quick bull market, and a sideways market. Market returns were zero. The SIP investor still made 8% CAGR return. And in an active fund, it would have been 9 to 10%. So you were not worse off, because the path was a falling market and a rising market. Now, in the next 5 years, if the path is a rising market and then a falling market, your outcomes could be poorer. So you cannot stamp and say that there is only one best way of investing. I think the reason for SIP to be amongst all other options being a better way to invest is because I think 95% of investors who are investing today get monthly cash flows.
Yes.
So do we have any other choice if not an SIP? There's no other choice.
Yeah.
And which is why I would, let's say, this is what I am doing in my portfolio. Every month, my date of birth is 28th. So I do a birthday SIP. मेरे birthday के दिन पे मेरी SIP, I should be buying units.
Sure.
So 20th of every month, my money goes into my multi-asset fund.
Yeah.
So in this cycle, because equities are expensive, I am doing SIP in a hybrid fund or a multi-asset fund, where it is buying stocks also, it is buying a little bit of gold and silver, it's buying a little bit of bonds, because I'm not comfortable with valuation. That's my way of investing.
But
so you have a choice.
Let's talk about that.
Yeah,
because you put this out on an ongoing basis, and I saw a post from you in August talking about your own asset allocation strategy. If I remember the numbers correctly, 39% in domestic equity, about 15% in international equity, and I understand that you look at that as a contiguous whole. You're talking about 14% in gold, and the rest, 34% I hope that my math is correct.
More
I haven't
less,
kept that.
Should be
but is in bonds.
Yes.
And so explain this idea of how you've subdivided. It seems like you're risk averse at this point.
So let me say that this is not a perfect asset allocation, or whatever asset allocation I tell you is not perfect, because it is all individualistic. So my son, who is studying, and I, transfer money in his bank account every month. I transfer 5,000 rupees so that he learns investing. His entire portfolio is equity.
Yeah.
His SIP is all equity.
How old is he?
He's 18 years old.
Wow, already?
Yeah. I have 2 nieces, and their SIP started 2-3 years back. They are all in equity funds.
I say already because I remember the COVID videos.
Yeah, exactly. So he's grown up. So for my niece, 100% of their SIPs are all in equity. In my case, because maybe I am too close to prices every day, and I've started my career seeing a 60-70% fall in the year 2000. I am generally a conservative investor, and I feel that, so my portfolio, the thought behind that is that 60% is in growth assets, which is Indian and global equities, and around 25% is defensive asset, which is fixed income, and 15%, which is joker in the pack, is gold, which in some periods behaves like equity, in some periods it behaves like bonds. So gold, today's 15 was not my desired asset allocation. My desired asset allocation was 8 or 9.
Sure.
But because of price appreciation, it has become 15. So at some point, the fund will auto-adjust or bring it down. So that was the construct. And my logic is that even in this year, let's say a multi-asset fund would have delivered to you equity-like returns without equity-like volatility, because the whole thought is 1 year back, valuations of the small and mid-cap buckets were very expensive. 2 years back, for example, gold had not run up as much. So if you take gold to Nifty ratio, if you take gold to money supply ratio in the world, if you take gold to any other stock market ratio, it was relatively on a lower cycle. It had, it was coming out of a 10-year consolidation in terms of its dollar prices, and central banks were nervous.
De-dollarization.
Governments were nervous with misbehavior of different countries. So I don't have a sound way of taking a view on gold, because gold does not have cash flows.
Sure.
There are some other complex dynamics about
geopolitics
gold.
And
so some of my other colleagues have a framework.
Oh, they do?
They have a framework. We publish it very frequently in Netra. So I get that input, and when other asset classes are expensive and gold has not run up, I will go towards gold. Today again, that worry of de-dollarization or geopolitics, or how you cannot rely on other countries in terms of parking your precious foreign reserves, means there is demand for gold. But it has run up. And hence, incrementally, I will go slow on gold, personally. I'm not saying I have a view on gold.
Sure.
But my bias is to, see, the way I think about it is that very long term, the asset class which has which increases purchasing power every few years is equities.
Yes.
So you have to be in equity, which is why overweight 60 is equity. But can that 60 go to 80 at some point? If valuations come down, it will go to 80.
Sure.
Bonds and gold are parking lots right now, and I'm confused and conservative, which is why my asset classes diversified. If I have to give you a very intelligent answer, I will say my portfolio is broad-based. If I have to give you a very honest answer, I'm confused. I don't have conviction on anything particularly, and hence I'm diversified.
So compare this 60 odd percent, so 39 plus what 14
20,
is slightly less than.
Yeah.
But has it, and you pointed out, it has been higher in the past.
Yeah.
Give me an example of that. I would guess that post-COVID, you might have increased
So post-COVID, I had increased, my funds had increased because most of my investment happened in hybrid funds. So they auto-navigate. So like our dynamic asset allocation fund was at 30% in equities pre-COVID because February 2020, again, valuations were generally on the higher side. So it was only 35% in equities. And then when COVID crash happened by 40%, this 30 went to 70.
Sure.
So the fund took it up. So automatically my allocation went up and vice versa. Over the last 2 years, large part of my equity exposure has gone up through global assets because those markets for last 5-10 years were consolidating or sideways. In between, there were sharper 20, 30, 40% correction in some of the global tech stocks. Asian markets, whether it's Japan or Taiwan or China, they had gone nowhere for 10 years. A lot of European stocks. I've heard many people say that, Europe is like a patient or a prisoner. So a lot of good companies there, or I would say some good companies there, were available at very compelling valuations. So our approach is, it's not about investing in a country. You are buying stocks. End of the day, global is also stocks. So in India, for example, HDFC Bank was, after 5 years of giving returns less than a fixed deposit, it meant that is getting attractive. So while Indian markets have not given return, but certain bank stocks have done well in the last 1 year. Likewise with few global stocks. So a lot of Asian stocks have run up in the last 1 year. And whole logic of mixing global and Indian portfolio is that your long-term returns may still be the usual 12 to 15% of equity compounding, but because their correlations are around 0.6, it's not a 1:1 correlation. So there are, like this year, Europe stocks are up 20%, Asian stocks are up 20%, MSCI emerging market is up some 15%, and India is down. Last year or 2 years back, these stocks were going sideways, and India was up 20.
To that end, in terms of asset allocation strategy, I know in years past we've spoken about when diversified funds, or not diversified, but multi-asset funds and hybrid funds were not as big as they are today, and hopefully they get bigger. But the point is that you would have a strategy towards pure equity, fixed income, and maybe a little gold, right? And rebalancing would be required if there was a huge dislocation or if there was a big run-up.
True.
But the question was, when do you do that? And what are the tax implications? So is that the primary reason why hybrid is now the way to go?
Absolutely. Because either you are an expert yourself who can, at extreme decide whether it's time to go for a 6 or it is time to wear your helmet and gloves and pads and just defend. Either you as an investor can have your own framework, and if you don't know when to play defense and when to play aggression, give it to a hybrid fund. There are amazing and wide range of hybrid funds available. You just have to make the effort to choose them right and then give it to them and leave it for next 10 years. They will navigate.
Multi-asset funds are getting a lot of inflows,
so
which
now,
is heartening.
One thing to always keep in mind is that, and again, learning from 25, 30 years of, making mistakes, is as an investor, you should not get excited about what others are buying. So, many times what will happen, your show is very popular. You are very popular. Your show will say that multi-asset funds are, getting a lot of inflows. So investors will start getting excited about it. But the fact that most human beings are late investors. We start buying a category after the returns have come. And when you buy after the returns have come, it means those asset classes have run up. So one, you should not invest in multi-asset if it's not right for you. You should not invest in multi-asset because last 1 year return or last 2 year return is 18% and higher than equity. Because it can fall. Remember one thing, multi-asset funds have 80% in volatile assets. Indian equity, global equity, gold and silver. All these three have a standard deviation of 15 to 20 units. Only 20% is in bonds. So they are not a no volatility, high return product. Be aware of that. The advantage of multi-asset is that it delivers closer to the best performing asset class over a full cycle at closer to half the volatility. So we encourage investors to look at this dimension rather than last 2 years they have done.
Because so don't focus on the methodology rather than the
returns
outcome
alone
that you've seen over the course.
And that outcome is not your future outcome. That outcome is someone who believed in your show 2 years back. I remember we also had spoken. 2 years back, if you had done multi-asset blindly, was sensible.
But a quick point here. I've read Morgan Housel, as a lot of people have, and he speaks about the fact that hybrid hasn't worked as a strategy in the US. I only ask this because you got to at some point play devil's advocate and say, hey, you know what? It's not necessarily worked in the largest market in the world where seemingly investors have had more experience than others have. What's the reason why it should work here?
So let me, make this very evident and clear to all the viewers. No one's statement, whether it is Morgan Housel or an average Kalpen Parekh, should be taken as gospel truth forever. Everything has context. Now, hybrids in India means Indian stocks and let's say Indian bonds. Indian bond yields have come down. Hybrids in the global context means American bonds, for example. Now, American bonds are down 50% in the last 2 years because their interest rates went down to almost 0 or 0.5%, and now they've risen to 5%. If you see the TLT, which is a 20-year sovereign bond of America, the price is back to where it was probably 15 years back. The Austrian bond, the bond of Austria, the sovereign bond of Austria, is down 75%. It has fallen more than a penny stock. Sovereign bonds have fallen that much. Now, have you ever heard that bonds are safe? We have always heard. We've heard government bonds are safe. But there are so many nuances. If you buy a government bond at very low interest rates, and then if interest rates rise sharply, you will lose capital.
You will lose.
People say gold is a safe haven, but gold also loses money. I'll give you another example. In context to global investing, it is suddenly becoming popular, right? Because last few years have done well. We have heard the statement that healthcare is defensive and large caps are safe. Generally, these are two labelized statements we hear. The largest market cap healthcare company is Novo Nordisk. It is down 58% in the last 1 year. So no label is permanently true. There is context, there is nuance. So globally, why hybrids have not worked is because a large component, the 40% of bonds, have got devastated in the last 5 years when rates have gone up. So I think more than investing in labels, so what do I mean? We say momentum factor is good, value factor is good, growth is good, quality is good.
Or a reasonable price.
Quality stocks are down 30% in the last 3 years, right? Small caps have, speed, but speed will kill. So everything has pros and cons, and 99% investors make these mistakes of investing in labels and not going deeper. What you have to ask is, whatever you are buying, is it inherently sound? And are you buying it at reasonable prices or cheap prices? If you end up overpaying, if we buy something worth 100 rupees at 200 rupees, the risk we are taking is 100 rupees worth of risk.
Closing thoughts, Kalpen, and I know among all of the people that I speak to, you read extensively and you learn on an ongoing basis. You try to learn, I think, from your mistakes, and you mentioned that in the past as well. What is one thing that you remind yourself of constantly as part of your investment journey that holds you in good stead?
I think what has worked for me since 2008-9 is being the opposite of me. So what I was in the first decade of my career journey as an investor was an below average investor, getting tempted by hot returns, getting tempted by fashions, getting tempted by labels, frequent moving in and out, not worrying about tax, looking backward to invest, not being aware of the fundamental construct of investing, which is ROEs, growth, and valuation. This triangle is very important. I think since 2008-9, as more maturity dawned, and with those reflections, I've tried to be a less maverick investor, and that has worked for me. Not being greedy about returns has worked for me. One big, one of my colleagues uses this word, that there are points in time you need to choose strategic mediocrity. So in periods like last 2-3 years when our markets have become very expensive or some asset classes have moved ahead of their fair value, it's okay to aim for mediocre returns in your portfolio versus aiming for high returns and losing capital. We have seen many, solid companies when they cross 70, 80 times on valuations are down 30%, 40% in the last 3-4 years. So avoiding, such sharp drawdowns is a quest for me. It comes at a price. It's not easy. Avoiding these, so whenever these stocks have fallen or these themes have fallen, I have not seen my portfolio getting impacted. But 1 year prior, when they were flying, my portfolio would have earned 1 or 2% lower return. So I think what has helped me is not being a greedy investor. I think the quest is always to be more and more disciplined. And you mentioned about Morgan Housel. One line that I try to imbibe is for reasonable returns for unreasonable periods of time. So I want resilience in my portfolio. And the last point I want to say is that, and this is a big tube light and I don't know how to explain because these big insights are very difficult to explain.
Yes.
The big insight for me is, let's say I had a point of view 3-4 years back when I built a certain portfolio. And my portfolio earned 15% return, which is a good rate of return because my view played out. If an alternate history had happened, where everything opposite to my view had happened, and things would have kept on going wrong, I should have still survived in this game. If not 15, if I earned 8%, 9%, 10%, it's still okay. But if I had earned 20% negative, if I had lost capital because of alternate history, then that would have been a bad. So the fact that I earned 15% and good outcome, but if the method for that outcome was wrong, and I had not survived in an alternate world, if a different view would have happened, that is bad investing. So I always ask this question that, okay, today I have this XYZ view, great. If it happens, great. But what if minus X, minus Y, and minus Z happen? Will I be thrown out of the game? Will I lose my capital sharply and not be able to come back ever? So if you lose capital permanently, that is very bad investing. And these are big learnings I have had from poor investing from 99 to 2008. And over time, then I've learned how to make lesser errors.
And hopefully our young investors can learn from that. Thank you so much, Kalpen, for taking the time and for speaking to me. That brings us to the end of this edition of MoneyWise. It's been an absolute pleasure listening to Kalpen Parekh. Let us know what you think in the comment section and do stay tuned. This is NDTV Profit.
It's just so rare to have you on camera, so I'm excited about that.
Let's have some fun.
Right? Earlier you can get away with it.
Your show is called Building Legacy. I think legacies are going to be created on different paths and different journeys going forward.
The position in a family business and get to that position is actually perhaps harder than people outside look at it.
The next generation of a family has a pretty tough time in the business because they have the name and there are expectations and they're always trying to live up to their name. The flip side is also true. If supposing I'm his boss in the Murugappa group, I know in the back pocket he holds shares of the company. So it does create a little bit of actual tension in that.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell. Yeah.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind?
We watch them every day. Some of us learn from them. Some of us take stock tips from them. But the law is clear. Finfluencers are not allowed to give any trading or investment advice unless they are registered with SEBI. This man did not follow the law, and the market regulator has cracked the whip. Many of you will be familiar with Avadhut Sathe, a hugely popular influencer who broke out into a dance in the midst of talks. Sathe's offices in Mulund and Karjat were raided by SEBI yesterday for hours. It is suspected that he had provided investment advice to unsuspecting followers. Not just that, he is also suspected to have colluded with companies to push penny stocks. It's a shocker, no doubt. And SEBI is sending a clear message across: follow the law or we will come for you. Today on this special show, we will take you through every aspect of this crucial case. But first, let's listen in to SEBI Chairman Tuhin Kanta Pandey, who spoke about fighting fraudsters. He said that speed of information is the market regulator's biggest weapon when it comes to fighting fraud. He was speaking at a mutual funds event in Mumbai. Let's listen in.
As fraudsters grow more creative, we must be more vigilant. Each time such a case is detected, AMCs must act promptly and monitor the evolving patterns in such practices. Such modus operandi may be shared across AMCs and QRTAs as well to immediately prevent recurrence of such cases. Remember, in this battle, speed of information is our greatest weapon.
Now, the case came to light on August 21st when SEBI whole-time member Kamlesh Chandra Varshney confirmed that a major search operation was underway. He did not name the influencer. NDTV Profit subsequently found that the finfluencer in question was Avadhut Sathe. Here's what he said on Thursday.
We have carried out a big search operation on some big name in this industry because idea is, you know, this chairman has given a very clear direction that quality is more important than number. So your enforcement action must be directed at big people where you can show impact. See, what is the idea of enforcement? Enforcement is not for revenue collection. You know, that is, I mean, sorry, I'm using this word because of my previous background. But idea is to create a fear in the market that there is a law enforcement agency, there is a regulator who is watching you, so people follow the law voluntarily. So that is the purpose of enforcement, and that purpose is best achieved by focusing on big people and showing that, SEBI is effectively watching everyone.
My colleague Charu Singh broke the story exclusively on NDTV Profit. She visited the Avdut Sathe Training Academy, or also called ASTA premises in Mulund, a suburb of Mumbai, where SEBI officials were searching the premises. She found that the illegal gains from Sathe's operations could be in the range of a massive 400 to 500 crore rupees. Here's Charu's ground report.
A little over 20 kilometers away from the BKC office of Securities and Exchange Board of India lies Flying Colours Cooperative Housing Society in Mulund. And why is it important? It's important because this is where the corporate office of Avdut Sathe lies, the influencer who has been under the scrutiny of Securities and Exchange Board of India for giving unregistered trading advice. Now, this is a person who has been in the business for quite a while and has offices around the country, be it Bhubaneswar, Kochi, Kolkata, Mumbai and several other areas in the Sahyadri region. And he has a big network of teachers and traders who themselves are unregistered on the SEBI platform and are the people who used to be his old students. Now he is running this business in a way that there are several people on the premises constantly working in a very godman kind of a way, working on a very self-proclaimed God philosophy of trading, where they also have an energy wing where they focus on the resilience and the emotional stability of the traders and keeping them connected with their platform even if they face losses. Now this is a case where SEBI is looking at impounding illegal gains of over 400 to 500 crore rupees, but the search operation is still going on and it remains to be seen as to what happens. We'll keep you updated.
We've all watched Avdut Sathe and know how popular he is among retail investors. His trading methods call for respect for the God market. He calls the stock market the God market. Sathe has regional centers across the country, including in Bengaluru, Kochi, Pune, Navi Mumbai, Ahmedabad, Chennai, Hyderabad and Indore as well. But who is he in reality? Let's find that out.
He has lakhs of followers on social media platforms. Over 9 lakh subscribers on YouTube alone. Many of whom believe in his philosophy that prosperity is the birthright of every Indian. Avdut Sathe's theatrical style, dancing mid-lecture, preaching trading as a financial war, captivated thousands of aspiring stock market traders. But who is Avdut Sathe and where did he come from? A BE Electronics graduate from the University of Mumbai, he passed out in 1991. He studied software engineering at NCST as well. He earlier worked with Deloitte and the Mumbai Port Trust, among other companies, and subsequently began his own venture and training models. According to his website, Sathe has traded in the stock markets in India and overseas since 1991. He has also been associated with Southern Advisors since 2010. In January 2015, he set up his Avdut Sathe Training Academy, or ASTA, promising to train just about anybody in achieving financial independence. Sathe, though, now finds himself in the crosshairs of the market regulator SEBI. Will the man who called the market a battlefield survive the regulatory storm?
Founder of Kushbora.com, Kush Bora now joins me to discuss this case further. Welcome to the show, Kush Bora. Thank you so much for giving us your time. My first question to you is, Avdut Sathe's case is quite a shocker. He kept claiming that he was training investors on financial independence. How does the average retail investor, a new investor especially, figure out who is legal and who is working illegally?
Hi, Malika. Very good evening to you and to all the viewers, and it's a pleasure to be here. I think the answer to your question very pointedly is quite simple. You just have to go to SEBI's website and see whether the the person in question is registered or not. Nowadays, what's happened is SEBI has made these laws and these rules very stringent for anyone who wants to dispense any kind of advice, perhaps even consider training or imparting education. And you could go ahead, register yourself with the SEBI. So if you want to get a very simple answer about who's legal and who's not, I think you should go to SEBI's website, type their name in, and see whether they're registered with SEBI or not. I think that's a very good starting point for an average retailer, especially a new investor who's walking into the stock markets.
Right, Kush. I think it is extremely easy today, and hence the prevalence of such cases, to get swayed away by people like Avadhut Sati himself, despite the rules being present in the system. Now, Sati is said to have made illegal gains of up to 500 crores. How is such a thing even possible, and what lessons must be learned from this case?
Malika, it beats me. In fact, even baffles me to some degree. While I will not comment on the gentleman in question particularly, but let me share something with you. I have been associated with some of the top brokers of the country. I wouldn't name them, obviously, but I've been associated with them on the education side, where I've partnered with them on training, coaching, retail investors on various subjects and various aspects of investing and trading. Now, the reason I bring that up is because I know that some of these arms of well-funded, well-intentioned, and well-meaning brokers also find it very difficult to make a few crores on the education side. I mean, right, of the financial literacy arm that they have, to make a few crores, every year. Let alone being in the profitable side of things, even perhaps even break even because of the marketing and the conducting charges, or the costs rather. So this kind of an amount through training just simply baffles me. So I don't know how such an amount can be made, but at least the entities that I've been associated with have found it very difficult to make make it big in terms of the revenue stream. Most of the brokers end up doing this as a value add service for their retail investors, so that they know how and what to trade in the market. So yeah, I mean, it's a difficult task, keeping the financial literacy arm going. But a lot of recognized brokers do this just to help their investors and traders out.
Right, Kush. Thank you so much for helping us understand that, but stay with us. Now, I have my colleague Charu Singh joining us also. Avadhut Sati is not the first influencer, Charu, facing the long arm of the law. SEBI has acted against a number of influencers in the recent past who had broken the law. Could you take us through the past actions by the market regulator?
In that against the increasing problem of unregistered stock tips and advisory. Now, this has been done to a certain extent by social media influencers who SEBI started calling as finfluencers. Now, this also became something that sprang up to a certain extent during the COVID period, but after that the practice continued, because of which there was a lot of proliferation in the market with fake market advisory, which eventually led to manipulation and innocent investors losing a lot of money. Now, there have been several orders in the past few months and since last year, ever since the regulations came in. First, the regulations came in and they said that any market registered entity that is directly or indirectly associated with any unregistered advisory platform or a influencer will have to face the scrutiny from the market regulator. Then there was the bomb-like order on Asmita Patel, the wolf of market, as she called herself. And then there was another influencer known as Bap of Charge. There are several of them over Telegram, WhatsApp, Facebook, and several other apps where a lot of people have proliferated through different platforms and people are being duped, and SEBI is on the lookout to bring market discipline in whatever manner it can.
Right, Charu. Thank you so much for giving us that extreme list of people who have been busted and caught by the SEBI and the regulators for doing such illegal practices. But Kush Bora, I'll get you in back here. And we were talking about you started this conversation by saying that it is, simply put, easy to distinct between a legal advisor and an illegal advisor by simply going onto the SEBI website and checking for their information. But as Charu recently just now highlighted to us, that cases are prevalent, they keep happening. Where do you think is the leakage then?
I think it's a mix of high expectations, right, from the side of the investors, and that combined with what influencers often think is a very gray line, between coaching and dispensing financial advice. Let me explain what I mean by that. if you speak to anyone who's been in the markets long enough, you'll know that making money is tough. It takes time. But every new investor who comes into the market often comes in hearing stories about how quickly someone made a very smart gain in a particular stock, or how much money they've made. They rarely come in with the stories of how much losses the certain individual would have made, or how much pain they would have gone through in terms of picking the right stocks. So I think it's the first step. I wouldn't call it a leakage, but expectation mismatch. As long as investors come in with a very clear expectation that yes, this is some place that you can make money, even on the side, as they say, you can make money while the markets, while you sleep, markets will work for you. But it's not a get rich quick scheme. So you have to come in with very paired and very tempered expectation. Now that's on the investor side. As far as the coaching, the training side goes, it's I think SEBI is very clear when it comes to this. If you're teaching, that's fine. But the moment you get into the financial advisory side of things, right, be it direct or covert, that's where the lines sort of become black and white. I won't even call them gray because SEBI is very clear about them. Often what happens is, if you want to discuss a particular stock and you're not a SEBI registered advisor, you could well go out and say, teach someone about a particular stock via charts or via their balance sheets, inherently just letting them know that perhaps this is one stock that is on your radar as well, and just seeding the idea in their minds. So the moment the investor or the influencer gets into this kind of territory, the lines are getting muddled. SEBI, however, as I said, is very clear. As long as you're teaching, that's fine. So I think it has to be it has to be a match of two things. One, when you come in as an investor, you have to come in with very clear expectations, understand that money can be made, but it's not a get rich quick scheme. And also from the side of influencers or anyone who's genuinely interested in teaching people about investing and stock markets in particular, as long as you stick to just the concepts, just the theory, just the ideas, I think that's fine. The moment you cross over to discussing, let's say, very specific stocks, the lines get muddled. Best to get yourself SEBI registered in that.
I would definitely want to continue discussing these muddled lines, Kushbora, but there's an important news coming in. Avadhut Sathe has just released a video message to his followers and students. Let's have a look at that before we go back to Kush.
Hello, dear Astayans. This is in reference to all the media reports about SEBI inquiry. Yes, SEBI did visit our Karjat Gurukul residential facility to verify whether we provide any advisory services. And you all know that we do not provide any advisory services. This is Arambha batch going on. It is 22nd of August. It's about what? 10:20 in the morning. Guys, do you get any advisory service here? No. Do you get any tips here? No. So why are you here? Learning. So are you enjoying? Yes. They are enjoying. Yes, and let me tell you, we are fully cooperating with the authorities, and I want you to, not get distracted by any media reports. All right, it's time to repose our faith in the mission. So believe in our mission, and yes, all our sessions, jitne bhi hamare events hote, they are going as per schedule, as per the plan. There is absolutely no change. So just relax and enjoy learning journey. All the best.
Kush, I have to ask you, that video of Sathe, what is your first reaction to this video? He's cleared the confusion around this particular case. What's your take?
Again, I have not read or seen the intricacies of the case, nor have I attended any sessions of the gentleman in question. So I wouldn't comment on him specifically. My discussion is rather more on broad areas of how investors actually get lured in, and how often they get misled by certain promises. But as I said, since I've not attended his sessions, and nor have I read any kind of article or any report that's come out of SEBI, so very difficult to comment on the gentleman. I would refrain from.
Kushbora, but I would then want to discuss and go back to the very lines that we were talking on, right? You mentioned muddled lines, and this especially is, the root of this confusion comes from the distinction that SEBI is extremely strict about, whether it's financial advisory, registered financial advisory, or financial education. As a retail investor, when somebody is giving me advice, either in an academy or online, How do I make that distinction? What kind of information can I feed myself to understand that this is a registered financial advisor and this is somebody who is just trying to educate me about about all kinds of financial related stuffs?
So I think again, I would like to answer that in two parts. One, as long as the legality of it goes, as I said, registrations available, the registration details available plenty on the SEBI website. You can go and check. As far as the course content itself goes, if you know the focus is more on the topics that are being learned, correct? That's when you know that you're learning new stuff. When you're learning to research something more yourself. See, the idea of coaching, at least for me, has to be that it makes you independent. The moment you step out of a classroom, you should be able to go out, apply those principles and be able to identify those stocks or maybe apply those principles and make money yourself. As long as the focus, remains on the concepts, on making you independent about, how to go back and do this yourself, I think that should be fine. If the reliance starts becoming more on the ideas that are generated within the classroom itself, and as I said, I'm not talking about that individual in question, I'm talking in general about how to perhaps identify whether you're getting the most out of a session or not. If your reliance on the ideas discussed in the session, a particular stock idea or a particular trade, if that develops more, then I think you might want to question whether you're learning more, or is it just a stock idea that is being discussed or passed on to you, under the guise of education. So as long as you're learning the concept, be it technical, fundamental, derivative, or just principles of financial financial independence in this case, as long as those are being taught and you go back and you're able to apply them yourself, I think that is fine. The moment the reliance is more on the stocks and whatever investing ideas are discussed, that's when things can get a little muddled. And again, it gets muddled on the training side. SEBI, as I said, is very clear. The moment you discuss stocks, in terms of an advisory format, you have to get registered.
Kush, do you think, as a market expert who has been observing the markets for such a long time, right? Me myself, I was interested in the markets when I started learning about the markets, when I started unlocking the potential it has, especially the fact that equity and investing today is one of the most important means, I think, to create wealth for yourself. Do you think it's because of the increasing promotion or encouragement of investing that's causing these sideline crimes from happening? Is that the reason why this is happening? According to you, I'd just like to get your view on this.
Look, this is a sad or a dark side effect of what is a genuine intent, of getting more and more people under the capital market ambit. Now, what's happened is most people would want to be a part of this journey. See, India, as we know, is on a journey in terms of growth, in terms of financial inclusion. But there is certain expectation mismatch, as I said earlier in the show, which is you want to get rich quick. So as long as that happens, there will always be the other side of it. Now, it's practically impossible to control or curb, every side effect of a genuine intent. But as long as you have, as I said, regular checks and balances, I think that's fine. To answer your question very pointedly, yes, this is a side effect, I would call, of creating a lot of financial inclusion. Right after 2020, a lot of investors came into this fold of capital markets, especially the stock markets, and there will be these expectations of high returns in a very quick time. But but you have to tackle that. You can't throw the baby out with the bathwater. So you have to take these issues as they come about.
Okay, thank you for that comment. But look at the modus operandi of Sathe up on your screens now, viewers. What are the other kinds of fraudsters you have come across in the markets, Kush?
Sadly, some of the other things are quite prevalent, where you've got these pump and dump schemes, where on YouTube you've got certain channels promoting certain stocks, or maybe even in most channels, including actually like yourself and others, where you would find a lot of spam suggesting a particular stock to buy. In most cases, those stocks are illiquid. So you have to be very careful about what kind of stocks you buy and where you get your information from. fake investment apps, I think right now are a big menace where it becomes very difficult for someone to identify, especially a newbie, to identify whether this is a genuine app, because the look and the feel and the entire operations are quite similar to, let's say, a genuine broking app. So that is also one thing. Plus, you've also already got the menace of free Telegram channels and WhatsApp channels passing on informations, getting subscribers on board, free and paid both. So these are some of the other ways that fraudsters or scammers typically try to get in new advice or new retail investors into their fold. So as I said, you have to be very careful about who you're getting associated with, especially if you're new.
Right, Kush. But Kush, despite so much information being available in the public domain, investors continue to fall prey to such influencers. How can SEBI then ensure that the message reaches the most remote villages and smallest towns in India? Because I'm assuming that as an educated person living in an urban area, I would be more aware and I would have the the access to information that maybe a villager might not, or somebody living in a small town of India might not have. How can such mishaps be prevented from happening to these people?
That's an excellent question. And if I can put it on a slightly lighter note, one of the ways a teacher would perhaps discipline the naughtiest kid in the classroom is to make them the monitor, right? So what I'm suggesting with this is, how do these non-registered entities reach those grassroots levels? I think this is something even SEBI or even the authorities can follow, which is partner with or rather have their own education initiatives, or get a lot of people who are into the education or the financial literacy gambit under their fold, and make sure that they through their registered licenses, just for education, not advisory, are promoting the right kind of message, the right kind of knowledge, and setting the right kind of expectations. So it's more about either having your own education programs, which I know the exchanges also partner with brokers. They subsidize a lot of these programs, but maybe you could take it to those grassroots levels. You could partner with already influencers or people who are doing this, as I said, but by getting them under their fold, by getting them registered as an educational partner and not necessarily a financial advisor. So the message is already reaching. It's about reaching via the right means, via the means of people who are genuine and who are registered. So get the message out in a way in which they reach the last mile, the smallest of the towns, because people are already starting to see these videos on YouTube. Might as well have them through authentic sources.
Right, Kush. I must say this conversation was extremely insightful and helpful for all our viewers. And thank you so much for helping us cover this issue with all angles possible. Thank you so much. We appreciate your time.
The pleasure's all mine.
And viewers, that's all we have on the special coverage of the Finfluencer in SEBI's net. We will be tracking all the updates on this case and bring them all to you as the news breaks. But in the meanwhile, keep your money safe and don't trust any investment advice given by anyone who is not registered with SEBI. And stay tuned to NDTV Profit, of course, for accurate information that you can trust.
Just so rare to have you on camera, so I'm excited about that.
Let's have some fun. Right?
Or earlier you can get away with it.
Your show is called Building Legacy. I think legacies are going to be created on different paths and different journeys going forward.
The position in a family business and get to that position is actually perhaps harder than people outside look at it.
The next generation of a family has a pretty tough time in the business because they have the name and there are expectations, and they're always trying to live up to their name. The flip side is also true. If supposing I'm his boss in the Murugappa group, I know in the back pocket he holds shares of the company. So it does create a little bit of actual tension in that.
Tamanna, thank you so much for coming here. So not that.
Welcome to this episode of Building Legacy, a series that takes you inside the engine room of India's most enduring family businesses. From legacy to leadership, from emotion to execution, we unpack the delicate balance it takes to keep a family enterprising thriving across generations. In this episode, we focus on one of the most defining challenges perhaps for any family business. How do you prepare the next generation to lead? As global ambitions rise and generational values shift, the baton of leadership is no longer passed down. It must be earned and reimagined. To take this further, we're joined, as always, by Mr. Janmejay Sinha, Chairman of BCG India. And we have a very special guest today, Muthu Murugappan, CEO and whole-time director at EID Parry. Now, of course, the Murugappan Group represents the fifth generation of the family, Mr. Murugappan. They are custodians of one of India's oldest business legacies. Founded in 1900 as a small banking and money lending business, today the Murugappan Group has grown into a diversified industrial powerhouse with a strong presence in sectors such as agri-solutions, financial services, engineering, auto components and beyond. So how does a legacy built over a century stay relevant in a world changing every minute? Let's start from there. Thank you so much for joining us, Mr. Murugappan. Thank you so much, Mr. Janmejay, as always, for being here with us.
Pleasure.
Yeah, I'm going to start with you, sir, just because, it's just so rare to have you on camera, so I'm excited about that. And speaking about it, do you think that the position in a family business and to get to that position is actually perhaps harder than people outside look at it?
So, Tamanna, thank you so much for having me on the show. So I think one has to put in the hard yards to progress in a family business. Different families approach it different ways, but I think if you really want to be creating value, I think there's no shortcut. I think you need to go through the hard yards to actually get there.
Tell us a bit, set the context for this conversation about this group. Very understated. I think in the popular imagination, people don't realize how large and powerful and diversified it is.
Yeah, it's always interesting when three generations are almost involved with a business. In the Murugappan case, in the Murugappa case, he's the fifth generation, the fourth generation is also in business. And the third generation is just retired, a little while ago, not just retired, in 5-10 years ago. And they are all present. So there are the values of the group. And then there has to be the energy in the group. The values of the group and the generational shifts cannot in any way impede the energy that India today requires. In terms of growth, in terms of diversification, in terms of new businesses to enter. And the family has been doing very well. It remains hidden, but roughly speaking, they would have a market cap today of around $50 billion, and it's not that apparent and that well known. So it's a big deal. If I look at this family versus some of the others that we've been talking with, they put these guys into the grind more before they rise, and whether it's good or bad, they have to answer, but you have to enter, you have to earn your stripes, and then you slowly graduate. As we were talking before the show began, he joined the board of Mahindra before his own family company. So that they have to explain, and you should ask him, how you feel.
We've always debated this. We've debated this within the family, and the two of us have debated it as well. The apprenticeship period, the length of the apprenticeship period. So, my career in the family business, a career at Murugappa started in 2007. I was at an FMCG company for 3 years prior to that. And I was appointed CEO of EID Parry in 2022. So longish apprenticeship period. When you speak to peers, there's different views on that. But
What's
we've
your
often
view?
debated. Slightly shorter would have been better. I think it's only good to have built all of that muscle, say, by around the mid-30s, and then you really get on to a leadership role, and then ultimately have the chance to be a very active board member. But I mean, I'm not at a significant disadvantage. It's just, I guess, a shorter one can also enable much more rigor. Let's just say it's about 10 years or so. Then I think a lot more rigor can be enabled, which builds a lot of muscle.
But let me come to your experience, because you spoke about your first stint with an FMCG company, Care.
That's right.
Before you came into the group, was it always a given that this stint at Care is something that I'm doing for a bit? Was this destination always clear to you? Was it pre-positioned?
Destination was largely clear. I mean, I did a high school internship. There was a gap between, finishing high school and university, a couple of months. So I think I did an internship in the group for about 3 or 4 months. And I think that was more done to see if, I had any interest in all of this at all. And I think that was established.
How do you gauge that? If you turn up every day in your internship?
Yeah, I showed up every day, and I traveled with the team. I had certain outcomes which I had to generate. So all of that happened well, and I also came back home quite excited every day, and I went to university very excited about what the group was doing. So that was the destination. I think towards the end of university, there was conversation around the merits of, say, working outside sort of started happening, and that's why I took the plunge. I was interested in branding and marketing, and that's why Care. So it was a 3-year stint, and then I joined the group after that.
I think that the tricky bit over here for a lot of families, and I'm not talking about this one in particular, is to decide whether, for want of a better word, the heir apparent is actually well suited for the role or not. What has been your insight on this, Mr. Sinha?
But first we should put it on both sides, Is the heir apparent interested?
Correct. That would be one of the criteria, I would suppose.
Yeah. So if you look at, I would think there are 6 or 7 people of his generation. And some of them are not in the business. So they have chosen to do other things. They have created their own business, or they manage money, they do other things, And so there is the first level choice, whether you enter the business, and then whether you want to enter as an owner manager, or do you want to actually sit on the board and have that different perspective. So those are real choices, right? I mean, and this family had a very interesting thing. They used to have an advisory board that used to actually evaluate the family members.
Oh, so you go through that rigor.
Yeah.
Yeah. Was there at any point for you an alternative in your mind of not necessarily having an executive role, but maybe being a custodian of the family business in another way? Was there at any point that plan A, plan B in your mind, or was it always clear?
So great question. Actually, COVID time was, I guess it was time for reflection for a lot of us. We were all at home, and I for a fair amount of time debated whether I should have an executive role or take a more a passive role and be a board member. In fact, Dr. Sinha and I debated it quite a bit. There was a lot of internal family debate as well, and then we chose the executive role. So yes, this dilemma was fairly recent.
What was the alternative, if at all? What else would you have done or would have liked to do?
I think the alternative was to be more a board member, so more be passive, be involved perhaps in certain projects and certain strategic projects.
Could I just interrupt? I don't think he means passive, So there are 3 ways you can actually work. You can actually be an executive in the company, or you could be an active board member as a chairman, where you actually employ CEOs and you have a holding company which you actually direct in the role of a chairman or in the role of an active board member, which is different from a passive, an independent director of some other company. This is because you are a promoter group.
Correct.
So you're never really just an independent director, right? I mean, you're a promoter group member on the board. And so to learn to be an active owner on the board is not so simple.
Yeah.
It is distinct from being an independent director. Because if you really look at a board, it basically does performance and conformance. You have to ensure being on the board, because you have fiduciary responsibility.
Correct.
That you don't fall foul of the laws of the land. And then as a board member, you allocate capital, you agree strategy, you hire the CEO, you pay the CEO, you monitor the strategy, you monitor some risks, you take big decisions of JVs and M&As, etc. So those are active jobs, on the board. Then you can be an executive, actually doing sales, or you can be doing marketing, which becomes a little different. But I just was objecting to his use of the term passive,
So, fair enough. I think thanks for the clarification. So, I guess the way I meant it was, not day-to-day involved in terms of, having executive responsibility for the business.
But that is something that you enjoy, and you
yes.
love
So
the
that
challenge.
I guess that's the role that I took up. I think it is a lot more involved and intense. So it took a little bit of settling down, I will be honest. But I think certainly enjoy, and I've learned a lot. I think the knowledge I have about the company and the people and where we're headed, I think it's really chalk and cheese compared to if I would have had a non-executive role.
Perhaps the lengthy apprenticeship has worked out favorably in this context.
So I think the apprenticeship, I guess, always continues. When you're running a company, I think that is you're really put to the test.
Yeah.
So I think the apprenticeship certainly continues.
But there are various paths, and this is something that we were discussing earlier as well. The path to the board for family members, when it is a large business family like yours, need not be that one path or a very traditional conventional path, isn't it?
No, I don't believe so, and I think you're very right. And especially in the times that we live in, I think there are perhaps multiple paths to the board. As Dr. Sinha was saying, there are members of the family who are not involved in the business. My brother's a filmmaker, remains a shareholder filmmaker. There's members who are entrepreneurs as well. Outside of the business, they have some roles in the business. There's members of the family who have, more project-oriented roles or, more strategy-oriented roles, and some like me who have executive roles. So I think the family has really accepted this very nicely, and perhaps a lot of Indian families will going forward, because I think that's the times that we live in. Your show is called Building Legacy. I think legacies are going to be created on different paths and different journeys going forward. I mean, if I was to look back at our own example, legacies were perhaps largely created within the business. I think we're really moving into an era where legacies perhaps could get created with the business or within the business. Legacies may be created outside of the business as well, but I think they will all remain trustees of the family.
Yeah. What are the lessons here which are important, Mr. Sinha? Because, if we are addressing right now an audience of people who are aspiring to build a legacy in their businesses, continue their family businesses over generations.
First, let's have some fun.
Okay, always.
Let's put him on the spot a bit, right?
Oh, only you can get away with it, so I hand it over to you.
So, his father is in the business, his uncle is in the business, cousins are there, How easy is it to deal with your father? How easy is it to deal with your cousins? Do you lack autonomy? Do you have to sort it out at dinner at home, or do you sort it out in the boardroom? How do you deal with some of this? People would like to know,
So, different ways of sorting different things out. I think you've all grown up around each other, so I guess you all know where and how everyone is wired. But there is the underlying value system, I think, which everyone in the family gets. Of course, there's always going to be differences of opinion, disagreements. Sometimes a lot of agreement as well. I mean, no one specific answer. I think some of these are done over a game of tennis or golf. Some of these have to be done in the office. Some of these are perhaps done where on vacation in Kunur in the Nilgiris. So I guess you got to pick the place, pick the time, and I think you'll have to really pick the tone of discussion as well. I don't think there's one playbook. This is muscle which you build out of experience and just out of self-awareness, really.
Yeah. Is there a mechanism in place for resolution, or is it at the end of the day the senior most takes the final call and it ends there?
Not exactly. I think we've always Dr. Sinha has been on the advisory board, so we've always had the benefit of having very trusted members of the board or trusted advisors to the family. We've often used their wisdom and their intervention as well, and that's also helped on a lot of occasions. So we do turn to that oftentimes.
I wonder when there is, in this scenario that you've described, and thank you for that question on my behalf, but in the scenario that you've described, there will also be professionals in play apart from family members in key positions. How does that dynamic work? If you'd like to answer that.
So I think we were very early to professionalize. I think at the turn of the century, we professionalized, one of the first family businesses to do so. So I think we've all operated in that environment. A lot of us have worked outside as well, so we really understand. And I think that's one of the benefits of working outside. You understand what it is to work in a professional environment. So no one really brings an attitude to work saying, hey, I'm anyway going to get to take the final call. There is a lot of consensus building which is done. We've often had professional managers and professional leaders also prevailing on certain decision making, because they brought very good and very sound logic to the table. So I think issues are really dealt fact-based, merit-based, and I think that's how we've largely progressed.
My own perspective on this is that, firstly, the next generation of a family has a pretty tough time in the business because they have the name and there are expectations, and they're always trying to live up to their name because everyone is saying, they have it easy, and they then put pressure on themselves, right? And then even in the flip side is also true. If supposing I'm his boss in the Murugappa group, I know in the back pocket he holds shares of the company, so it does create a little bit of actual tension in that. But then the people who have spent time, also learn to work with the family, and they are respected, they know how to navigate the family. Now, every company, you need to navigate the company. Whether it's BCG, you need to navigate our own selves, within a company. So it's not that in any company you don't need to navigate.
No, but I suppose a family or a business that has that kind of legacy over time also knows how to treat the professionals who are coming in and the value that they bring. I don't think it's a clear black and white. And any perspective on this? Did you ever have a boss in your journey up there who you felt was a little hesitant to take you on, or was that never the case?
No, never the case. I think I've had maybe 3 bosses in the group. I think they were all senior leaders, either directors on the corporate board or MDs of companies. So never hesitant. I guess they knew that we were brought up, in that environment of professionalism. I agree with what Dr. Sinha said as well, but I think they were comfortable to take me on. And you respectfully disagree with them and on certain topics, so on and so forth. But I'd agree with Dr. Sinha. I think by they build that experience of learning to work with the family and work with the group. For example, on a certain issue, a professional leader would straight away, and if there was let's just say there was a situation at the factory, it was a labor situation or whatever, and he'd brief me, and he'd sort of straight away say, I think we need to do a briefing to your uncle as well, because he'd be concerned about this issue. So he knows perhaps, what are some of the areas which he also likes to watch closely. So I think that experience anyway gets built.
Just, your take on running a large business and building a legacy in modern times, when traditional wisdom would tell you, let your work speak for yourself, let your balance sheet speak for yourself, let your company's results speak for yourself. But we're in times where you have to speak a little louder than that. You have to be out there, your brands, your logos in the collective memory. That is something that the group has always shied away from. Do you think that's the right path going forward in this day and age?
So I think, we do what's necessary. I mean, you'd see us doing earnings, you'd see us, sometimes there are events wherein the group participates in, there's not too many consumer facing businesses in the group. There are some, there's, a lot of stuff done on the advertising, on the promotional side. So I think we do what is required.
Individual leaders, we're living in a time, and especially with so many new age businesses coming in, where the promoter / leader is a brand in themselves, and they really put themselves out there.
Yeah. So, I think we like it a little understated. I think we're comfortable with that. I think I think it helps us focus on what we're meant to do, and which is create value in the businesses. I think we've had a lot of success stories. We've had some which haven't worked out as well. So I think we're comfortable with being understated. But I would say, compared to in the past, we're certainly a little bit more out there than what we would have been maybe a decade and a half ago.
Let me ask you an unfair question, and I'm telling you it's unfair before I even ask it.
He loves doing this.
That's why I love having him on the show.
So, do you think in a normal family which doesn't have a business, you can be closer to your cousins than in a family where you have a business also?
Wow, that was a googly. It's a nice one.
I mean, the answer really depends. It's a tricky question. I guess the pressures of the business and differing views in the workplace can certainly impact familial relationships. But I think it's very important to have very strong open lines of communication, because otherwise they will break down. Because at the end of the day, there's the workplace, and then there's home and there's family as well, and it's not easy when familial relationships are strained, and that takes a toll when we're not in the workplace. It certainly takes a toll in the workplace as well. So there is truth to your question, but I think on the flip side, I think there's perhaps that much more you need to do in terms of building familial relations, building strong communication, so that these bonds remain intact, because a lot of cousins in all family businesses would have grown up together. So you've literally been to school together. You've played as children together. You've grown up through your college days together, and then the business being in a family business can change things. But it's very important to work on.
We had that discussion long ago in one of the early episodes, that if you look at Europe, families have tried to stay together. In India, we have created conglomerates, so different members look after different businesses.
Parts of
Actually, their family for a long time has actually been European in a sense. They've had one head managing all the different companies. Of course, the companies having some professional CEOs, some family members, etc. So in a sense, a more evolved kind of European conglomerate, but they have had a conglomerate. They've had multiple companies, not just one company where a lot of members are part of. But it's different from just some of the other families we met, where each side has taken a different part and they manage that part alone.
Any advice that you would like to give either to the next generation? I don't know if the next generation is already being groomed, generation number 6.
Oh, generation number 6 is, some of them have had their first day of kindergarten earlier this week. So, I mean,
I'm sure there's
it's going to be a while. But yeah, I think the oldest in Gen 6 is 10. And yeah, as I said, some of them have started kindergarten earlier this
Fair
week.
enough, but is that, like I said, we're in a very different day and
Sure.
age. So would those expectations be very different, or their experience be very different in this family versus, say, yours?
I think they're very likely to be different, and we talked of these different paths and creation of legacies on different chosen paths. I think that's how I think our legacy is going to get built going forward. There will be the core Murugappa legacy, which will continue. The businesses will continue. But I think legacies will be built very differently. With this generation as well, yes, perhaps, and I think a lot of us as parents amongst cousins are going to probably give these children a whole lot more, independence. Not that we didn't have the independence, but I think they're going to grow up in a completely different era.
Yeah.
So it really remains to be seen, but probably will be very different. I'm sure we'll be around to talk about it when at the right time.
Yeah. We really look forward. Thank you so much to both of you for joining in, and what an excellent conversation. Great insights into what it takes to build the legacy of a business which has lasted 150 years and going strong. Thank you so much for joining us.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. as profit.
Do you really know the company you invest in? What is the real picture behind?
This promises to be India's answer to reducing dependence on imported lithium-ion cells. These are batteries that power electric vehicles. It's bold, it's ambitious, and it has its fair share of naysayers who question whether Ola can pull it off. In fact, we have the man himself. Bhavesh, thank you so much for joining
Tamanna,
us.
thank you so much for coming here. It's not that far from Bangalore.
Only 4 hours.
Only-
But you know, this is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're
Yeah.
going to be on the factory floor.
Absolutely, yeah.
And of course, a lot of questions on what this plans to do.
हर नई चीज़ पे सवाल होने भी चाहिए मार्केट के जो सवाल हैं दे आर ऑल द राइट क्वेश्चंस इज दिस द राइट यूज ऑफ कैपिटल इज दिस द राइट थिंग फॉर इंडिया बट आई एम गोइंग टू स्टार्ट विद पोजीशनिंग दिस इन द मैक्रो कॉन्टेक्स्ट इन विच वी फाइंड आवरसेल्व्स तमन्ना टैरिफ्स रेयर अर्थ्स नहीं मिलेंगे हमें यहाँ से ऑयल मत खरीदो वहाँ से मत खरीदो वी हैव टू बिल्ड आवरसेल्व्स आवर प्राइम मिनिस्टर टुडे has painted a technology vision for Viksit Bharat 2047, and at the heart of India's future is going to be the next energy technology, and what we are building here is the next energy platform of the future. It's not just for making the EV transition, it is for making the whole energy transition. These cells इतनी बड़ी फैक्ट्री में छोटे से सेल निकलते हैं but you know, you can imagine then you need such a big process to really make those really high-tech cells. All the technology is built by us in-house, and we'll go through and I'll show you, we'll wear the suits, I'll show you how the process is so automated, so quality controlled, dust-proof rooms. And these cells go into EVs, they go into drones, they go into robots, they go into grid energy storage जो solar के साथ लगती हैं. So this is the energy platform of the future, and India needs to have its own, and we are here today standing at India's first gigafactory.
Fantastic. Let's go inside and take a look.
So you can see here, this is the full scale model of this whole site. And this vision that you see here is going to be 100 gigawatt hour. Just to contextualize that, today the world produces about 1500 gigawatt hour. Almost 80-90% of that is in China. So this site alone eventually will be 100 gigawatt hour.
What are we starting with right now?
So what we are starting with is this first block you see here. So
no, in terms of 100 gigawatt,
5.
We're starting with 5.
What you see today is 5, and the same building will scale up to 20, and then the 20 will scale up to 100.
Okay.
Yeah.
Okay. So how long has it taken to build the entire facility?
The facility took about a year, and then we put all the machines in. So for the last 1 year or 1.5 years, we've actually been fine-tuning our process. And the process goes through a lot of steps, and it's highly complex each step. And छोटा cell बनाने के लिए इतने सारे step लगते हैं.
Yeah, of course. Of course. You know, the question is that why has India not been able to, when you started very
Yes.
well, because you talked about the importance of this
Yes.
in terms of tariffs, in terms of Atmanirbharta. The question is, why have we not been able to do it hence, thus far? What really is the problem?
See, for India to make a big leap into this, we made a big leap into renewable generation.
Yes.
With solar, with wind, etc.
Yes.
The next phase of renewable is equally, if not more important, which is storage. And storage is more technology intensive, R&D intensive. And in general in India, we've taken the leap on manufacturing, but we're still early in the leap on R&D.
Agreed.
So that's why what you see here, a lot of it is, and you can see here the lines are producing, the cells are coming out. Right, so these are the finished cells, and when I'll take you inside, so we'll see actually किस तरह से वो material से cell बनता है इस पूरे line में. So it's very R&D intensive. All the technology we had to create in-house. So it took us also 4 or 5 years.
You know, this is interesting you say that, because this is being seen as a good thing and as a bad thing. The negative in it I'll talk about first is the question that is coming, that since you're not doing this with any large partner that is established globally,
Yes.
will you be able to manage the efficiencies that others do have in this space?
Yes. Well, we've been at it for 5 years now. When Ola Electric started 5 years ago, we started with our cell R&D. So we've also improved our processes, improved engineering to a level where our efficiencies are at the same level on global benchmarks. Our scale is lower than global benchmarks, but our technology and our process efficiencies are at the same level. So as our scale improves, our cost of manufacturing will also be equal to global benchmarks. And also for us, this is not a 1 year, 2 year vision. It's a long-term vision. As we keep increasing scale, India is going to be a large consumer of these cells.
Yeah.
We ourselves, as the leading EV company, but also across EV, energy storage, बहुत cell लगने वाले हैं. So we will need the whole capacity, and that will provide us the impetus for scale.
Here's where all the magic happens, and of course there are various segments of it. So, you know, the idea of a modern day factory is few people and a lot of machines. And I think one interesting thing over here is that it's led to a large part by women running the shop floor.
Almost 99% it's women. So I would say it's all women factory. Even our automotive factory is an all-women factory.
That was a conscious decision?
Yes, very conscious decision, because in India, one of the reasons our workforce has lagged behind is because women participation is low. And it's not because the women can't do it. It's because there's a little bit of mindset in the industrial communities that are women good enough for the industrial work. And our factory has been, automotive factory has been working so smoothly for 4 years now. So we've scaled that up into the gigafactory, and you know, the women are doing such good technical work. And if I can say this on camera, Tamanna, women are better than men at this work.
You can say it on camera, off camera. I think it's true.
They're more disciplined. They don't take random breaks, and they're more dexterous with their hands. The women are better hires than men. I hope I don't get into trouble for this.
No, I don't think you will. Okay, so now of course we have to wear protective gear, right? When we're getting in.
You know, because I'll tell you why we have to wear protective gear. This process of making the cell is extremely sensitive to moisture, to dust, and to any environmental impurities. So we have to cover our skins because our skins release moisture.
Okay.
So sweat, right? So we have to cover ourselves in these suits so that the ambient temperature inside remains at a very controlled level. Cell manufacturing is second only to semiconductor in terms of complexity. Semiconductor, you will see similar suits and similar clean rooms. So just like that for cell manufacturing.
Okay, let's go. Okay, so tell me what we are looking at right now, Bhavesh. What is this section that we are going to?
So the whole gigafactory, the cell manufacturing process is extremely clean. Humidity control, dust control, other impurity controls, very high degree, because the cell is at a micron level.
Which is why we've had to wear all of this gear.
Sar ke upar, pair ke upar, sab jagah we have to wear all this because we can't let moisture from our skin go into it. Now we are entering into the assembly process.
Okay.
Yeah, so we'll enter into this cleaning room.
Oh.
Yeah.
And we have to wait here?
We'll have to wait here. Wind will blow. So this is for whatever, if we have some impurities, they'll go onto the sticky carpet.
Wow. This is quite an experience. Okay,
so this is what we call this is where the magic happens. This is the assembly process.
Okay.
So there is another much more, a very more tightly controlled process behind this, which is called the electrode process, where we get the powder from outside, put it into a mixer, and out comes a roll, which roll we see over there. So let me show it to you.
Okay.
Yeah, so what this process gets as an input is these rolls. So this is the anode, and this is the cathode.
Okay.
Right, so
this is safe to touch?
Yeah, you can touch while you have the gloves on. Yeah.
Okay.
Yeah. So ये anode खराब हो जाएगा. We'll no, it's okay. Don't worry. Minor thing. But so these are heavy. So these are wound very tightly. This thing you see is the material.
Yeah.
Anode, cathode, which goes into these big machines over here, fully automated.
Right.
And you can see we put the anode roll, put the cathode roll, and then it winds it. It's called a winder. It winds it into this jelly roll.
Okay.
So it's called a jelly because It's supposed to be soft like a jelly, but it's not because you have to wind it very tight.
Obviously.
But it looks like a jelly.
So this is this actually, my thumbprint actually went in.
Yeah.
Because it is.
Yeah.
It's got that kind.
So what will happen downstream is all these things will get actually compressed, firmed up. So you'll press it like this to firm it up.
Okay.
Yeah.
So this is the entire gigafactory. If you
Yes.
want to understand what comes out of it, it is this size.
It's this size, which is the cell. This is still not the cell. It'll go into a container which will then have electrolyte inside it.
Okay.
Yeah, so this is the output of this step.
Okay.
So you
got
take
it.
this inside, two of these, and you output this.
Okay.
Yeah.
Got it. So Bhavesh, let's talk a bit about why this gigafactory is such a big deal and
Yes.
why there is in terms of your financial goals, because your Q1 was blockbuster, right?
Yes.
Huge increase in gross margins.
Yes.
Your view and bills of materials came down, etc. The vertical integration is what the state seems to be very excited about.
Yes.
How does getting this gigafactory up and about actually play into that, and when do we see the magic of your own batteries in your thrillers?
So the heart of a vehicle is the cell, EV especially is the cell. Just like in the ICE era, the heart of the vehicle was the engine.
Yeah.
And the biggest cost driver, the biggest performance driver, everything is the cell. So if I hold that and show you, so about 40 such cells this size go into our scooter.
Okay.
Yeah, so you can imagine the amount of material that goes in. So the biggest anchor of our vertical integration strategy is the cell. Already, like you said, our Q1 results had a lot of gross margin improvement with a lot other vertical integration. For example, the motor, the electronics, the software. And now the cell is the next phase of that vertical integration. When our cell comes in, that gross margin will further go up. So, and that cell coming in starts this quarter. So one of the reasons I wanted you to come here and for you to see is that the cell is ready. And the cell is going into our products. And I want you to see this. So you see, it's fairly complex process, fully automated. The girls are only monitoring the screens.
Yeah, this is amazing. This is amazing because practically it goes through.
So by the time it comes here, it already flattens the surface.
Yeah.
And that machine is separating the cells into different grades. Top grade, one level lower. So the one level lower will get redone. And if I show you what the girl does, so there's no manual intervention. The girl operates the computer.
Okay.
So it's a very high quality manufacturing job that gets created in a factory like this. So all these kind of, she's monitoring the system. If there is any alert, she will deal with it on the system itself.
Okay.
Yeah.
So coming back to this, the gigafactory, this is of course, the exciting thing about it is this is part of the PLI scheme.
Yes.
And in second quarter, the PLI scheme incentives are also expected to kick in, and that also helps you, of course, in terms of EBITDA, etc. The one concern was that have you stuck to the timeline to be eligible for those PLI incentives?
Yeah. No, that's a fair question. We have also decided that we will not expand beyond 5 gigawatt hour right now.
Okay.
For the PLI, we had to grow till 20.
Okay.
So, but we're the only one in that scheme who has put up a factory and is producing commercial cells.
Yeah.
So we are engaging with the government and telling them that we might need a little bit extra time.
Okay.
And the government is fairly empathetic because of the complexity that goes with this kind of a manufacturing setup. The fact that it's the first in India appreciates our point of view on this. Yeah.
Okay, so to be fair, the gross margin expansion has happened without the PLI incentive coming
absolutely.
in. Without the possibility of the PLI incentive being delayed, do you still become EBITDA positive on your auto segment?
Q2, that's what I've told the street in Q1 results.
Yeah.
And we are on that path.
Yeah?
Yes.
Okay. What is demand looking like? I know it's in a gigafactory, but you sell bikes, so have this vantage point of seeing what demand is looking like.
Yes.
And there's an unclear story there. One side of the speed, some companies say consumption is picking up, others they're not.
Yeah.
What is that looking like for you?
See, I think the EV story, penetration story, where it is still very early. So there's a lot of headroom to grow the EV penetration story.
Yeah.
We have a scooter portfolio where we have a very strong position. Like I was mentioning, we have sold almost 1 million scooters. The next player has only sold less than 6 lakh vehicles. So we have a very large scooter franchise in EVs.
Yeah.
Scooter penetration is now almost 20% in EVs. The next phase is motorbikes, and our motorbike story is picking up. We are being gradual. We started from South India, launched about 200 stores with our bikes. This month and next month we will scale it up to all our stores. So the Roadster X and X Plus consumers have given us 2 thumbs up. So it's looking very exciting, and you will start seeing very good numbers as we ladder up into festive.
Okay. So, the festive push, apart from the great numbers coming in, what do you think your market share is going to look like? Because your Mark, you were up here.
Yes.
You were the guys who dominated the market.
Yes.
So 50% plus.
Yes.
Then all the big boys woke up and,
Yeah.
"Arey, EV to humko bhi bana."
So
Then they've come in and your market share now has improved back at
now it's rising again. 20% is where it is, right now.
Where do you see it going?
See, you mentioned the trajectory well. We were about 35 to 40%, before our IPO 1 year ago.
Yeah.
And since then, other incumbents have come in with more scale and more products, and our market share has gone down to the high teens, and now it's inching back up. What I see is, what work we did over the last 2 years, other OEMs are doing now, which is build some products, scale up distribution, get some consumer mind share. But we've gone to the next game already. The next game is actually to make money with EVs. To make money, you need the vertical integration, you need the technology development, you need the product portfolio. So Ola Electric's core strategic pillars, which are 3: vertical integration in manufacturing, our own technology development across the stack, be it cell, software, electronics, and company controlled front-end distribution. These 3 are helping us grow both profitably and inch back market share. So now, as you see over the next few months, and especially as we ladder into festive, we aim to claw back market share, and we also aim to have a steady state market share of about 25 to 30% in the two-wheeler EV segment.
Do you think that the company has crossed that hump, those concerns from customer service perspective? That was something which was a pain point a few months ago. Do you think that has receded? And especially, I think, with the newer models that seems to have receded.
Absolutely, Tamanna. Well, we had a challenge last year where our service network was not as big. Our sales network had grown, but our service network we hadn't scaled up fast. Yeah. So then we spent time investing into scaling up our service network. And now our service network is almost where we want it. There's still another quarter or so of effort required. Customer service complaints and all are now fully taken care of. It's roughly where the industry average is. Now with our new products also, the Gen 3 products, the warranty claims, customer complaints are much lower because it's a much better product, more in-house manufacturing, the motor controller, everything manufactured in-house. So as a result, we have a much better product. And the customer adoption of the Gen 3 product is very strong. So we have both our Gen 2, Gen 3 products in the market. Gen 3 now contributes to almost 90+% of our sales.
The last time I spoke to you was before your IPO.
Yes.
And the Bhavesh pre-IPO and the Bhavesh after Q1 of FY20, it's a very different person.
Is it?
From my perspective, I speak to a lot of CEOs. So from my perspective, I can see that you have tried to figure out what the street wants, what investors are saying.
Yeah, no, that's...
Has there been a bit of a journey? Because you've been a passionate creator.
Yeah.
You started this journey as a creator. I have an idea and I want to create.
Yes.
Now you have to manage a lot of stakeholders.
No, you're very right, Tamanna. It's been an important learning journey in my journey as an entrepreneur. Specifically 2 things that we have learned as an organization and me personally. How we need to do smarter capital allocation and how we need to do operational risk management. Especially as a public company, the yardstick is higher, and rightly so. There are more people who are invested in your journey. The way we have to manage operational risk also is broader and more deeper. So we're learning those skills, and we're learning them by adding people who have been through this journey before. We're learning them by ourselves, reflecting on some of the learnings. And I do believe today the company is in a much better trajectory of a balanced, profitable growth journey than where we were maybe 1.5 years ago.
What happens in terms of, does this realization and these new responsibilities as someone running a public listed company now temper some of those ideas, the maverick part of you?
Not at all. Not at all. I think it adds a layer. It doesn't temper anything, but now it's a more holistic way of managing business, or my approach to entrepreneurship is more holistic. The ambition, सपना तो वही है, but सपने को पूरे करने के लिए जिस तरीके से आगे बढ़ना है वो थोड़ा सा nuance हो गया.
Let's see the battery. I want to see.
Yes, the battery is all the way down that side. So shall we walk back?
Yeah. Okay. Let's walk back.
So this whole line, like I said, starts from that electrode roll. We make the jelly roll, and there are almost 25-30 processes that happen in this line, fully automated.
Okay.
And each step is manned by a girl. Actually, I shouldn't call it manned, woman by a girl.
Yeah.
Yeah, and that's another important story, Tamanna. The amount of change of life that a girl has when you give her employment in a place like this, a rural community.
Yeah.
Right? The whole family's life changes.
Correct.
And we've seen that goodwill be there for us as we've given all these girls a very respectable job.
No, and employment in manufacturing is huge. You know, I want to come back to something that you said right when we started this interview, when you talked about the world we're living in.
Yes.
Tariffs. Someone says, don't buy oil from here, don't buy oil from there. A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what we're trying to do to solve that problem.
Yes.
And right now, of course, only for Ola, but does this become something that, you know,
we can do broader.
Forward.
Yeah.
So tell us a bit about that.
Yeah. So I think the geo-strategic landscape, Tamanna, is increasingly getting more complicated. And I think there's broad consensus that the geostrategic landscape is only going to get more and more complicated over the next few years. As countries now start looking out for themselves, globalization is going through a different phase now. So, and this is also coming at a place where in India's journey, we are looking towards a Viksit Bharat dream, like the Prime Minister has said, where we have to develop ourselves. Now, how do we choose to develop ourselves? It's a very conscious choice we have to make, that we have to invest in technologies of the future, so that we can control the narratives of the future, the products of the future, supply chains of the future. Cell and this energy is one of them. Rare earths is another one, and we can see how our neighbors are really using it as leverage against us in a trade negotiation or whatever. The way forward for us is twofold, Tamanna. We have to partner with other countries. It's not as if only one country has the source. We have to partner with other countries, like-minded countries in Southeast Asia, elsewhere, western part of the world. And there are also, we have to leapfrog technologies. So now motors, electric motors today use rare earths. But the whole world has moved to rare earth-free motors now, increasingly.
Okay.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. Our entire two-wheeler lineup will, by next quarter, be rare earth-free. So
does it work the same way? Sorry, very
absolutely the same way.
Because if there is an alternative, then why is everyone getting blackmailed by one country that has all this?
Because it needs some technology development. It's a next generation technology. It's like 3G था, फिर 4G आया, फिर 5G आया. उस sequence में चलती है ना गाड़ी. So rare earth है, then you can you get the same performance from a non-rare earth magnet, then from without a magnet itself, electromagnet के साथ. You know, we've all studied physics in school. Electromagnets are magnets with electricity, just a copper wire with electricity. So increasingly motors can be without any magnet, it can be electromagnets only. So that's a direction of technology. It needs some level of technology development. We have done that because we've invested in technology for the last few years. Indian companies, other companies are behind on that curve, but other global companies are doing that. Many global EVs are actually without rare earth motors now, increasingly. Right? So our products will start coming in without rare earth magnets next quarter. And we do hope the rest of the Indian industry catches up. So that's one way we can kind of de-risk ourselves from the supply chain issue.
Now, if what we're creating here clearly is important for the industry as a whole, not only for Ola, of course it has to do vertical integration, margins, etc. Is there a potential to have this available to the rest of the industry? Is there the ability to scale up to that extent required?
Yeah. So this is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah. It's इतनी बड़ी factory में इतनी छोटी सी चीज़ निकलती है.
That's what it is.
As you can imagine, you know, the most complex factories in the world are for the smallest things.
Yeah.
Like the chip and the cell. You know, such a big process. ये suit wood पहन के बनाना पड़ता है. But in the end, it looks so simple. But a lot of complex technology goes in it. And you can see here, if I draw the attention of your crew, this line, you can see the cells are waiting there for this process. They're coming in over the line there. The machine picks them up, puts them in the process, and then.
What is the rate? How many batteries do you have per minute, or what is the sort of rate of production of these?
So this factory can produce 5 gigawatt hour of cells, and I don't know how many cells that means. I've never made that math. Yeah, but a vehicle takes 40 of these cells, so 10 of these cells make 1 kilowatt hour. So 1 gigawatt hour is a million kilowatt hours. That's 10 million, so 50 million a year.
Oh, wow.
Yeah, so that's about a lakh or 2 lakhs a day.
Wow.
That's what this factory will totally produce.
Very impressed as a mental math.
I am a engineering student, so
Correct.
I hope those numbers were right, by the way.
We'll check them. Okay, so now we're getting a great idea of
Yeah.
scale of this.
Yeah.
Now, my question is, what do you need to scale this up?
Yes.
There is a PLI scheme, but clearly more push will be required to bring this to fruition and to the scale that India needs.
Absolutely. Our scale right now is 5 gigawatt hour. We do aim to scale to 20 gigawatt hour as the Indian market grows. Today, the Indian market cannot digest a 20 gigawatt hour scale yet, but the Indian market is growing. So in the next few years, as we end the decade, I think we will have the potential to invest into the 20 gigawatt hour. And then beyond that, the market potential is huge. So just for automotive and energy storage, I believe India will need about a few hundred gigawatt hour a year capacity in a decade or so. Right, so it's a potential for many companies to enter and create a few large gigafactories across the country. Then beyond that, the world is also looking for de-risking its supply chains from China. And China is the largest supplier of these cells today, lithium cells. India can be a very good trusted supply chain source for the rest of the world, be it Southeast Asia, be it Australia, be it the West or Middle East. Because you will not be able to build these factories in every country. They require a lot of depth, ecosystem, technology. And I think that's where India can become an alternate, a peer to China in terms of scale and technology.
Yeah. So this is it, folks. This mega Zeta factory, you've seen the first logo exclusively right here on NDTV, and this is what comes out of it at the end of it. It may feel small, but it's definitely mighty. It is something that is hopefully
Cheers to that.
power the future. Cheers to that. Thank you.
Thank you, Tamanna.
Thank you.
Wonderful speaking.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth-free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell.
Oh, wow.
Yeah.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. as profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
They're the force behind some of India's most respected business empires.
Influencer Avdhut Sathe responds to SEBI's allegations, releases a video saying he doesn't run any investment advisory services. Benchmarks gained for second week in a row, with Nifty closing below the 25,000 mark. Mid and small cap indices gain over 2% for the week. Nifty Auto makes the best weekly gain since May 2025. In an attempt to encourage investments into mutual funds, SEBI plans incentives for first-time women investors, says Chairperson Tuhin Kanta Pandey. And in a relief for telcos, government may slash the AGR dues as the PMO revises the latest DOT proposals. If approved, Vodafone Idea's dues could be slashed to 28,000 crore rupees, while Airtel's AGR liability may be cut to 10,000 crore rupees. Real money gaming firms such as Dream11 and Gamescraft may sue the government over the passage of online gaming bill. Sources say the companies plan to file a writ petition with the Karnataka High Court next week. Online gaming bill is now a law after President Draupadi Murmu issued her assent. All eyes on US Fed Chair Jerome Powell as he is set to speak at Jackson Hole Symposium in what may be his 8th and final address ahead of his term completion in May 2026. FBI raids the home of former Trump National Security Advisor John Bolton after he criticized the president for tariffs. Supreme Court impledes all the states and union territories in the matter of stray dogs, expands the scope for final solution, says dogs with aggressive behavior or with rabies shall be immunized. Hello and welcome. A warm good evening to all of you. This is Profit 360 and I'm your host Malika Mishra. Along the next half an hour, we will be bringing you the latest on markets as well as national and international news, so follow along. Starting with the big NDTV Profit exclusive viewers, SEBI has ramped up its scrutiny of financial influencer Avdhut Sathe. According to sources, Sathe is alleged to have made illegal gains of 400 to 500 crore rupees through unregistered advisory services. And now, in the latest development, Sathe has released a video message to his followers and students stressing, "I do not offer investment advisory services." Let's listen in to that bite.
Hello dear Astayans. This is in reference to all the media reports about SEBI inquiry. Yes, SEBI did visit our Karjat Gurukul residential facility to verify whether we provide any advisory services. And you all know that we do not provide any advisory services. This is Arambha batch going on. It is 22nd of August. It's about what? 10:20 in the morning. Guys, do you get any advisory service here? No. Do you get any tips here? No. So why are you here? Learning. So are you enjoying? Yes. They are enjoying. Yes, and let me tell you, we are fully cooperating with the authorities, and I want you to, not get distracted by any media reports. All right, it's time to repose our faith in the mission. So believe in our mission, and yes, all our sessions, जितने भी हमारे events होते हैं, they are going as per schedule, as per the plan. There is absolutely no change. So just relax and enjoy learning journey. All the best.
And let's now go across to my colleague Charu, who was at one of the centers that was searched. Here's a report from her.
A little over 20 kilometers away from the BKC office of Securities and Exchange Board of India lies Flying Colours Cooperative Housing Society in Mulund. And why is it important? It's important because this is where the corporate office of Avadhat Sathe lies, the influencer who has been under the scrutiny of Securities and Exchange Board of India for giving unregistered trading advice. Now, this is a person who has been in the business for quite a while and has offices around the country, be it Bhubaneswar, Kochi, Kolkata, Mumbai and several other areas in the Sahyadri region. And he has a big network of teachers and traders who themselves are unregistered on the SEBI platform and are the people who used to be his own students. Now he is running this business in a way that there are several people on the premises constantly working in a very godman kind of a way, working on a very self-proclaimed God philosophy of trading, where they also have an energy wing where they focus on the resilience and the emotional stability of the traders and keeping them connected with their platform even if they face losses. Now this is a case where SEBI is looking at impounding illegal gains of over 400 to 500 crore rupees, but the search operation is still going on and it remains to be seen as to what happens. We'll keep you updated.
SEBI Chairman Tuhin Kanta Pandey said that speed of information is the market regulator's biggest weapon when it comes to fighting fraud. He was speaking at a mutual funds event in Mumbai. Let's listen in to his remark as well.
As fraudsters grow more creative, we must be more vigilant. Each time such a case is detected, AMCs must act promptly and monitor the evolving patterns in such practices. Such modus operandi may be shared across AMCs and QRTAs as well to immediately prevent recurrence of such cases. Remember, in this battle, speed of information is our greatest weapon.
And let's now shift your focus to how the benchmark indices fared today. Indian benchmark indices took a hit today, erasing this week's gains with cuts of nearly 1%. The Nifty wrapped up trading at approximately 24,800, while the Sensex concluded at around 81,200 odd levels. However, broader markets defied this trend, outperforming both the Nifty and the Sensex on a weekly and intraday basis. Mid and small cap indices were the bright spots, surging over 2% this week. On the flip side, HDFC Bank, Reliance, ITC, ICICI Bank and even TCS were the major contributors to today's downward pressure. Most sectors ended in the red zone as Nifty Metal, PSU banks and FMCG led the decline. Media, pharma and defense were the only sectoral gainers in fact in trade today. However, auto, realty and consumption clocked the highest weekly gains. Just over a quarter of stocks ended in the green, wrapping the market breadth in the favor of the bears. Despite this though, the overall sentiment remains cautiously optimistic, buoyed by potential GST reforms and S&P rating upgrade on India. Let's also take a look at how Wall Street has opened. Stocks were slightly higher at open, with investors hoping to end the otherwise losing week on a positive note. The Dow Jones Industrial Average traded 0.7% higher. The S&P 500 climbed 0.3%, while the Nasdaq Composite hovered around the flat line. This is ahead of Federal Reserve Chair Jerome Powell's speech at Jackson Hole to be held shortly. Investors will be seeking clues on the path forward for monetary policy and a possibility of rate cut in the month of September. What makes his address even more important is that this might be his last keynote address at the central bank's annual conclave. And this is not surprising, considering that US President Donald Trump has kept up a near constant drumbeat against Powell and his colleagues. Trump has consistently badgered Powell to lower interest rates, and in recent days, the president's attack on the Fed chair has gone past just the mere monetary policy. But to tell us about what this year's symposium holds and the political backdrop it presents itself in front of, let's go across to my colleague Jasmeet joining us.
Well, right, yes, thank you for that. Just to give viewers a bit understanding about exactly Jackson Polls is. Well, the Jackson Poll is an annual gathering of the central bankers which has been happening since 1981. And this is a platform nearly used by Fed chairs to give away the directions towards which the markets are going to flow. While the US Fed chairs often use this platform as a major signal of the policy shift, while what is said here generally turns and gives a momentum towards the market, bonds and other share-based commodities. Now, well, the Fed chair's speech title for this time's speech would be Economic Outlook and Framework Review. So that's something key highlight to watch out for. While secondly, the market expect a rate cut. The last rate cut the market had seen was back in December 2024. So the market are signaling there could be a rate cut. So that's why the positive move. On the other hand, the last rate cut was anywhere between 4.25 to 4.5. That's something to watch out for. On the political backdrop, there has been pressure by Trump to cut the rate further. And there also been pressure towards the federal chairman Powell. So that's something to watch out for. Well, any signal from Powell today would also shape the monetary policies and other policies going ahead. So that's something to watch out for.
Right, Jasmeet. Thank you so much for helping us understand that background. Now, another big headline from the SEBI chairman, Tuhinkanta Pandey, viewers. Citing the immense potential of mutual fund investment in India, he emphasized the need to increase the participation of women in mutual fund investing. Let's listen into that as well.
Today, less than 5% of India's population invests in mutual funds, which highlights the immense potential that lies ahead. Increasing penetration is therefore a key priority. To this end, we are taking a series of measures to facilitate and encourage the industry. One such recent proposal is to incentivize distributors for investments from first-time individual investors in B30 cities. This will not only bring new participants into the fold, but also extend the reach of mutual funds into underrepresented regions, contributing to deeper financial inclusion. Another priority is to encourage greater participation of women in mutual fund investing. Financial inclusion will remain incomplete unless women are equally represented. And we are thus also envisaging to introduce an additional distribution incentives for investments from first-time women investors.
And staying with the market regulator, sources tell NDTV Profit that there could soon be a cap on intraday index derivative trades. SEBI's secondary market panel has proposed a 1,500 crore rupees limit on such trades. The move comes after SEBI tightened its scrutiny of high-frequency trading firm Jane Street. Right now, there is no cap on intraday trades, but exchanges have been asked to keep a closer watch on unusually large deals. Sources also say SEBI is considering broker-level limits to prevent concentration of trades. Remember, NDTV Profit had earlier reported that both intraday and position limits were already under review. And on to a corporate news. Sources tell NDTV Profit that the Department of Telecommunication has escalated pleas from Vodafone Idea and Bharti Airtel for adjusted gross revenue relief to the Prime Minister's office for a final decision. For more details on this matter, let's go across to my colleague Aishwarya Patil now.
Well, what we're picking up currently is that the Prime Minister's office will be reviewing latest documents and a plan that the DOT has put forward, a proposal as far as the AGR dues are concerned, relief towards Vodafone Idea as well as Airtel. That is being reviewed by the PMO is what we're picking up from our sources. Now, if this plan is approved, what is on the cards for both these telcos who have massive amounts in terms of AGR AGR dues. As far as Vodafone's AGR dues are concerned, that is likely to be reduced to about 28,000 crore rupees from the current due of over 83,400 crore rupees, while Airtel's AGR dues, those currently which stand at about over 42,000 crore rupees will be reduced to about 10,000 crore rupees, is just one part of the proposal. Apart from that, DOT has also pitched a relief plan as far as the penalty and interest on penalty is concerned for both Airtel as well as Vodafone, so as to restructure and take a look at how that can also be extended in terms of moratorium as well as interest payments. That will also be reconsidered by the PMO, is what we're picking up from our sources. PMO may consider about 2 to 3 options, especially for Vodafone Idea. Now, overall, if we talk about Vodafone Idea's debt in total, that stands at about over 2,14,000 crore rupees in terms of payment obligations towards the government, of which about 83,000 crore or so is in terms of AGR. And that's the update so far. We'll keep you posted as and when we hear about what steps the government will take going forward to give relief to both the telcos, Airtel as well as Vodafone Idea.
Right, and now we have an important update on the online gaming bill. The President has given assent to the Online Gaming Act, but the act seems to have thrown everyone into a panic mode. From companies to gamers, everyone is worried about something crucial. As industry giants get ready to battle it out with the government in court, my colleague Agni is here to break down what the real concerns are.
Right, so let's look at first what the bill proposes. Now, what actually is banned under the real money gaming bill? Now, online games like poker, rummy, fantasy sports that involve real money, which means money that can actually be used for transaction, are the ones that are banned. Now, this includes, the bill does not differentiate between games of skill and games of chance. So, a tournament where you can win money through chess does not differentiate from a game where you can win money through betting on say a cricket match or a kabaddi match. Now the game has finally been able to receive the President's assent, which has turned it into an act from a bill. Now moving on, who does this directly affect, which is basically who is shutting shop. So all usual suspects, your Dream 11, your Winzo, MPL Sports, your Zupi, Probo, Rummy Circle and Pokerbazi, which is owned by listed company Nazara Tech, are all the ones that have or are in the process of shutting shop. Now, what will happen now? Now, platforms are given a few alternatives. They can focus on a different business model where they can start earning revenue through in-app purchases, ad revenue, and even a subscription model. They can sell their business to overseas buyers, because remember, having a real money gaming business in India will be illegal, and being a gamer in that will be illegal. Or they can use their established tech stacks to continue into other businesses. Now the next question will be, if you as a gamer are in these companies, have already played, is your deposit with the companies currently safe? So channel checks and sources have been telling us that most platforms are blocking new deposits, but what they are doing is allowing older deposits to be drawn out of your existing accounts, which means, say if you have a 500 rupee left in your Dream 11 account, you can withdraw it. And experts warn, however, of a system overload from sudden and mass withdrawals, basically something similar to a bank run if it happens on that scale. Remember, India has nearly 16 crore real money gamers. Let's take a look at what the flip side of the whole issue is. The act says that it's all good, but what wrong can go with it? Now, banned users, experts say, can shift to unregistered peer-to-peer betting via apps or other means, and they can start using UPI mule accounts for illegitimate means of settlement of their accounts. Now, this will also lead to a booming in offline traditional betting networks like, say, lottery betting and all, and experts believe that up to 30% users may migrate to these offline bettings within say 2 or 3 months. And they also see users flocking to offline offshore illegal sites for gambling, and they also expect job loss in an industry which is backed primarily by private equity and foreign direct investments. Now let's take a look at what the companies are planning to do. Today we were the first to exclusively report that Dream11, Gamescraft and other are considering to sue the government in court. Now which court is it? It's the Karnataka High Court, and writ petitions are likely to be filed within the next week is what sources are telling us. Now real money gaming firms are deliberating over whether to do it individually as separate companies or together as a federation of RMG companies. Now the bill has certainly become an act, and shops, a lot of businesses are shutting down, but let's see what the next week holds, and we'll keep bringing you more updates.
Right, Agni, thank you so much for explaining us the nitty-gritties of this act and also the follow-up of the NDTV Profit exclusive story that you brought to us of how these real money gaming companies are planning to see the government in the court. But in a significant development, viewers, the Supreme Court has modified its earlier directive on stray dogs in Delhi NCR. A bench of justices today clarified that stray dogs can now be released back into their original habitats after being dewormed and vaccinated. The court has put a hold on its previous order that mandated the confinement of all stray dogs in shelters and prohibited their release. However, it made it clear that dogs showing aggressive behavior or infected with rabies will not be released into public spaces. My colleague from NDTV, Nupur, now brings us more information on this matter.
Well, first of all, the Supreme Court has for now stayed the earlier directions pertaining to relocation of dogs. That is, the Delhi NCR dogs can now roam freely for now on the streets. Secondly, the Supreme Court has for now said that ABC rules should be complied with till the time a national policy is framed in that regards, and thus it has in fact issued notices to union territories and states seeking their response on how to go forward with a combined uniform national policy on as to how the menace of stray dogs, increasing stray dogs or dog bites should be dealt with by the authorities. Thirdly, the Supreme Court has also stayed this direction, which was earlier in fact passed by the two-judge bench of the top court, which had caused massive furor and protest by dog lovers. The Supreme Court has now said that the ABC rule, which mandates that you need to pick up stray dogs, sterilize them and vaccinate them, and cannot relocate them but have to leave them back to their original places where they were picked up from. That will have to be followed strictly. So in a way, this court in an interim order has upheld the previous ABC rule, which the two-judge bench had in fact called absurd. So for now, but the top court has also said that there cannot be any frivolous feeding of stray dogs. They should be fed in designated areas, and people aggrieved in colonies and residents by people frivolously feeding stray dogs can complain on helpline that the MCD should bring forward for common residents to complain about them.
The law is fine as long as we are, empathetic towards, even while making these laws, like for example putting them in pounds and shelters when these shelters don't even exist, right? That is inhuman.
As you can see, Junior is a building dog, and this society is such a sweet, accommodating society. ये भागता था बाइक्स वगैरह के पीछे, हम सब ने मिलके ट्रेनिंग की उसकी, एंड नाउ ही इज कोएग्जिस्टिंग. अब देखो आप कब से खड़े हो, उसने कुछ भी नहीं किया है.
जब इंसानियत जागती है ना, तब ये अच्छे बदलाव आते हैं. अब तक इंसानियत नहीं जागी थी. आज आदमी इतना जंगली हो गया है, इतना जानवर जैसे बिहेव करता है, उसके लिए बदलाव नहीं आ सकता है. एक कुत्ते के पीछे पड़ गए हो, वो बेचारा अनकंडीशनल लव देता है, इतना प्यार तुम्हारा सगा बेटा भी नहीं देगा जो वो बच्चा देता है.
ये अगर अटैक करते हैं एक रीज़न होता है, ये अपने बचाव के लिए करते हैं. जैसे इंसान अपने को बचाता है वैसे ये भी करते हैं. ऐसे नहीं अटैक करेंगे. आप उनको टीज करेंगे, आप उनको कुछ उनको थ्रेट लगेगा तभी वो अटैक करते हैं. इसका मतलब ये थोड़ा है कि आप उठा के उनको फेंक दें, ना शेल्टर में डाल रहे हैं ना कुछ, आप मारते जा रहे हैं उनको. डोंट अग्री विद दिस एट ऑल, एंड आई एम हैप्पी दैट दे हैव चेंज्ड देयर डिसीजन.
That was a clear message of the common man on the stray dog issue. But while the court now says that sterilized and vaccinated dogs can be released back into their original localities, lingering questions remain. How will the authorities ensure all dogs are vaccinated? How will they relocate the dogs to original areas? Let's go across to my colleague Arushi for all the answers.
Now, on August 11th, the Supreme Court mandated rounding up all stray dogs across Delhi NCR and placing them permanently in shelters. No provision was made for returning sterilized and vaccinated dogs to the streets. Shelter infrastructure had to be created and strict action threatened for non-compliance. Now, after widespread protests and opposition to this ruling, exactly after 10 days, today the Supreme Court reversed its stance. Strays will now be sterilized, vaccinated and released unless aggressive or rabid. But there are a few questions that arise looking at the order. Let us take a look at them. Point number 1 is that sterilization and vaccination are key to controlling the stray dog population. But in a city as large and populous as Delhi NCR, logistics and follow-up remain challenging. So question number 1 is that how will municipal bodies sterilize and tag dogs while keeping a record to make sure that no dog is missed or treated repeatedly? Point number 2 is that the order mandates releasing sterilized dogs back to their original areas to maintain ecological balance and avoid territorial conflicts among other dogs. However, enforcing this requires coordinated monitoring systems and cooperation from local authorities. So question number 2 is that how will the court ensure that directives to release stray dogs is in the same area is being followed? Also, point number 3 is that designated feeding zones aim to manage where dogs gather. So clear definitions of aggression, procedures for assessment and plans for containment of such dogs are essential for safety. Now the question we are raising is that how will these authorities control aggressive dogs in designated feeding areas? Now, garbage dump sites provide food source that attract strays into urban areas. The absence of directives on garbage control leaves a critical root cause unaddressed. Question number 4 is that why is the court silent on garbage dumping, which is the key cause for strays entering cities? So now final point is that animal welfare groups often take legal recourse to protect stray dogs' rights. Now imposing fees on or legal costs on such petitioners might discourage public participation and advocacy. So the final question here is that why are dog lovers and NGOs being asked to deposit a fee for moving to court? In the end, the real test will be whether these directives translate into practical solutions on the ground.
Right, Arushi, thank you so much for that and bringing us that perspective. Definitely some sound questions asked there. Moving on, viewers, Federal Bureau of Investigation agents raided the Maryland home of former U.S. National Security Advisor John Bolton today. The high-profile national security investigation related to classified documents was launched during U.S. President Donald Trump's first term, but halted under former U.S. President Joe Biden's administration. Since leaving the Trump administration, Bolton has been vocal in his criticism of the U.S. president's national security and even foreign policy. My colleague from NDTV, Disha, now brings us more information on this.
In a shocking development, the FBI began a raid on Trump's former national security advisor, John Bolton, in the early hours of Friday morning in the US. Now, this is part of a major national security probe where John Bolton has been facing a lot of scrutiny. Now, who is John Bolton? He was the third national security advisor of US President Donald Trump during his first term. And even during his tenure as NSA, he was very critical of the US president's foreign policy regarding Iran, regarding Ukraine and Russia, and really has been a very vocal voice when it comes to criticizing US president's policies even in this current term. In fact, in this incident, he is under probe over a national security incident wherein of his handling of classified documents. In fact, in 2020, he released a book where there were the Trump administration alleged that certain national security state secrets were in fact leaked in this book, and that the Justice Department even tried to sue John Bolton to stop the publication of this book.
And that's a wrap on this edition of Profit 360. But do keep your eyes glued to NDTV Profit as we bring you the entire coverage on Jerome Powell's speech at Jackson Hole Symposium.
Tamanna, thank you so much for coming here. So not that far from Bangalore.
Only 4 hours. This is exciting.
Yes.
It's exciting because we're also the only channel to get a look inside the factory. We're going to be on the factory floor.
Absolutely.
Wow. I'm tired of doing interviews in the boardroom, Bhavesh.
So good to have you in the manufacturing suit inside a clean room, not a boardroom. To make money, you need the vertical integration, you need the technology development, you need the product portfolio.
A big concern right now is rare earth.
Yes.
And I think we need to focus a bit on what you are trying to do to solve that problem.
Global OEMs, Western OEMs are increasingly testing rare earth free motors in their batteries. And Ola Electric is the first Indian company to do this. This is the output that comes here, Tamanna. You can see this is a cell. Oh, wow. Yeah.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation. India consumer equity analyst at Goldman Sachs, who's joining us this morning. Arnab, very good morning to you, and thank you so much for speaking with us here at NDTV Profit. You know, I was going through your note on the mass consumption revival that you're talking about, and it seems very heartening. Also flies in the face of how the street has been responding to this bucket of stocks. Do you think that this revival is not something that is not apparent yet?
Yeah, thanks so much for having me on. I think when we speak to investors, I think what we are getting from investors is a reasonable amount of skepticism, mainly because these stocks or this sector has underperformed for a very long period of time. It has promised to deliver, and we've had false starts in the last 5 years where it looked like demand is picking up and then it's fizzled out. So I think there is some skepticism that is there really a pickup in consumption which is happening, number one. Secondly, if there is a pickup, will it sustain going forward? Or is it just a couple of quarters thing? And the third, of course, is that will it lead to earnings growth going back to double digits, which has been very anemic for the last many years. So I think that's where I think the gradual discussions are happening.
Shifting. In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework, as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle, and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could